working. Perfect. Let me get everything sorted. So D-Day's here, man.
Yeah,
Today's the
been
day.
a crazy few days.
Let me get everything sorted. Hey, everyone. I'll give this a few minutes, as always, and then kick it off. I'm just getting the panel ready. How did you feel yesterday, man? Did you collapse after the space?
Yeah, I did. I think I got to like 7 a.m. UK and then just knocked out.
We did it. How long did the space last? Was it about 20 hours, wasn't
22 hours because you started at 9 a.m. and UK and we finished at 7 a.m. UK.
And there was one before. There was one before that, wasn't there, for like 10 hours or so?
Yeah, that was the day before. Yeah.
Feels like one long day for me. Simon, how are you?
Yeah, good. How about you? Oh, Simon. Yeah, how you doing, Simon?
Are you Simon as well? We got two Simons. Very good.
No, accent. So I thought you said Suleiman, and I let people go. They're not able to pronounce it. See, so. But yeah, go for it, Simon.
Yeah, no, I'm good, thank you. Do we know what time the announcement is? We don't know that, or?
I'm gonna check now. I haven't checked yet. I just woke up like 30 minutes ago. I haven't had a chance to catch up.
Okay.
What are your thoughts on the developments today? Slama, do you want to summarize the thread that we did and the comments from Yellen?
Okay, did you do a thread, yeah?
Yeah, now Sulaiman, you guys can't hear me well, can you? So Sulaiman, do you want to summarize quickly the thread that we did and the comments from Yellen? Be good to update Simon on that.
Yeah, sure. So basically, what Yellen said was that they're basically working hard to make sure that they try and solve the situation. The aim is to make sure that they reassure Americans that the banking system is safe. In addition to that, they're looking at possibilities of Silicon Valley Bank being acquired by other banks. And then other than that, there is obviously industry experts who we've discussed this quite in detail in these spaces, who are concerned that this bank will have a cascade, this bank falling, so SVB, the impact of it will have impact on other banks as well. And then there's been a significant drop on other banks in terms of in the index. So Signature Bank fell by 23%, Republican Bank by 15%, Western Alliance 21%, PacWest 38%, and Charles Schwab 11%. And then separate to that, in the UK, there is going to be government intervention, it seems, and they're going to do their best to minimize the loss. And so, yeah, so that's a slight overview of what we've heard up to now.
And it's looking as well from what I've read, it's looking at an intervention in the US is to protect depositors is likely, at least from what I've read. I'd be surprised if there isn't one.
Yeah. The saying is. Oh, sorry. Go ahead, Simon.
Yeah. So I think what we're preparing for is, and probably if everyone's got a different version of what they think is going to happen. And the lingo doesn't help as well, because I think people are getting quite confused with different terminologies. But the FDIC is an insurance company. They've been there all weekend. Their job is to guarantee the first 250,000 and then restructure the rest. And an FDIC, will have been there trying to assess the different assets. What assets can they sell? What can they auction off? What value is there? When you market to market, what effect will that have on the balance sheet? What is the size of the hole? And just getting an assessment, who are the likely buyers? And that's the first outcome, the FDIC, determining, can we get 50% upfront is kind of the consensus across social media and various other sources. And then what would the rest look like, so that people, these and can meet their payroll needs. The second is a takeover. So, within the crypto space, we had our fair number of fake illegal bank Chapter 11s, which was an awful process because companies can claw back each other when people withdraw money, and it can take down the whole system. We're just experiencing that in our market. But in the banking market, they have very fast reactions where banks should come over that can take on all those loan books, and then everyone can just almost log in with a new bank and be in the same position that they were before. That's obviously one of the areas. The third is what people confuse is a government bailout, and that's where we, rehypothecate the Ponzi scheme, print up some more money, taxpayers pay through inflation, and a bunch of people get money subsidized by taxpayers. I think they've announced that it's not likely to be a bailout. I've always believed that there cannot be a bailout anymore. The only bailout that could ever happen in the future would be a deflationary bailout where...
Before we continue, Simon, just a few minutes ago, we got Oak North Bank is in talks to buy the British arm of Silicon Valley Bank, which is close to being placed into insolvency proceedings by the Bank of England. So sorry to interrupt, just want to give this quick update. But yeah, Simon, go ahead.
Yeah, no worries. So it looks like we're moving towards, banks taking over. Typically in other bank run scenarios, like the famous panic of 1907, you had JP Morgan that essentially issued a line of credit and bought banks for pennies on the dollars for virtually free by issuing the credit and then taking over the relationships. We had a slightly different version of that in 2008, which was crony capitalism, where essentially BlackRock was guiding the Federal Reserve. The Federal Reserve was picking winners and losers, deciding who to issue government bailouts and loans to. Investment banks like Goldman Sachs were reclassifying themselves as retail banks to get access to FDIC money. And then they just picked which ones were going to lose. And they obviously backed JP Morgan in order to take over Bear Stearns for pennies on the dollars, a couple of dollars, in fact. And so, that's what that typically means is that the people that invested in the shares and the equity get wiped out. Silicon Valley Bank as a public company, a lot of that equity value's already depleted, so it's priced into the market as well. So yeah, those are kind of the three different outcomes. And what's interesting is seeing I've always liked to see is the industry that has the most to gain solving its own problem. I've been looking for Silicon Valley to solve their own problem of Silicon Valley Bank, because the reality is the VCs, have gone on. Various different VCs have pulled their money, told. Obviously, you want to get your money out. That's the whole definition of a bank run. But at the same time, you've seen your guarantee bit, and then we'd love to buy all these assets for pennies on the dollars once you've reinstalled confidence in the system, and we'll make all the money. I wasn't able to join the second space, but I think you've probably seen all those different versions and all those different debates. Where did we actually end up? Did we reach a consensus on the last space?
Yes, Sleiman, what you were moderating took over after I collapsed. So what would you say the consensus was? Michael Hodis was there. It's got a bit heated at one stage.
Yeah, I mean, I thought it was really good because what happened was, and I think the name was there till the early hours of the morning as well. But basically, what happened was, initially your stream or your space had the thought that basically, there must be a bailout. You need to save the bank. If not, it's going to destroy any innovation. It's going to cause a cascaded effect on the entire banking system. But once Mark came on, the view kind of changed, and he made everybody change their opinion. And then and people who even commented in the How is Mario space changed from one end of the position all the way to the other end. And that position was actually, no, we live in a the point I pointed out earlier on, we live in a capitalist society. Let the free market decide. We should not be bailing people out. We should not be even bailing out the deposits. People took the risk, and they're going to deal with the risk. They will get some of this money back, whether it's 80 cents to the dollar, and he actually believed it probably be higher than that. So let the market decide. We live in a capitalist society. We're not communist China. So what's your thoughts on that?
Yeah, well,
I'd love.
There's got to be.
Go ahead, Simon.
Yeah, I was going to say, language as well. Language is very important. A bailout normally implies, so people have PTSD from 2008, where the bankers got bailed out and the bankers got all their bonuses, and it was an illegitimate bailout because of the systemic risk. But finding a way where depositors get made whole, which in a sense are the creditors, is what would happen in a liquidation proceeding anyway. So using the word bailout is misleading. We had this when we were working with all the crypto chapter 11s. We were looking for free market solutions to restructure companies to take advantage of the assets so that creditors could be made whole or close to whole, and everyone kept calling it a bailout. So you got to make a distinction between the investors and shareholders, which is paid for by government. That's a bailout. But then
so Simon, just to clarify, even though I used the word, he wasn't using that word. So he specifically was talking about what you're calling making whole. So in terms of the depositors, that he was saying even when it came to the deposit, they took the risk. Some of the deposits were linked to the credit, and so therefore they will get some money back, 50 cents to the dollar, 80 cents to the dollar, maybe even 90, whatever it may be. But that was the risk they took. We live in a capitalist society, and the government should not intervene. So I don't want us to be hung up on the word bailout, but it's actually the point that he was making.
Yeah, which is where a free market solution is insurance. And FDIC, although it's got connection to government agencies, FDIC is a contribution insurance mechanism for insuring for disastrous outcomes. So a free market solution would be, a restructuring FDIC and looking at how you can make this as whole as possible. Now, whether that blurs the line between a private and public partnership, where the government says we'll install faith into the system so that they don't end up with a massive problem where people lose faith in the banking system, and hopefully some of them go up to buy some Bitcoin. But I'd hate for our Bitcoin to do well as a result of everybody losing their deposits in the banking system, which would be an event that no one wants. And government would do a lot to try and prevent that. In fact, they'd sacrifice the entire dollar and take the whole system down to the end in order to try and prevent something like that. But yeah, so depositors being made whole, the assets are there. It's just a question of, do you want to create some moral hazard and allow the government to back that while you try and figure out what the value of those assets are? And the problem with that, the benefit of that is you get a quick result. The problem with that is you get all the crony capitalists that take advantage of their relationships with the Fed and the government and VCs that come along and say, you take all the risk, government, in case it all goes wrong, and you be the bag holder, and we'll figure out a way of structuring all the profits, which was kind of the 2008. So you're going to get a blend in between. And so, but a free market solution can be achieved. But it's going to be FDIC is kind of a hybrid between that as well.
Stock, you were there with us till the earlier hours of the morning. What's your thoughts?
In general, I think, look, there was two solutions here, either FDIC insurance protocols in the standard way or a bailout. They've clearly ruled out a bailout. So they're looking to sell the rest of the business, and they'll have bids in supposedly by this afternoon. So, I imagine maybe by tonight they'll choose a winning bidder, and tomorrow we'll see. Maybe even tonight, but tomorrow we'll see whatever protocols they put in place as a backstop to this contagion spreading, because I know they mentioned, or at least Yellen mentioned, she was planning on doing something about that. So maybe I don't know, maybe they'll announce something tomorrow regarding the potential risk to other regional banks. But it honestly seems like a quieter
Stocky, if
solution
sort
so
of
far.
broke off towards the end there. Oh yeah. Oh, you were breaking off
Yeah,
there.
just it seems like a quieter solution so far. Yeah.
Thank you for that. Yeah, Naim, you were there till the early hours of the morning yesterday as well. What's your thoughts? Anything you want to let the audience know?
Yeah, I mean, I hope we hear more from Yellen or Powell, other than a appearance on Face the Nation. I mean, that would not give, unless they are expecting to put out a press release before the U.S. futures in Asia open at 6:00. If that's all we get, it's not going to look good for Monday. There was a tweet by Charlie Gasparino, who he's really plugged into the whole Wall Street world, so he has pretty good sources, and I trust most of what he puts out. And a half hour ago, he said bankers increasingly pessimistic that a single buyer will emerge for Silicon Valley Bank, laying out options for clients with money in there. Number one, ride it out. Number two, sell deposits for around 70, 80 cents on the dollar to another financial player, and borrow against deposits. JP Morgan's at 50 cents on the dollar for that bid. So it's not looking good for a
hold on. JP Morgan's at, as you say, JP Morgan's at 50 cents on the dollar?
Yeah, because if a bank bids on all the deposits, like they're taking a risk of what the wind down is going to look like, and how much money the FDIC is going to be able to raise for the assets held on the balance sheet, right? So, I mean, we've thrown around numbers all day yesterday of like 60, 70 cents on the dollar as far as once they liquidate the balance sheet and the mortgage-backed securities, but it's really unknown. So.
Hey, can I jump in? Hi, guys. How are you? Hi, everyone.
Hey, Wahid. So Wahid, the question to you is, I'm not sure. First, can someone offer more clarity on the headline about U.S. Treasury Secretary Yellen saying that a bailout for Silicon Valley Bank it's being ruled out?
So I think,
is that true, or is that just semantics to kind of not make it seem like a bailout while bailing it out?
I think I don't know, but I'm hoping she's using the semantics. I'm hoping she's laying the groundwork to define a bailout as keeping a banking franchise, bailing out shareholders or even debt holders, et cetera. I think that's off the table. And I don't think anyone is asking for that. I think if she's leaning towards her solution being a blanket deposit guarantee till the system stabilizes, I think that will be very, very important. I'll have a very different take on some of the comments already made. I think the capital markets have been waiting for something to break, and something hasn't broken up until now. And so people were, staying long risk assets, et cetera. Now I think there's going to be a run on everything until the Fed capitulates, because basically, the fox is out of the hen house, right? You raise rates to the point where a hyper leveraged system can't handle it anymore. And the marginal investor, depositor, consumer, et cetera, is going to go into this freak out mode now. And unfortunately, I don't think we're going to stabilize until the Fed truly blinks. And so, that's what I think is going to start happening in the next few weeks, which unfortunately in this Ponzi environment that, Simon always eloquently describes, is what resets the clock again to the next cycle. It's sad for the gentleman that says, do you want to, people take risk, they should be responsible for their own actions. That's a very libertarian view that I think no one can argue with. But the reality is we don't have a libertarian system. The reality is the entire thing is rigged, be it the repo crisis of 2018, which bailed out JP Morgan and all the big banks, be it, Swiss National Bank bailout last November, October with Credit Suisse. I mean, the whole thing is rigged. And so if the whole thing is rigged, then I just want peace of mind, and I want to be able to take risks that I need to, i.e. a venture capital company with, a product that they're creating, as opposed to this Ponzi system where, no, I do not think I should have to take risk with my deposits. So no, I put me on the chart for saying that should be completely risk-free. because they were the ones who rigged the system. They're the ones who created this silly banking system where the big are too big to fail and the small now get eaten alive. So no, I do want a rectification by the government of this system. Absolutely.
If we don't see it, Wahid, I know everyone's talking about a bloodbath starting Monday.
Mario, we will see it. We will see it. You don't solve $700 trillion worth of global liabilities, okay, without seeing it. It just does not work unless you truly believe we're going to go back to the caves. I've given you the statistics: 330 trillion of global sovereign debt, 180 trillion of consumer and corporate debt, and then the residual unfunded liabilities and pension funds. You saw the UK completely blow up with a 200 basis point run on gilts. So let's stop pretending that we have a system that is fair and libertarian. We do not. The system cannot handle much higher rates. Okay. And you know, as a human society, we either move on or sing kumbaya. I don't know what to tell you, but that's the reality.
So you disagree with Qual's, before going to other panelists, just one more question to you, Wahid. So you disagree with Qual's statement that this won't impact larger banks and the broader financial system, will impact small regional banks. So it's limited impact. You disagree with that?
With regional small banks. And then, you know, credit spreads start to widen. And then the JP Morgans of the world, et cetera, tighten liquidity even more. And then Home Depot and others start seeing credit lines shut. You know, it's all over again. Yes, the banking system is much less levered than it was in 2008, but the whole globe is more levered. We have a shadow banking system that is 5x the size of what we dealt with in 2008. Okay, we have a derivative system that is you know, is triglyceride, right? I mean, it's you know, it's a neutron bomb. So let's not kid ourselves. We live in a system, okay, of fiat that is very highly leveraged, and we've been playing this game of raising rates to try and fight inflation till something breaks. Okay, now something breaks. So okay, now everyone's going to run on the next marginal weak hand until the Fed capitulates and restarts the cycle and solves the problem with even more leverage. Simon is the best at describing it. I mean, this is unfortunately the system we all created as humankind. I hate it, but it is what we have.
Kim, you got your hand up. Thanks for joining us. What's your thoughts?
Yeah, well, I mean, by Yellen announcing that they're not going to bail out Silicon Valley Bank, they're basically telling all investors and shareholders in Silicon Valley Bank that they can write off their money. 6 months ago, that was a $24 billion market cap. There is a liquidity crisis now in the market. All banks are struggling for money. In a situation like this is going to set off an avalanche of additional write-offs of other companies failing. You know, similar to what we have seen with FTX, you will see side effects to this non-bailout. And it's just really going to push the market down. I expect on Monday a major crash in the US market.
We'll find out in a few hours, Kim. Futures open at 6 p.m. Eastern.
So to build off
that,
my bad.
Christian, sorry, go ahead, Kuchi. What were you going to say?
So to build off of that, like, wouldn't you think this entire Yellen coming out and announcing that there's no bailout happening, wouldn't you think that this could potentially have been the perfect present sitting in, you know, the Fed's lap to stop, I mean, kind of give them the benefit of downward inflation finally, without them directly, you know, putting anything towards it? Because now if they create a bailout, then we're, you know, only looking at a higher inflation instead.
I mean, Kuchi, do you think that she was being, you know, maybe working in semantics? So when she said no bailout, she meant, you know, the investors and shareholders, but she didn't actually mean specifically the depositors.
I mean, I'm eager to hear what they have to say later on this afternoon. I mean, I think that'll paint the clear picture.
For sure. Christian, what's your thoughts on that? And then any other comments you've got?
Hi, guys. Thank you for having me. Yeah, I just wanted to share my 2 cents on everything that's going on. So very, very quickly, if you guys obviously visit the website on FDIC and look through all the documents, their balance sheets, and all the 9 yards. We can see that their designated reserve ratio is 2%, right? They have in reserves, they have 2% of $19.36 trillion of all U.S. deposits in the banking system. Now that comes out to roughly about $380 billion that they have in reserves, but they actually don't have that money sitting on the reserve account. They've actually loaned it back to the Treasury. And obviously that probably got loaned out again. And, Treasury probably just gave the FDIC an IOU. And so that money does not exist for reserve accounting. So that being said, it almost seems like the Fed, hypothetically, let's say, who knows what happens on Monday morning, right? Who knows what happens in the next 6 months? A lot of the loan to deposit ratios of a lot of the smaller banks, they've levered up almost to upwards of 95, 96%. When the Fed and COVID hit, they lowered that reserve ratio. So all the smaller banks took a careless approach and they lent out most of it. And so whatever happens, in the next on Monday or the next 6 months, it's going to be very, very interesting to observe, simply because if the Federal Reserve is going to try to bail out the FDIC, because the FDIC does not have that 2% of 19 trillion, then essentially what it means is the Fed is going to have to sell a lot of their treasuries, a lot of their assets on their books, more so than they're currently doing during the quantitative tightening. If that happens, that means that it's going to create a bigger, sell-off on the bond markets, which will actually hurt the banks even more. For all the banks that bought, those low-yielding 10-year treasuries that were yielding 1%. So now if you have this bigger sell-off that the Fed sells their bonds to create cash to bail out the FDIC, that just puts more strain on the entire banking system, right? So where does the Federal Reserve raise that capital to bail out the FDIC, right? The FDIC doesn't have those almost $400 billion in cash reserves to bail out a lot of the banking system. So the question is, where is that money? Where could they get it? And that's what, I've been trying to wrap my head around. The only way to get it is to sell more treasuries from their balance sheet. But that creates a bigger sell-off in the bond market. So how do you solve this problem? And then the only other problem is insurances. If you look at the market, and I think it was Warren Buffett who, called the insurance, all the insurance companies creating these synthetic CDOs and synthetic products of derivatives market. Bloomberg reported not too long ago that there's about $65 trillion of missing derivative debt. And this is what Warren Buffett was referring to. He calls it a weapon of mass destruction. So all these insurance companies are insuring all these treasuries and all these synthetic products, a lot of credit default swaps, a lot of other synthetic default swaps on top of that, insuring derivatives on top of derivatives on top of derivatives. And Warren Buffett back in the 80s and 90s, he was familiar with all these products as they were beginning to be created. But then, in the early 2000s, that's when we saw the big spin-off on all these products. And as of today, we have, in the 60s of trillions of dollars in derivatives debt, but that's notional value, right? So if one missing piece, kind of breaks apart, what happens then to the entire banking system, right? And so where do you hold your cash? And the answer to, where do you hold your cash when, Warren Buffett is right, the weapons of mass destruction with all these synthetic products. The answer to that is obviously, well, you got to look at the healthiest countries, right? And which countries have sustained moderate levels of deficit ratios relative to their GDPs for, let's say, in the period of the last 15, 20, 25 years. And the answer to that is actually Norway, Denmark, Luxembourg. These countries have actually sustained very healthy economies, very healthy deficits where, they collect not non-deficits, they have surpluses. And essentially, putting money to work in Norwegian and Danish government money market funds would be probably the safest bet against the United States economy falling apart when the Federal Reserve has to bail out the FDIC because they don't have those reserves, right? So that's just obviously something that I thought of a lot. We've done a lot of research on, simply because, it takes one one crumbling toothpick to bring down the entire building, and it's very scary when you have synthetic products out there that represent the entire system, but the underlying assets don't carry any actual value, so pretty scary to know. And so what happens now with on Monday, I think the Fed is going to do right by depositors, and I think it's the right thing to do. Depositors are first, the equity holders and bond holders should come last. They knew the risk that were taken by investing in a company, that was not hedging. They never hedged. If you looked at their operations of Silicon Valley Bank, all their balance sheet, they never hedged once with interest rate swaps in case interest rates changed. So they had, improper risk protocols inside that bank. They should have had a better chief risk officer to hedge all those securities and all those treasuries that were buying that were yielding 1%. In no way or form is that a great way to do right by your customers. In fact, management teams are in of itself the greatest risk to customers itself. It's not even so much their own individual businesses, right? All the family-owned shops, all the people trying to grow their startups, and the risk, the economy is a risk, mortgages are a risk, interest rate is a risk. None of these are risks as much as the management teams inside banks, simply because they are not looking at proper risk protocols. They're not looking at all the different variables that affects depositors. And so all that management team should be fired.
And Christian, that is interesting. And I just want to ask Justin this, because Christian's mentioned that they've been reckless, they should be fired. And more to your forte, what do you think? And what I'm doing is laying out the different issues before we actually get into the depth of the discussion. So what do you think the possible political ramifications of this are? So Yellen's obviously engaged in this because they're concerned about this, but what could be the result of this?
Oh, it could. Go ahead, Chris.
I'll take it. Yeah. So there's an actual model cases on this where a lot of the probabilities of real GDP growth being destroyed into the future stems from the very basic nature of GDP, debt to GDP ratios, right? So what I've found is that any real economy that has sustained levels of debt above 77% are going to create negative real GDP growth into the future for every percentage point above 77%. So the answer to that is, I think we're at around 138% debt to GDP. So for every percentage point, subtract 0.00175, and that equals to about a negative 1% in real GDP growth into the future, which will actually affect the value of all equities and the value of all financial assets.
And that's only sovereign debt, not consumer, corporate, and unfunded liabilities.
Correct. Yeah, that is all public debt owned by Japan, China, et cetera. Right. So, and all including intragovernmental debt as well. So the threshold for a stable growing economy is no more than 77%. And if you look at someone ingenious like Warren Buffett, right, he was able to grow and compound at levels of 20% per annum during a period where every single administration kept the debt, under essentially 77%. And it wasn't later until the 80s where that level started to get higher and higher and higher. And actually his performance started to falter a bit in that sense, simply because, again, real GDP growth is still going to be the number one factor that drives, financial assets. And so if we have unsustained levels above 77%, we're going to be yielding about negative 1% real GDP growth into the future. And so every single financial asset has to be discounted back to the present with that in mind, those terminal values in mind. So if you believe the value of Uber, Uber can grow, say, 5 or 10% per annum for the next 10 years. And in perpetuity, then it will start growing at negative 1% in perpetuity to the end of its life, simply because the country cannot grow with these levels of debt, right? So the debt has to be completely restructured. What's the biggest risk, I think, to the entire United States? It's not so much, one administration Janet Yellen or the Federal Reserve, or it's essentially just people who do not understand the macroeconomics and running a corporation, right? The United States is the biggest corporation in the world, and those debt levels need to be respected, right? The government spending is essentially what drives negative real GDP growth. And so that government spending, if it doesn't get taken care of by any administration into the future, no matter if another Democrat gets elected and essentially he's all against Republican values, or Republican gets elected and he's against democratic values, what needs to get addressed for the health of the country and the health of the US empire is the government spending. And that's essentially what drove Japan back in the 80s with that growth. They were our competitor back in the 80s, and then essentially their real GDP began to yield negative 1% per annum because of that government spending, right? So if these things do not get taken care of, there's going to be disasters. Every financial asset.
Okay. So, Kristen, on the political side of things, here's what I see taking place, because Thomas Massey, Representative Massey, very smart, uprising Republican on several influential committees, came out with a very powerful thread this morning. And he talked about how he really put the blame right at the feet of the Federal Reserve Bank. He used different sort of nomenclatures to describe these folks. He said, first, they're like Santa Claus. They're keeping they kept the interest rates artificially low, stimulated the economy, nudged those with capital into the VC space, creating a demand for a bank like the SVB. Then two, they play the arsonist. The Fed created $5 trillion out of thin air so Congress could inject the money into the economy. Then three, they come in like the firefighter, right? After this blaze is set, he said, the Fed came in to rescue the fight inflation by rapidly increasing rates. As a result, net VC startup deposits into SVB slowed, while assets held by SVB became less valuable. Then four, they become the trauma doctor, right? Will the Fed play a role in bailing out SVB depositors and other banks, ? Possibly by lowering rates, buying their holdings at above value, or creating more money for bailouts. None of these are free, but the Fed becomes Santa Claus again, and the cycle continues. I think that's what we're going to hear from Washington. I don't think there's going to be any stomach for letting approving anything beyond what powers the FDIC and the Fed can muster. I don't think there's any technical way they can go above the 250, except for just finding good rates to sell everything else off. I think an expansion would be crazy. Right. So that's what's happening in DC.
There's just came out. There's $1 billion of loans being offered by Global Liquidity Group. I don't know if you guys have been to their offices, 419 Lafayette Street, New York. They're also raising about $2 billion from outside funders to help backstop the credit lines that SVB was originally offering. Now, this is all conditional on this Sunday offer. I don't know what's going to come up with that. You guys have probably been discussing it already, but this is a pretty big check. And this is not like Oaktree just buying individual lines at 60 cents on the dollar. They're offering between $1 to $10 million on a typical loan, or as much as 30% of the balances held within SVB. They have as of right now, they have about $1.2 billion of cash available to give to companies.
And so, where would that leave us in terms of the current situation?
Well, this is just one person. I'm assuming more guys are going to step up to plate. But where it leaves us is that a lot of the companies, there are $62.5 billion of off-balance sheet commitments and revolving credit facilities that were going to these companies that used that money, that drew down on those facilities to pay people and pay their expenses. This company is saying that they're willing to, over the next several weeks, start at $1.2 billion and go up to $3 billion, right? Which takes care of about 5% of those commitments. But we need to see more companies get up to plate. If you are a tech company, you should reach out to Liquidity Group. They have a phone number on their website, and they have an email box. You should reach out to them right now to just be at the front of the line.
But I'm sorry, this is Ryan. Just what's the point of reaching out to them if Yellen's pretty much said that customer deposits are going to be are going to be
It's not about
honored?
deposits. It's not about deposits. It's about the revolving credit lines that these companies have to draw down to fund working capital.
Okay, got it. Okay, so it's companies that have got approved loans with SVB.
That's correct.
No, I think this is helpful because it's credit lines. Those are going to get canceled. It has nothing to do with deposits, as you said. One thing I would point out is we have 600 billion of duration mismatched balance sheets in the mid-tier savings and loans banks of America. So, I worry about the big elephant in the room here. So they do need to find the solution with deposits and I don't want to say make a blanket, but basically say whatever it takes, the Mario Draghi famous statement, where any bank can to prevent any run on any bank. I will say from political aspects, no one's ever really asked for the Fed chair to resign, except for Donald Trump. And I'm not advocating that. I'm just saying that it's just weird how we have a system where they're not elected, they're appointed, but no president can say they've lost confidence. They are completely immune to their term. And there's not a single position, literally, around the world, not even Bank of England, the ECB, where people are 100%, actually the ECB is, where they're 100% immune. And they've made so many mistakes and there's just zero accountability, zero. And then they have all these open positions and they keep doing the same damn thing, going to these useless academics that have zero life experience. I mean, ironically, Powell has a little bit of life experience, but they keep perpetuating.
Powell has a lot of life experience. He probably has more financial experience than anyone on here.
Well, he had a little bit of experience.
A lot of experience.
With Carlyle Group, right? But not exactly running money. Okay. Not exactly running money. So that's a very, very, very different position at Carlyle. Okay. I mean, you cannot possibly do the Wyoming speech in 2020. All right. And basically say you run a risk with a hyper leveraged economy. You can push disinflation, hence why we need to absorb this transitory thing. Get appointed, and then immediately after you get appointed, start this hawkish run and completely destroy the system. Okay, I'm sorry. Someone needs to be held accountable.
Powell was making up for a mistake he made before. Powell, I don't know if you know, he ran his own investment firm, Severn Capital Partners, for years. I mean, this is a very sharp guy. He was forced into this situation because of an exogenous shock. He eased for way too long, and then he had to correct his mistake. I will say that the majority of the people who work for the Federal Reserve are academics. But you look at people at the Treasury like Hank Paulson back in the day, Powell, there's several people that have real experience. In fact, like most of the Treasury secretaries over the past several years have come from Goldman.
Yeah, but you look at Yellen over the past 2 years, and I think even up until like early last year, she was saying inflation is transitory. This is all transitory. This is all going to go back to normal. Just buy all of our low stuff. And it keeps going and going. And I think the impacts are there. Well, I will say an interesting caveat. These are sort of side things that are happening, the impacts of what happened. I mentioned last night, but I'll mention it again. I had a co-founder of a startup company I did some years ago, and he's on to different things now. And I just reached out. I said, so tell me about SVB. What are your thoughts? He said, completely wild. He said, I was at a founders retreat this weekend. Biotech company can't make payroll on Wednesday. He says, I have a term sheet for my new stuff I'm doing, supposed to close Friday, but they have 38 companies with money at SVB. So it's totally hung up and just tons of impact. And then like an hour or two before that, I got just a DM because I'm on these spaces. I'm not in the financial arena anywhere. But he says, hey, Justin, I guess he follows my COVID stuff. He said, a big fan. If you have any startups with small-term capital needs, please reach out. I work for a large family office focused on credit. I'm like, okay, the vultures are here, but there's something there. And he DM'd me again this morning.
You should share the name of the family office.
What I will do, go ahead and just do, if you want to DM me, I will absolutely put you in touch. He says, they got one company they set up with a $1 million bridge loan on this stuff. So yeah, give me a call or just shoot me a DM. My DMs are open. I don't want to be the middleman for this thing, but I will definitely pass on the information. So,
guys, what do you think the Fed does this week? Having this weekend having passed, and everyone pretty much realizing that there's a much bigger banking problem with the same thing.
I think the Fed is going to raise another fund that eventually is going to insure part of the non-insured deposits. If you look at First Republic, which has 68% of its deposits non-insured, now it's a very good bank. It has high quality customers, but the Fed has reached out to a number of banks of that size with those types of issues, and they're working on setting up a new fund. Maybe it'll be a mix of private public capital. Maybe the banks will have to contribute, just like they contribute fees to the FDIC fund, which is a private institution. But I think they're going to, at 11:30 tomorrow, talk about raising a new fund to insure some of the non-insured deposits.
And what do you think they do in terms of interest rates? I mean, there is one school of thought.
I think it depends on the market reaction, to be very frank. If everyone goes and starts shorting all these companies and freaks out, people are going to be buying bonds. If people believe that the Fed has a solution to this problem, then the market will be a little bit more balanced. But it really depends on, no one really knows what the outcome is, but it depends on the state of our banking system next week. If there are more bank runs, then I think the Fed will have to pause regardless of the inflation situation, because remember, the central bank is a bank, and all these 11 governors, they all oversee territories, and they all oversee different swaths of the 4,900 banks we have in the United States. So it's, Powell's not going to look like an idiot and have like several banks go bankrupt under his authority. It's more important than inflation. It's more important than inflation, which most people don't seem to understand.
Yeah, I think you're very smart. Special situations. Thanks. I'm hoping, because of Yellen's background in San Francisco, and the New York Fed chair actually came from the San Francisco Bank as well. I'm hoping they'll have a little bit more insight as to how tragic this thing is. I will say one thing is that there's a lot of swap lines. There's a lot of central bank bailouts. People don't realize this, but foreign banks, when they fail, can tap into their respective central bank, and there's always a ready swap line available at the Fed. And so I'm really hoping people stop criticizing these small SMEs and the VCs and say, oh, they're just getting bailed out, because we keep doing this every few months and people don't realize. And then last but not least, unfortunately, the Fed only pivots. They're always late to the game. And what really pisses me off about the Fed is they're so behind the curve in both directions, right? And you just need to follow the 2-year, right? In order to basically gauge what they're going to happen next. I mean, that is not being ahead of the curve. That's not being proactive. And they really need to be held accountable in order to actually start creating value, as opposed to staying behind the curve and causing a lot of damage in both directions.
How do you hold them accountable? And Ron, just to answer your question.
You can hold them accountable. With this new fund, all you have to do is set it up so that JP Morgan, Citigroup, PNC, all banks contribute to the fund every year. So it's not really a bailout. Maybe at the very beginning, right, there's a backstop. But over time, these guys repay into the fund, and it's essentially the banks paying for their own insurance.
Yeah, look, that's a good way of doing it. I'm not denying that. I'm just saying, when I say accountability, I mean actually, at the Fed level of a bad decision making. I mean, I think you just said you can't remove, or someone just said
you can never fire. No, I said it.
Yeah,
it's true.
Yeah.
Trump couldn't even fire Powell, and they do that with political reasons.
But Ron, let me just jump in. So on this point, like I think 50 is off the table. I don't think anyone in their right mind thinks that 50 is a possibility.
But Vinny, if you look at the charts, the reason why I asked the question is exactly this. On Friday, when this thing was going down, the probability of a 50 basis point rate hike went to 25%, and the probability of a 25 basis point rate hike went to 75%. Over the weekend, it shifted back to the majority towards a 50 basis point rate hike. Now, this is the part that I'm struggling to reconcile here.
Yeah, rate cuts by the end of the year. Absolutely. Is that what you're saying, Ren? Absolutely.
No.
So you look at CME futures. So what he's saying is, if you go to the CME futures website and you look at the probability of the next hike, it went from 80% 3 days ago to less than 50%. He's commenting on the next hike. No one knows, what's going to happen with, the cuts. The market is
right, but the same curve is saying rate cuts by the end of the year. It backed off.
Not this time.
Hold on, guys. I'm not a bond trader, but can you just make sure I'm gonna ask the question? I think
that's true. I'm looking at it now. That's true. The market is expecting rate cuts by the end of the year.
So,
Okay,
so let me just ask a question because I don't know the answer to this. Is it possible that people are fleeing into bonds because of being scared, and that just affects the curve? In other words, like the markets, there's a mispricing happening because the demand now is more out of fear than anything else.
No, they're pricing disinflation. That's what they're doing because this is the most deflationary shock. This is the issue.
The most deflationary thing that can happen is for banks are levered 10 to 1, and it's a fractionalized reserve system. Banks create money out of thin air. If you have banks collapse, M2 is going to go into the ground. It's going to go so negative. People are going to forget what happened in 2020, 21.
I assure you, it's negative this week, sharply.
I hope you're right.
On a fun note, I have a method of predicting the future. So what you do is with the Fed, you figure out what is the best decision they can make, and then just bet on that not being the decision that gets made.
So I mean, go ahead, Ron.
The other question which I have is, if they've pretty much told us that all depositors are going to be made whole, and we had a statement from Jeremy Allaire come out and say that they actually requested in the right time period for their money to be paid out of Silicon Valley Bank, why isn't USDC trading at $1?
So first of all, Rand, they didn't say that. It's very opaque. She did not say that.
Rand, what she said is that they're trying their best working to help depositors. That doesn't mean they're bailing out depositors. And then later on, they said that deposits are covered up to $250,000 by the Federal Deposit Insurance Corporation. So anyone who has the deposit higher than that has no guarantee whatsoever at the moment. And we're talking about 176 billion in deposits. So what Yellen has said is not at all what you just made it up.
The quote is, and I'm reading the quote, is depositors don't have to worry about losing access to their money. That's the quote.
Yeah, well, she's not saying they're going to guarantee 100% of the deposits, but what she is saying is, and the FDIC has already said this on Monday, up to $250,000 is available Monday, and that's about it. But they're not going to go to zero. Like, most of these depositors will recover 60-70% or more of their money. It's just going to take time.
Yeah, but still, guys, this is not about SVB anymore. It's about all the mid-tier savings and loans banks. Please, there's a 600 billion mismatch on duration. Okay, every bank, every small and mid-sized bank cannot handle it.
Absolutely.
Yes.
Yeah, that's what I wanted to comment on earlier. And this is from the FDIC website itself. The chairman gave a speech, I think, a month or so ago, and they put a chart in here about the unrealized total unrealized gains on losses on investment securities. And just due to obviously the Fed rate hikes, there's currently a $620 billion unrealized losses across the whole banking system. So that's pretty much the elephant in the room. And I'll read her. Hold on. I'll read her quote. Her quote is, "The combination of high level of longer term asset maturities and a moderate decline in total deposits underscores the risk that these unrealized losses could become actual losses should banks need to sell securities to meet liquidity needs." So our banking system is sitting on unrealized losses of over $600 billion right now.
But why doesn't the banking system?
We talked about this.
Mark to market.
We talked about this last week. The 620 billion. There's a very low probability. It includes AFS and HTM. There's a very low probability it's actually going to be realized, right? JP Morgan isn't going to say, "Oh my God, I have to sell all these government bonds," right? Most of the 620 billion is at the very, very large banks, but the problem at the smaller banks is obviously real. Right. And people are talking about, and I think, by the way, I think Schwab's going to be absolutely fine at the end of this. But, Schwab is 173 billion itself. So it's concentrated at bigger institutions. It's not,
but Jay,
it's not like some of these small banks, by the way, so you guys understand, 90% of the small banks have zero exposure to treasuries. They're mostly funded by deposits, and at most have 10% exposure to securities.
Jay, you are assuming
Mario,
there is a rational decision making here. Name 1 second. I wanted to make sure that it's clear. This level of uncertainty in conversation, I believe yesterday when we were all on stage and having a conversation, we wanted more certainty. Can we say that I've heard that from Janet Yellen and the rest of them? Do you feel more certain?
No, they've had 24 hours. They've had 24 hours.
I feel very
Listen, if all we get is a Face the Nation interview, then that is like, that's terrible. They should have had some sort of press conference at the very least to give some reassurance. We get Hank Paulson up there, or Tim Geithner.
Guys, this is nothing like 08. They had a year to prepare for this. The Bear Stearns hedge funds blew up in July of 2007. And Bear Stearns started having issues in March of 2008. These guys had fucking 7 months to prepare for all those meetings you're talking about. Right now, these guys had 1 day, right? This happened on Thursday night, Friday. You need to give them some time. Like, you guys want certainty. I want certainty too, but you can't imagine that these guys don't even know what the hell is going on, right? They need to figure out what's going on. They need to get bids. They need to understand the problem. They're talking to executives right now. I posted on my timeline. They're talking to executives at all the banks to figure out what the issues are. And eventually, right, they're going to come out with something more holistic, but you can't just assume 24 hours that they're going to wake up and have a solution to this.
So Bill,
they say that the Fed continues to increase rates until something breaks. Do you think that this is something?
This is the first sign. This is the first sign.
This is the first little earthquake.
Well, and just to explain that, like if the Fed drop rates 400 basis points tomorrow, for example, the whole disappears, right?
Yes.
I mean, inflation goes to the roof. We have other problems to deal with, but it's directly a function of the inflation rate. So the same applies to what SEB is holding, etc. Because the rates have gone up, these things have been marked down, and it's a good point. Like, why if they change the rules to do, that you have to mark to market even the stuff that you're holding to maturity, how healthy or unhealthy would the system look today? And that's a question for Special, actually.
So your question is, if you were to market the HTM losses today, which by GAAP accounting standards isn't allowed, and you're saying what would capital ratios look like today?
Yes, if all the banks system wide were forced to market even the stuff they're planning to hold to maturity. Remember, just because Silicon Valley Bank was planning.
I have the answer.
Yeah, go ahead.
So right now, the banking system, and we on specialsitsresearch.com, we cover a variety of sectors. We have 9 analysts. We've been covering the banking system since February. So we have a space on Discord coming at 3:30 where we go through all the numbers. But we've been doing work on it, and there's $30.1 trillion of total banking assets in the United States. And against that, there's $18.1 trillion of deposits. And outside of the 18 trillion of deposits, there's several trillion of securities. Now, the banking system has about 4 trillion of equity. So the 600 billion of losses, right, will take the tier 1 capital ratio of 12%, right, down to something like 9%. It's really not the end of the world, even if they have to realize it. Now, in my opinion, you'll have to realize less than 10% of those losses, because most of those losses of the 620 billion are very, very large institutions that can just hold those bonds till they mature. So I personally think that the actual hit would be very, very little. And you'll see maybe a handful of banks that have to raise capital, and they'll have to raise a new fund to guarantee uninsured deposits. But for the majority of the very small and large banks, there is no problem.
So everybody,
the bottom line is this: the Federal Reserve creates these problems by their policy.
Danish, go ahead.
Yeah. So sorry, Name. Just wanted to invite. We have someone on stage, Thomas Massey, representative from Kentucky. With everything that's going on, it would be helpful to get more information from people that are actually working within the government.
That's awesome.
and getting a very clear sense of what's actually happening. So, Representative Massey, thank you so much for joining us. I imagine this has been a very busy weekend for you.
Well, I'm trying to catch up. Listen, I'm not an expert. I had 3 economics classes at MIT, and Paul Krugman taught the macro class that I took. So I'm definitely not qualified.
Well, but you can give us a sense of what your initial reaction has been. You know, today we saw Representative Ro Khanna and we saw Janet Yellen doing the rounds on the shows. Have you had a chance to see those? And what is your initial impression of how the government is handling this situation right now?
Well, I threw my TV away 20 years ago, so I haven't seen my colleagues speaking on this, but I have a lot of threats. The first is this is sort of this is a symptom of long COVID response. So, I mean, this is partially fallout from the fact that they created $5 trillion during COVID because there weren't $5 trillion to borrow at the low rates. Nobody was going to loan the government $5 trillion to spend in that environment at those rates. So we just created it and spent it. And that's the primary driver of inflation, that and some of the policies that increased demand and kept people from working and killed production. This is sort of the fallout of that, in my opinion. The reason I'm interested in this is because eventually they may come to Congress and we may have to vote on something. Now, they may just try to do all of this at the Fed as well. And I think they have several levers to pull. They could buy back some of the paper at these banks at, you know, without discounting it. They could buy it back at retail value, even though it's not worth that. There are other levers that I think the Fed can pull without coming back to us. But
all due
respect,
did them back at that level and hold them. Wouldn't that sort of solve the problem? Again, these are small businesses who are losing jobs, can't make payroll. Wouldn't this be the most economically viable thing to do here?
Well, there's lots of ways they can solve the problem, but none of them are free. Like, they could create more money and then Congress could just go and bail them out by spending that money. Or, I mean, none of it is free. It's all going to lead to inflation. And one of your speakers already said before, another solution is to lower interest rates again. But there we are. We're back to inflation. And I also have some thoughts that I haven't put on Twitter. So I've got a Twitter thread on the Fed's contribution to this problem, and I won't repeat it. But look, the notion that the VCs, by the way, I raised $32 million of venture capital for my startup. My partner and I did. And they were going through that process. I learned a few things that surprised me. We did 3 rounds when I was there. They give you all the money at once. Like, the third time we raised money, we raised $23 million. And after the investment bankers took their cut, it was still over $20 million. We put it in a bank that day. And I was shocked. I thought, why would they trust us with all this money at once? But they do. And I also remember once in our first round, we raised $2 million. And it was coming up on a weekend and we couldn't put it in an interest-bearing account. And the only interest-bearing account there was like one down in Puerto Rico or something. And we decided we probably shouldn't do that with the money we had just been given. But
probably good.
Yeah. But the notion that the venture capitalists couldn't couldn't identify the risks at this bank, I think, are somewhat ridiculous. Like, as a founder of the company, they subjected me to a blood test so they could do key man insurance. Like, the venture capitalists they pride themselves on due diligence, and they should have recognized that this problem and long ago. And maybe I think, by the way, the DEI thing.
But Representative Massey, sorry, just to kind of push back again. Just to have a real conversation here.
Yeah, please.
The venture capitalists actually weren't even holding their money there. The founders were, just like you said. Right. And those founders don't have, your focus as you build business, you're focused on reaching product market fit. You're not focusing on looking at balance sheets of a bank and trying to understand whether, as you can imagine, when you were running the company, of all the things we were thinking, as you think as a founder, the last risk, there's many ways your company fails. The last one you're thinking of is a bank run. Don't you agree?
That's right. But look, the VCs put people on your board to and they pride themselves on saying, "Oh, we're value add. We know things you don't, and we'll help you. So don't take that other VC's money. Take our VC's money because we have all this value to add." And this is one of the things they should have been adding. Now, I do think there's an element of the DEI conversation. I think that don't focus on that too much, but this bank was sort of courting the West Coast startups who were seduced by that maybe over some of the principles, the fundamentals of the bank. But let me end with this and take some feedback. I came on here to listen mostly because I want to hear the experts. I know you have some experts on here, and in case this comes before me in Congress and I have to take a vote or inform other people who are going to take votes.
So can I ask? One of the questions that comes up quite a lot in our and Faith, I'll go to you next. But one of the questions that often comes up here is if this bank was not called Silicon Valley Bank, and let's say it was called Farmers and Unions Bank, would there be a different response? Is there something that makes this bank unique, in your opinion, that makes it really hard to look at these companies as small businesses and instead see it as Silicon Valley playing it fast and loose?
It is a community, and by the way, I think the everybody who invested their money there should take somewhat of a haircut, or else or else there's a moral hazard because there is a community there. And I would tell you, if it were a farmer's bank, there probably wouldn't be a DEI web page for the bank.
That's fair. Faith, did you have a question for us?
Yeah, look, so pleasure to have you, Representative, and thank you. We're honored. One thing which I'm bothered about and just profoundly mystified is how there's no accountability for the Federal Reserve. I mean, a lot of the huge economic blowups have their fingerprints, and then they go in front of Congress. Sorry, I'm in an airport. And they testify and they get grilled for 5 minutes on both sides of the aisle, but there's absolutely no checks and balances, no accountability whatsoever. You don't serve at the confidence of the president because he or she cannot fire you. You have these term limits that are quite expensive, and the only time there's a little bit of accountability is on the nomination process, and there it's just how many senators you have on each side of the aisle. It's ridiculous. And we give them so much power. And all of you, every single other post in government, in public policy, has accountability, be it to the electorate like this. How on earth have we given these people godlike status?
Well, you're preaching to the choir. Obviously, I'm the one who introduced HR 24, which is the bill to audit the Federal Reserve. They only undergo a perfunctory audit. And the reason they don't take us seriously is they know we're not going to do anything to them. Now, they always argue that, we need to be independent. That's hogwash. They are not independent. They are trading emails and working with the Treasury every day. They have to in order to pull off the monetization of the debt. And then there's the revolving door between the banks and the Treasury and the Fed. It's the same people working in all these places. They just take turns. The one place that's not involved is Congress, except for the occasional obligatory show up and say something in a hearing.
So Representative
Start a process to call for the resignation, and let's get the people to petition. Let's utterly humiliate them. If this is going to be in our hands, let's do it. I'm sick and tired of having me have to follow them and their decision making on whether I take a risk in this business or that business or this country or that. People say, we need free market economics. Representative, you're a libertarian, you want free market economics. We don't have that. So long as these guys are in charge, there's nothing free about this market, nothing. And so if it's not, then I don't want it to be rigged against me.
But are we going to get a libertarian to run the Fed? I don't know. It'd be special kind of hell for that person. But, we got rid of John Boehner, and I was a part of all three coups, and we ended up with Paul Ryan, and not a damn thing changed. And so that's why this time when we were having the kerfuffle over the speaker, I told my colleagues, I said, listen, what we have to get out of this is a change in the way the place works, not just a change in the person. So, yeah, we could call for his resignation, but if there's not some, something that a Magna Carta to go with it, I don't know if it's going to have much effect.
And hey, Congressman, it's Justin Hart. Thanks for coming up here. Just do you feel like there's another shoe that's going to drop on this thing? What's the sort of buzz that you're hearing? I mean, the fear is that this is just the beginning of some of this kerfuffle. What is your sense from what you hear?
Well, I'm worried. I'm wondering about the second order effects. Maybe the people who stand to lose money at Silicon Valley Bank are the ones who are trying to say, hey, there's going to be a run on the banks if you don't take care of our problem. And then I hear the banks who stand to gain quite a bit with lower interest rates. If the Fed would drop them half a point, that would just immediately go to their balance sheets. They're the ones who are out there saying, oh, you better, to stop this from spreading, metastasizing, you need to drop the rates. Everybody has a bias in this. And so, there's when I was a county judge executive, which isn't a real judge position in Kentucky, it's just like you're the head of the county, like the mayor of the county. I was always sympathetic to one side to a fault. And then the county attorney came to me and said, there's three sides to every story. He was a family court lawyer. He said, there's her side, his side, and the truth. And so I'm trying to listen to all the sides and get to the truth, understanding that everybody has a vested interest in any of these adjustments.
But can isn't the truth though that
on your congressman?
Yeah, isn't the truth that Jeremy Powell said that he wanted to create and cause damage in the marketplace, and now we have exactly what he wanted? At what point does this one individual, get held accountable for pushing it too far and causing damage, or is it just on the shoulders of those at the bank? This can't be the only bank that took out 10-year treasuries, and they're going to have unrealized losses. There's trillions of dollars of this that is taking place in the banking system.
Yeah, as I said earlier, Grant, there's a total of $620 billion currently on balance sheets, bank balance sheets of unrealized losses just due to the Fed hiking rates aggressively. But Congressman, to add to what you said and the sort of the debate going back and forth the last couple of days on this was, a lot of people calling for these deposits just to be unlimited, insured unlimited above the $250,000. And the argument I made was, number one, the FDIC is not a taxpayer-funded institution. It is funded by the banks. So who's going to come out and fund this unlimited amount of insurance, number one? And the second point, to add to what you said, Congressman, is if we did that, it would create moral hazard, and these banks would be taking on way more risky investments on their balance sheet.
Jay?
Yeah. By the way, real quick.
Sure. 1 second.
I know there's some sympathy for the people who may have had $500,000 or $750,000 in that bank, and people think that they're not covered. But when I sold my company once, and I discovered that you can open multiple accounts. Now, I think the FDIC threshold at the time was $100,000, and so one of my kids and a trust for so and so, and this and a trust for that and that, like. Those people are actually, if they're individuals who have $1 million, they're probably already fully insured because they're smart enough to take out different accounts.
That's fair, unless you're talking about the business itself, right, Representative? I mean,
right.
A business.
Yeah,
have 10 million. How many accounts can you open?
Yeah, obviously, if you got $10 million, you're not covered.
Special, go ahead.
Sure. So, thanks for your time, Congressman, and obviously, you're looking out for your constituents and trying to get educated on the topic. I had a question about one of your colleagues who recently, about 30 minutes ago, Congressman Ro Khanna, is calling for clawbacks of essentially stock sales from SIVB executives. The CEO, Beckett, sold about $3.6 million worth of stock just a few days ago on February 27th. He made it look like a 10b5-1 plan, but actually, if you read the fine print in the Form 4, the 10b5-1 plan was actually started 30 days prior to that, when the issues were probably known. Do you have any views on clawbacks and how this could play out?
Well, I mean, if they did something deceptive or something illegal, I think so. But if they did something unsavory that's legal, I mean, shame on us for not having laws to prevent that. And I mean, I don't think we can make law ad hoc or in reverse if what they did was legal. But I don't have the resolution to know.
So, I would be remiss if I didn't bring up the elephant in the room right now, which is that President Biden, in the midst of all of this, released his new proposal for his budget. Did you have any initial comment on the budget? I mean, the plan is to shore up Medicare, shore up Social Security, but to raise taxes. What are your initial thoughts on it? And how do you think that the current situation of what seems to be financial instability across the country kind of fits into the concept of spending more money and raising taxes?
Well, I haven't looked at the budget directly, but I hope one of my colleagues does what Mick Mulvaney did with Obama's budget when Mick Mulvaney was in the House. He forced a vote on Obama's budget, and no Democrat, there was like one Democrat would vote for Obama's budget. None of them would, except for the one, I think it was Marcy Kaptur. So, let's put Joe Biden's budget on the floor and vote on it. And I think you're going to see Democrats run from it too, although I haven't scrutinized it. One thing that's, and budgets are budgets, they're not binding. Even when the House passes a budget, a 10-year budget, there's really no way you can bind a future Congress or a future presidency. So those are all aspirational and imaginary, except for the first year of the budget. One thing that is timely is we have hit the debt limit. And so the irony that I like to point out is that we're funding pensions for the Ukrainian government employees by liquidating the assets of our own federal pension programs. Like, those are the extraordinary measures that Joe Biden's undertaking. And I think it's kind of crazy that we just sort of, we'll sell off the postal workers pension, and now we'll do the federal employee retirement says we'll sell that off. But that's what we're doing right now, understanding we can probably buy that stuff back.
And just, wanted to bring up Nikki Haley, who is the current presidential candidate. She brought up that it would be not the right move for the Republican Party to not put entitlements on the table. We are, if increasing taxes is not on the table, we have to address the debt issue. What are your thoughts about her comment? Should it be on the table?
I think, let me just talk about politically, because realistically, I don't think you're going to get that done. We're in the majority in one branch of government and half of one branch of government. I don't think we're going to get entitlement reform. So why should we push for them right now? I don't know. There could be some like work requirements for able-bodied adults who aren't, single parents with children. Like, I think in order to get food stamps, there are a few things like that nibble around the edges. But other than the things that everybody agrees on, I don't know that it's worth pushing for it. Now, the discretionary part of the budget is kind of like pocket change compared to the entitlements. But I don't know that we're even going to be able to get major changes in discretionary. Now, if we have the right plan of attack on that, we can, because spending starts in Congress, but that's the yearly appropriations, and those will run out. Unlike mandatory, those will run out if we don't do something by October 1st. So that's where our leverage is. We don't really have much leverage on the mandatory spending.
So now,
Congressman, I would like to
in context. Kim, one last question, and I'll get you.
Yeah.
So kind of putting it all together, I'm going to ask some pretty direct questions, but it'll be helpful for our audience to understand your thought process on it. If the federal, if FDIC does not shore up deposits for every bank account holder at SVB, at Silicon Valley Bank, do you think that Congress should act to shore up deposits to prevent a bank run?
Look, there are assets at that bank that are worth as much as the deposits. The problem is you're not going to get the money back for maybe 10 years. And so those assets belong to the depositors, in my opinion. Now, just assign them their assets. And then if they can't wait 10 years for it, let them go out on the market and get 80% or whatever that asset is worth. I think there's an extreme moral hazard if we get in there and start bailing folks out.
So, Kim, you had a question for
yeah,
Thomas
I just want to congratulate the congressman for coming here and acknowledging that he's using Twitter Spaces to learn about potential. Can you hear me?
Yes, go ahead, Kim.
Yes. So what I wanted to say to the congressman is that it's nice of him to say that he's coming to Twitter Spaces to listen to experts, to educate himself on potential future votes and decisions that he will make in regards to future legislation. We've come quite a far way, I would say, if Twitter Spaces is achieving this level of status. And I advise that you tell your fellow congressmen and women to come here and listen to the people, not destructive.
Yeah, Mario.
And, with that comment, so
just
Congressman,
quickly, I learned the most when you all are in disagreement, because that's how you get to the truth with the sort of adversarial presentation of facts. And so that's why I'm here. That's what it offers, is an interactive place for that to happen, which we don't get in too many forums.
And Congressman, good to have you back on stage, and just more credit to you. You were in a previous space as well. I can't remember what news we were covering, and you came on. I think it was the FTX collapse, and you came on as well. I brought you up, and you're like, Mario, I can answer a few questions, but I want to stay in the audience. And rightly so, you stayed in the audience for a few hours listening to various panelists discuss the collapse of FTX. So credit to you there. I do want to read out breaking news, get your thoughts on it as well, Congressman. So just came out on the Washington Post from 3 anonymous sources. Federal authorities are seriously considering safeguarding all uninsured deposits at Silicon Valley Bank, weighing an extraordinary intervention to prevent what they fear would be a panic in the U.S. financial system, according to 3 people with knowledge in the matter who spoke on the condition of anonymity to describe private deliberations. Would love your thoughts on this piece of news that just came out a few seconds or a few minutes ago, and any comments you have, Thomas.
Well, it sounds like the implication of that is that they would do it at any bank or at every bank, and I'm not sure they can afford to do that at every bank, but I think maybe some of your experts would know if they're able to do that at every bank at once without congressional involvement.
Can I take a crack?
Actually, the actual amount of capital that would be required to do that is not as much as you would think. It would be, it would be at the end, it would be less than, in my opinion, be less than $50 billion, because you would just stop seeing the stem of outflows from depositors.
Yeah, I agree with that. It's the identical thing to Mario Draghi saying whatever it takes, and he did not spend €1, not €1, on bonds on that program in the whatever it takes thing. So I agree with that. But if I could ask you, Congressman, a very tough question, because I understand your philosophy and I love it actually. But aren't we too late? With 330 trillion of global sovereign debt, 180 trillion of corporate consumer debt, and around 220 trillion of unfunded pension liabilities globally. How on earth can we get the system under control?
Well, you'll send me into a existential cul-de-sac if I think about it too hard. So I don't go there. I'm in Congress in case it is salvageable. So I can't think about the alternative where it's not.
Because if it's not, and I don't think it is, because now we're talking real money. So every 100 basis points is, 3 American, almost an American GDP each year just to pay for that. we are going to have to go into a world, unfortunately, where we have to guarantee people's deposits. Otherwise, you have a complete loss of control.
But what do you guarantee it with? And eventually, does the Fed have to create more money to cover those guarantees, and then you create more inflation? I'm not sure. Eventually,
No, I agree with you. I guess the point I'm trying to make is I'm as hard money as they get. That's why I love your politics. And I'm not even American, so I don't even vote in America, but I have the politics globally. I'm just saying that I've given up because the numbers are so astronomical that once you cross the Rubicon, it is you just cannot control it. And so you just have to have a realistic view of the role of fiat money.
Right.
I think that's actually controllable.
Jay, 1 second. Sorry. Matt had a question, and I think he got muted. So, Matt, can you go ahead with your question for the representative? Or comment?
No, it was more of a follow-on comment that really what we're talking about. What's the genesis of this bank run? It's the fact that 97% were uninsured, right? When you look at the rest of the banks, you're talking about a much different ratio. So I was just going to amplify the fact that in the scheme of things that we spent $3 trillion of stimulus and don't have a ton to show for it in many ways, this is relatively nothing to shore up the banking system and then fix the mark-to-market regulations and fix the ratio requirements too of uninsured deposits. But just going to amplify that comment.
Representative Massey, do you agree with that this is a drop in the bucket here?
Well, it's a unique situation. Yeah, it was a bank for venture capitalists, and the FDIC is at $250,000. But if they pay no price for this, what's to keep them? What are we going to do to keep it from happening forward? Are we going to have more government regulations to prevent this, or what's the solution?
I mean, I agree. I guess the question is who pays the price, right? So if the deposit holder who put their money in the bank, and actually if you had a line of credit with this bank, for the liquidity covenants required you to have your payroll with the bank in many cases. So it's a question of, I don't think there's a moral hazard here because the ones that are suffering are the companies and the founders and VCs, by the way. We're overlooking the fact that there's a lot of big funds in America that have a ton of, billions of dollars on deposit with that bank too. So there's a degree of self-interest in this, crisis, admittedly for a lot of people. I don't have money there. But nonetheless, it's who pays the price. And so I do think, I'm not a big government regulation person, but the fact that these banks did not have to mark to market is, problem number one. And problem number two is that the purpose of FDIC insurance is to prevent a run on bank. It doesn't work if a tremendous percentage of your deposits are not insured. So we need to go back to the drawing board, increase probably the level of insurance, but at the same time, have new requirements saying that you can't have your ratio below X. So you can't have a concentration of uninsured funds.
Well, we can't. When we make it to the other side of this, there has to be something different. We can't just keep making the same mistakes over and over.
Congressman, I've got a question here from the audience. I'll read it out. How do you think voters will look at the bailout of Silicon Valley Bank?
Well, I can tell you when, the CARES Act was proposed during COVID, which was a big bailout, it was $2.2 trillion. And I was the only one who said we should have a recorded vote. I forced everybody to come back to Washington, D.C., but I polled that. And if you called the CARES Act a stimulus, it polled at 81% support among Republicans. And if you called it a bailout, it polled at 79% support among Republicans. We can't lose perspective if you're on this, this discussion right now. You're probably really biased. Most of America likes bailouts, unfortunately.
So last year, this last 24 hours, Bloomberg reported that in an effort to prevent contagion, the U.S. government was having a meeting. And that's kind of, again, we heard another version of that this morning, that Mario is breaking news. The U.S. officials are talking about a backstop. So the words that have been used instead of bailout are backstop, but a backstop to prevent contagion in small community banks across the country. Would you be in support of federal funds going towards that, making sure that if there's a bank run contagion that occurs across the country, that we do have a backstop?
Kind of like in this situation, I think it's the weakest banks or the sloppiest banks that would suffer in that. And again, you set up the moral hazard. And I haven't seen the problem yet. I guess let's wait and see.
Yeah, I mean, there's rumors of many different banks that we will not name, but many rumors that have come out talking about multiple banks that are currently have long lines outside. So there's definitely a concern around contagion.
I mean, look, a lot of the community banks are gone. The ones that where there wouldn't have been a run on the bank because you know the person who owns it and they live in your county. So, I mean, again, we've kind of created this problem by, I know that you call them small banks, but they're not small like they used to be. And I think they're actually less robust.
And zooming out just a little bit more, when we talk about who is involved in these and what's going on, you know, right now we have an adversarial position where we are competing with China on innovation. If we don't support these entrepreneurs, like you were, by the way, right? You were one of those entrepreneurs that was helping drive innovation forward. If we don't support them in this moment, would that not put us behind against China, where we are actively competing with them?
Well, it could, depending on what percent, does this mean people won't invest in venture capital after this? Does this mean that there's so much capital taken out of the small businesses that it's going to damage us? I don't think those things are true. But by the way, that same argument can be made for why we shouldn't destroy our patent system. But you've got big tech in Congress trying to absolutely destroy the patent system, which is crucial to American innovation. You've got the FTC trying to basically block every acquisition that ever happens by saying it's anti-competitive. Yet that's how most startups that are successful don't go public. They actually get acquired, but now you have an FTC who's stopping that. So that being anti-intellectual property in the United States or being anti-acquisition, that's also the Chinese love that notion. But I suspect if the VCs take a small haircut because the small companies are going to take the haircut, but the VCs by association, if they all take somewhat of a haircut because they were reckless, that's not going to destroy investment in small companies in this country.
Absolutely. Nick, you're next, and then Matt. Go ahead, Nick.
Congressman, I just wanted to ask you real quick. One of the questions that we're getting a lot in the audience is about the rollbacks, right? When it comes to Dodd-Frank regulations under the Trump administration. This was actually supported a lot by Democrats as well in Congress. Do you think that had any sort of effect on what we're seeing today? Did those rollbacks actually peel back protections that would have actually, possibly stopped this from happening in the first place?
Well, there's two ways you can move the knob, right? You could try to anticipate all the ways the wheels can fall off the bus and then just ban them. Just ban all outcomes that might have any risk associated with it. And I don't think that's the direction. The other direction is people assume responsibility for the risk and turn the knob in that direction. What the problem we have is we're socializing the risk with the Federal Reserve, or if the FDIC has to exceed their capacity to fix this problem, then we're going to end up socializing the risk again. But you can't have situations where you allow a free market, but then go in with these, we'll call them backstops, like you said, that are essentially funded by the taxpayer or responsible people. So it's got to be one or the other. But I wouldn't be for more, over-regulation.
Matt, do you agree?
Thomas, just real quick, the one problem that I have with what you're saying is, for people to take a cut, we're talking about depositors here that have put money in a bank. If that is a risk, then what's safer than a bank to put your money?
And by the way, these are the most sophisticated investors on the planet. Now, I know these are startups that took the sophisticated investors' money, but those sophisticated investors are still on the board. In fact, at my startup, I had some friends who wanted to invest in my company who were not allowed because they weren't rich enough. They didn't meet the standard for qualified investor. So the irony here is that your assumption is that I guess our operating assumption at the FDIC and also FTC is that if you have a bunch of money, you're sophisticated enough probably to figure out the difference between a bad and a good bank, or a bad and a good investment, or that you could weather a bad investment. And that's why we have a threshold at 250,000, which I pointed out earlier, is actually more like 1.5 million when you count all the accounts you could open if you're an individual.
And Matt, do you, as an investor, now I know you've invested in a lot of startups, do you agree with the representative's assertion here?
I agree with some, and I don't agree with some. I'll start with what I don't agree with. I don't think in this case you're actually socializing the risk. I think you're stabilizing the risk and recognizing that this is actually a failure of regulation. You know, to rewind the clock to February 28th, where the chair of the FDIC said out loud, exactly the scenario is a dangerous scenario when you have a bank that has these, you know, long maturities on treasuries as a mismatch. And if there's a run on the bank and they need liquidity, you'd have this situation. That's exactly what we have. So I don't think there's a moral hazard. I don't think we're socializing the risk. We're stabilizing the risk so we can reset these regulations and change that ratio of insurance deposits. The part I want to agree with is I don't think that if the government were not to step in whatever measure, and backstop the deposits, that means innovation is going to die in America. The reality is, among those companies that are the best companies, what's going to happen is there's probably people sitting on this call polishing up their special situations deck, and they would step in and they would be aggressive down rounds or aggressive terms. And so the losers would be the companies that weren't strong enough to survive through that process, the investors who, you know, were in those previous rounds. So I don't think innovation dies. And I think that's a degree of scaremongering that the rest of America would call bullshit on. But that's not the point. Everybody who had money in that bank had a reasonable expectation that the bank would open up on Monday with their money in it. And the average investor, no matter how sophisticated, does not assess that risk. Now, maybe we need a critical reflection upon why all of us investors don't, you know, scrutinize whether there's risk by having your money in a bank, but then what, right? Like, that's not realistic. If we're going to be subject to so much regulation in this country, which we are, that stifles innovation, at the least we can expect is that the regulations are going to protect depositors.
Well, what I suggest to Thomas is that he puts a law into the work that doesn't allow banks to gamble with depositors' money. That is the easiest fix. Why are banks allowed to use money that isn't theirs to invest it in the stock market or in government bonds?
They don't. The Volcker rule doesn't allow that. There's a lot of like misinformation on here.
Exactly. Go ahead, Jay. Why don't you share what they can actually do? Because I think we just want to make sure that people are not, or actually, Jay, we'll have you do that in a second. Jim, you've had your hand up for a while. Go ahead with your question.
Hello, Thomas. How are you doing? Good to see you on Sunday.
Hey, Jim, thanks for inviting me.
Yeah, sure. Hey, have we changed? Let's say that there's some, I mean, you and I both know there's not going to be the kind of fix that we would prefer here, but hopefully there'd be one in a positive direction that would get rid of the moral hazard and get back to what George Gilder likes to talk about, you know, where entrepreneurs can be effective with information. You know, it's not just Pavlovian, this person, give them an incentive to do this. There's a whole lot to that. And the loss of information happens with government. Assuming we can go and retrench to a better direction, do you feel like the changes that we just made in January might allow, at least in the House, for some of those really truly good ideas to push forward?
No, I'm pretty pessimistic about what we're going to be able to get done in the House, controlling just one half of the legislative branch. It's all going to have to happen on the spending bills, and we can defund certain bad things, but I don't think we can get much permanent law done.
So, you know, I want to make sure that we give you a chance to share with us how you think this entire situation is going to play out. And, you know, I know that you're here to learn, but we're also here to learn from you. So, you know, what do you think is by Monday, how is this going to be a Lehman moment where we're going to see long standing issues, or do you suspect we won't even remember this happened 6 months later?
I cannot predict the future, but before Jim came on, your speaker before that, I actually agree with him. Whether we're socializing the risk or stabilizing the risk, it's actually a degree of magnitude. If the FDIC can do this, and I don't tell the FDIC what to do, if they could do this on their own without coming to Congress, then we won't be socializing it. If they don't need the Fed and if they don't need Congress, then we're probably not going to socialize it. So great, it will be stabilizing risk. I think Peter Schiff set up a bank. He didn't take any American deposits because of the rules, but he had an offshore bank. The government shut him down, but it was for people who just wanted to keep their money somewhere, and he didn't invest it in anything. Like, I think I'm sorry.
And that's how it should be. Banks should not have the power to do anything with customer deposits other than holding them.
Well, gold or something.
Thomas,
not gold.
I
Gold
want
won't
to
solve it.
Oh, sorry. Go ahead.
No, go, Jim. Go ahead.
I was just going to say, Thomas, I remember talking to people back in 2008 that I knew in small and regional banks. And right after the financial crisis, here we are bailing out the big banks and the big investment firms. And the FDIC was, you mentioned it just a little bit ago, is shutting down all the small banks. I mean, when you talk about the situation of Peter Schiff, that's the direction we got to go. We do need to spread the risk out into people who can deal with and manage the risks more directly. That's one of the big problems when you have a situation. I'm not against large banks necessarily, but when they get to dominate the whole landscape, you can't mitigate the risk as well, it seems.
By the way, one of my theories is you can't protect stupid, but sometimes you can inform it. So maybe there's just another reporting requirement that comes out of this, that if you put your money in a bank, maybe if all they're doing is buying long-term treasuries, they have to tell you that.
Name redacted. Go ahead.
Yeah, my question for the congressman, the news that we're seeing, it is reported, by the Washington Post, so take it for what it is, but that the federal authorities are considering backstopping all the 100% of the deposits at this bank. Well, the FDIC only has $125 billion on its balance sheet. That would be enough, obviously, to cover this situation. There's probably about $20 billion hole at the end of the day, or maybe a little more. But where's this money going to come from? Is the Fed going to print it? This seems to me that it would need to go to Congress to get an approval to do something extraordinary, because it wouldn't just stop at Silicon Valley Bank. If you're going to make it a precedent to backstop unlimited insurance for deposits, that we have more banks fail, which will likely be the case throughout this recession. Where does it end? And what would you do in Congress? Where would your position be on that?
I don't know what the FDIC balance sheet looks like. I don't know how much they can do. To call it a backstop, I think is a little bit of a euphemism, because let's say there's $100 billion worth of assets in this bank, but they're actually only worth $80 billion, unless you want to wait 10 years. That's telling me that somebody is putting up $20 billion to make everybody whole immediately. The net present value of money. I don't know where that money comes from. Somebody on this call, tell me.
Hey, by the way, Thomas,
Actually, there's a lot of unnecessary fear mongering on this. There are some really basic concepts that the question was not. It was a leading question. Okay, so there are three different things that are brought up that I think have pretty logical answers. Number one, when you have the Fed or the FDIC guaranteeing uninsured deposits across the system, what will happen in a capital market system like this is that the moment they say that they're going to guarantee, the number of bank runs falls dramatically. And so that's number one. You're not going to need that much money to guarantee those deposits. Number two, Of the 600 billion of mark-to-market losses that are being circled around, a large percentage of those are in AOCI, which already flows through the GAAP income statement and is already in the CET1 capital ratios. So only the HTM is relevant. Number 3, of the HTM losses that are recorded, a lot of those are at very, very large, systemically important banks that have other investments on their balance sheets and have very strong, in fact, banks like JP Morgan that have a lot of HTM losses, you can look at their 10K, they're actually seeing higher and higher capital inflows. So their deposits are actually growing. There's no way they're going to have to sell those securities. And number 4, on the fear mongering around our debt situation, you kind of need to put it in perspective and look at debt versus GDP. And if you look at history and you look at debt versus GDP back after, the Great Depression, debt to GDP went to over 100%. And it fell down to 20%. And then during, the savings and loan crisis in the 80s, it went over 50% again. Then it came out down under 20. And during the great financial crisis of 2008, it was at 80%. And because of COVID, it went to 128. But, just throwing out like hundreds of billions of dollars this or that, you need to look at it relative to GDP. We are much better off than Japan. We are much better off than Europe. We're much better off than the UK. And you really need to put things in perspective. Gold isn't going to solve the problem. Crypto is not going to solve the problem. This problem is actually very containable. And the more and more we create fear, the more and more we're just hurting ourselves. Like, this is a very controllable problem. It's just figuring out the actual mechanism. And there's several ways to address it.
By the way, just to throw something in real quick, and Thomas, I texted you this. I just found from the FDIC, they're backstopping $9.9 trillion in deposits with $125 billion in cash, or at least as I understand it on there, it's cash. So, no one's talking about, I don't think, obviously the whole 200 billion doesn't necessarily need to be backstopped here. But it seems to me it's an insurance, like I didn't just work for Thomas, I worked for a guy on the farm on the ag committee, and crop insurance is the same thing. These federal government insurance programs are not an efficient way to do it. But Thomas, why wouldn't we want to just tell the FDIC take the hit and then go reactualize everything and handle it the right way?
Well, one thing is, I don't tell the FDIC what to do. Like, I stay in my lane, and I certainly don't mean to cause fear. I'm only interested in this problem in case it comes to Congress. And if I don't need to worry about this, then I'll go worry about other bigger problems we have.
Absolutely. Kim?
So, yeah, I just want to correct what a special situation said. And, he's using the word misinformation, and I would put him in that category, saying there's nothing to worry about here, nothing to see here.
No, it's not that there's nothing to worry about. You're taking it way out of proportion. Kim, I've read your tweets. It's complete nonsense, by the way.
Hello. Thank you. All right, sorry, mute everybody. I'm unmute everybody. Kim, go ahead. Special, you can go after.
And we can focus, guys, actually, Kim and Special, we can focus questions for the congressman, because I know he doesn't have too long to give us, and then we'll go to Wahid. Kim, the mic is yours.
Kim,
it's muted on your end.
You got to unmute.
Yeah, sorry, someone muted me.
Oh, good.
Okay, so what special situation said here is the misinformation. You cannot look at the financial health of the United States right now and say there's nothing to see here, don't worry about it. It's significantly problematic, because US treasuries are being dumped by nations around the world. It's toxic.
By the way, that's wrong. Russia's the only country in the world that has actually dumped U.S. treasuries. Europeans are buying them. European insurance companies are buying them. Foreigners are buying them. Japan has an FX-adjusted issue, but they will continue to buy them next year, as per a number of large Japanese banks. And China still has a very large percentage of their total banking system invested in deposits in U.S. treasuries, because without that, their peg, which is, by the way, on developed market currencies, would be completely useless.
So, I want to get back to asking questions. Kim, I appreciate you. You guys can have a conversation offline about this. I think, we're lucky enough to have
I have to correct one thing here. right?
All right,
Because you can't just have someone be in a large room like this with 15,000 people and just spread lies. I've pinned a tweet on top about the world dumping US treasuries. These are real statistics, real numbers that anyone can verify. In the last 12 months, foreign countries have dropped holdings of US treasuries by over 10%. China alone by 16%. US treasuries are now considered a toxic asset. So don't let this guy come in
That's
here.
complete garbage. You have no idea what you're talking about.
All right, guys, so what we're going to do, guys, we're going to go back to you afterwards to continue this discussion. Nick, I know you've been waiting for a while to ask a question. Ray, we'll give you the mic to respond. And it's a discussion worth having. I think it's a very important discussion. But I do want to go to Nick and a few others waiting to ask Congressman a question, because I know he doesn't have too long. Nick, mic is yours.
Yep, Congressman, so I came in about 6 minutes late here, so I apologize for this if you've already been asked the question. And it is one of the most important questions, especially that we're getting in the audience and have within the past few minutes as well. The U.S. government comes in and does a bailout, let's just say theoretically. Is that something that, I mean, does that set a precedent? Does that make everything worse, make banks less risk averse? And we see this happening a lot more often to the point where we just end up crashing the economy?
I think we covered that some already. Obviously, it creates a moral hazard. There's some dispute over whether Congress is going to have to get involved or the Fed is going to have to get involved. I think if either of us get involved, then you are socializing the risk. But if the FDIC can handle this, as special situations suggest, then maybe there's no hazard. I will tell you this. 750,000 people in Kentucky that I represent don't really care about a bank in California. None of them have their money there. What they do care about is inflation. And not to sidestep your question, but if I could ask special situations a question, it would be, does he have concerns about inflation? And if any of the ways out of this are going to create more inflation, whether that is by printing more money to cover the problem or to lower interest rates? Does he think we need to lower interest rates? If he could answer
that's for you.
Thank you for that question. I do think that inflation coming back it could be an issue, and could be an issue, especially going into the winter with European distillate and gas reserves being as low as they are. We could have an energy spike by the end of the year. But for people to understand the situation that we're in today, we're actually at a period where we're entering goods deflation. What does that mean? It means that inflation is a basket of goods and the prices of those goods year over year. In a number of different categories, we're actually seeing negative inflation or deflation. Number two, in the real estate market, where you have $21 trillion of commercial real estate, and everyone's acutely focused on residential as well, real estate prices are already falling in places like San Francisco, where they're down 12 to 13% since the peak of May of 2022. Outside of the Sun Belt, real estate prices are falling all across the U.S., which is a big component of OER. The rents are also falling. Because OER, which is 30% of CPI and 16% of PCE, is actually a lagging indicator because everyone's lease doesn't come up at the same time, you will see the effects, and Powell has acknowledged this in his last three speeches. You will actually see CPI and PCE fall over time because the rent and real estate data that's coming in is lagging. Rents are already falling in certain parts of the U.S., but you won't see it in CPI or PCE until several months from now. Number three, the only issue, 100%. And then number three, the only main inflationary issue we have right now outside of a potential energy crisis at the end of the winter is wages, right? And wages are a self-fulfilling prophecy. I think wages will continue to be an issue because inflation was so high last year, people's wages haven't caught up. If you read earnings calls of the S&P 500 companies, look at Lowe's, for example, and just pull it up. I'm just using public data. They're investing $1.1 billion in increasing wages across their workers. So the wages are going to continue to go up at the lowest end of the U.S. economic spectrum. But believe it or not, that's a good thing. And I think it will continue for this year. And by next year, wage growth is actually going to slow down as well. I don't think the Fed needs to cut rates, but I do think that if we have more bank runs, they're going to be forced to pause because for the Fed, believe it or not, the banking system strength is more important than inflation. And in reality, we talked about that.
So let me mischaracterize what you just said. You're saying inflation is not enough of a concern, that when the Feds cause a little bit of inflation to avoid this problem at other banks, it'll be ameliorated by all those other factors. Like,
I'm saying that the market is forward looking. And if you look at the bond market on Friday, the bond market leads the Fed. Everyone's looking at the Fed. What I'm telling you is that there are thousands of bond traders like me in my prior life that actually, they try to anticipate what the Fed is going to do. And on Friday, what the bond market was telling you was you saw over 2 days, Thursday and Friday, a 40 basis point decrease in the yields of the 2 and 5 year Treasury, which is actually telling you that the market sees bank failures as extremely deflationary. The most deflationary thing you can do on a planet outside of nuking a major city is having a bank collapse. So it's disinflationary.
Let me ask you one other question real quick. So when we do resolve this debt limit increase debate in Congress, right now we're selling assets of pensions and whatnot. We're going to have to go out in the market, right? We're going to have to take on a lot of debt. Because we're actually accumulating liabilities right now and covering them in other ways called extraordinary measures. So the day that we raise the debt limit, we're going to need, I would guess, over or around $1 trillion, rough numbers. Is there appetite for all of that when we go to that market for it?
I think that we need to actually cut spending. I don't want to be political, but I don't agree with Biden's plan. I didn't agree with the infrastructure bill that came out after trillions of fiscal expenditure. For every 1% interest rates go up, we are going to see $400 billion of additional interest spend, which is about 6% of our budget. And by the way, that's why defense companies, Medicare Advantage healthcare companies like United have been underperforming, because the market expects actual budget cuts over the next couple of years.
Really quick,
but,
I'm trying to learn. Let me get to.
But to answer your question,
hold on, Jay. Yeah, go ahead.
Hold on, Thomas. Go ahead.
Let me get to exactly what I meant to ask, which is. And by the way, we're not going to cut spending by this summer. That's not going to happen. My question is, do you think we're going to monetize the debt or borrow the money come June when we need another trillion?
I think we're going to borrow money. I think we're going to borrow money after the debt ceiling thing is resolved. In the meantime, Yellen will do whatever she needs to do. But I think that we are not going to default on the debt.
I know we're not going to default. The question is, what my point I'm getting to is, if we don't borrow it, we're going to monetize it, and there you have more inflationary pressure.
Jay, what he's trying to say
we're going to borrow. Hold on. I understand what he's saying. We are likely just going to borrow more. There is a strong appetite for treasuries at 5%. I know people, with $200-300 million PA accounts who are subscribers, who are former hedge fund managers. Their entire portfolios are going to ramp up into treasuries. So, when Kim.com was saying, foreign holders of treasuries have fallen, yes, I can name 13 or 14 countries that have decreased their holdings of treasuries. But then on the flip side, I can tell you that European insurers have been buying, if China's been dumping 16% of their treasuries, European insurers have been buying them. European citizens across various countries in the EU have been buying them, and U.S. citizens have been buying treasuries hand over fist. That's why deposits are leaving the banking system. They're at 5%. You're getting a risk-free asset. It is the best of the worst in terms of government bonds globally. That's the truth. If someone can pay you 5% risk-free, everybody in the planet, who has their money invested in risky securities, junk bonds, stocks, etc., can take a very large percentage of that portfolio and put it in U.S. treasuries. It is an absolute no-brainer. So when it comes to supply and demand, just the fact that rates are so high means that all private investors, including pensions, endowments, sovereign wealth funds, insurers, are moving money into treasuries. And that's a separate argument than just focusing on the government data. There's only one country that's 100% sold out of treasuries, and that's Russia.
So Thomas, what's going to be the effect of that if we're actually selling that with the kind of...
Thanks, Jim. That was the thing that was running right through my mind. Yeah, everybody is better off at 5% treasuries, except for the taxpayer who's we're going to have to pay the interest. Now, I know those mature at different dates, but if we
Yes,
stay
only
at
33% is maturing over the next 2 years and 50% over the next 3 years. So as long as the Fed cuts rates.
So go ahead, Thomas.
Oh, no. So that's fine. I'm just saying, I know it's not all maturing at once. I'm just saying 5%. Okay, that allows us to sell our debt, but then that just creates a longer term problem for us. But I'll take one more question, then I've got to jump off.
It also creates a recession. We forgot about that.
So
And a recession is inherently deflationary, right? Which solves the problem. A recession solves the problem. So this is all circular. We're all like, this is, again, I'm saying it again and again, it's fear mongering. If you believe we're going to enter a recession because of these issues, the recession solves inflation.
I think, Kim, before you respond there, Kim, just want to ask you a final question. Thomas, I ask this to every special guest that we have. I didn't ask you this last time you came a few months ago. What are your thoughts on Twitter Spaces in general as a feature? You know, you just saw the experience, and Danish was messaging me in the background saying, "Mari, this is incredible. Won't forget this moment," in which you get the chance to speak to other experts in the space and people from the community. Would love your thoughts on this feature. I think Elon would appreciate some feedback.
Well, first of all, I spend way too much time on Twitter. I find it generally a good source of information as long as you consider all the adversarial viewpoints. It's also a good place for me to formulate my thoughts. But as far as the spaces go, if they're properly moderated, it's a high risk place for me. You're not going to find many congressmen here because they don't want to take questions from people they don't know on topics they're not prepared on. But I came here to learn, and it's really useful for that. And it's the best place for that. Having a town hall with 15,000 people can be amazing if it's properly moderated. So, and I think you're doing a great job.
Yeah, we've had, you were actually, I don't think you know that. We've had a few congressmen here, but you were the first. And I think Jim invited you. You came in during the FTX collapse. So it's, during the Twitter files, I think it was. So again, pleasure to have you, Congressman. You're welcome to join us again anytime. And we appreciate you coming in. Jim, thanks a lot for inviting Congressman Massey.
Thank you all.
See you, Thomas. Danish, maybe you can kick it off, just a bit of an overview. We do have more guests coming in, so I'll announce them shortly. We've had, yesterday we've had hundreds of thousands of people listening to the space. There's only 12, not only, there's 16,000 live now, but with the replays and everything, every space is getting about 500,000 listeners and counting because the replays are still ongoing. We've done spaces for 30 hours in the last 3 days, and we've reached close to 1 million people so far just on our spaces without everyone sharing them. So just for the audience to get an idea of the reach this is having and the impact it's having. And we've had, for example, when Bill Ackman was here, the press was just reaching out to us to just get a piece of it, to get the recording, the section in which he speaks. So Danish, maybe give us some thoughts on the discussion so far, your thoughts on everything that was said. And I know a few other speakers have an opinion and a few things to share.
What is absolutely fascinating is that in the middle of discussions around the new Biden proposal, the House is currently formulating their version of the new budget. We have a bank collapse, and Thomas Massey is up here talking to us and learning. He came here, again, many people may not know, I actually don't completely agree with his politics on some very specific items. But the fact that he came up here with the express intention to learn, and even though our goal was to ask him as many questions as possible to understand where his mind space was, where the mind space of Washington and especially the Republican Party was in the midst of this collapse, he said, no, Jay, tell me about this. Jay, tell me about that. And that moment, I think will, at least for the people that do this regularly, will be one of the moments that we're going to look back and say, holy cow, this is an opportunity for true citizen journalism. I mean, this is what it's all about. And I found that, Jim, thank you so much for having him here. It was actually, I gained an incredible amount of respect for him.
I got to tell you, so many people like him as a member of Congress because he is so authentic, to be candid. And he's really smart too. That's the other thing. He doesn't flout his intellectual capabilities, but I've interacted with him on public and very private levels, one-on-one, and the guy is just brilliant because he's incisive because of the fact that he's asking questions and trying to figure out what's really going on. And he's got an opinion, he's got thoughts on certain things, he's come to some conclusions, but he doesn't hold on to them so firmly that he can't hear what's going on and double check and make sure. And he's got an engineer's brain, by the way, too. He thinks like an engineer. He does. He goes from that perspective of, does it work? And does it work in his mind means, is it constitutional, number one, when it comes to Congress? But then when that's not at issue, then he looks at all the other stuff in that same way. And it's very useful, and I think has made a big impact on Congress. He's on the Rules Committee now. Like, that's like the biggest place to be.
I'm just going to quickly jump in, just some updates here. There's no breaking news. Let me check the group, actually. Hold on, let me see if there's any breaking news. I do know that crypto's really picked up heavily since the announcement. BTC's up 5% after the news of the Fed backstop. So I just want to share that. And of course, for anyone that's been keeping up with the details of the story, Harry and Meghan stand to lose millions of collapse of Silicon Valley Bank. Sources tell ISN the couple set up accounts following the advice of friends in Silicon Valley. Quote, this is a major blow. They had all of Harry's money there. All of Harry's money there. I'm sure they diversified.
God bless the couple, but we have bigger issues to talk about.
And I do want to say, Bank of London, this is what your guru sent me this, Bank of London officially submits bid for Silicon Valley Bank UK. So that we were talking about it yesterday. Now there's a bid officially, there's an official bid from the Bank of London.
So I'm British, and I've never heard of the Bank of London. Who wants to admit they'd never heard of the Bank of London before this week?
They've only existed for 2 to 3 years. But
they make it sound so official, like it's the Bank of England or something. But who the hell are the Bank of London?
Yeah.
That's exactly what I thought.
I'm just going through the sentiment seems to be shifting within the market. I think as the news we saw so far, Wahid, would you say it's getting, would you say it's enough to, if it seems that they're heading in the right direction in such a short time period? Jay was saying that they don't have much time to act in that limited period of time, and they're just learning about everything as we're doing on a weekend. So would love your thoughts on the progress so far.
Yeah, sorry, I'm in a plane. I'll be quick before the noise hits. Look, it's exactly what Bill Ackman prescribed yesterday and others. It is the fastest way. It is very akin to Mario Draghi saying whatever it takes. When he did that, he did not have to use any purchasing to back that statement. And when the Fed backstopped the money market mutual funds, they also did not have to use much arsenal there. In fact, in 2020, around COVID, they said they were going to have an unlimited capacity to buy corporate bonds. They also did not have to spend much money. So these statements are very powerful. They don't consume a lot of capital. If the Fed backstops the FDIC with a swap facility, that helps. They're not going to need to do that, I think. So yes, this is the fastest way to shore up confidence.
I want to go to Jay, just get his thoughts on the discussion we've had so far and the announcements we've seen today, because you did call a lot of what was said fear-mongering, which I'm sure Kim would disagree with, and he's got a few things to say.
Yeah,
so
I want to correct
that, by the way.
I do want to correct some of it. So the factual
so Jay,
data,
I'll let you respond, then we'll go to Kim, because I know he's been waiting patiently for a while. Go ahead, Jay.
Absolutely. So, from a factual perspective, I'd like to reiterate that, number one, the only country that is fully sold out of U.S. treasuries has been Russia. That there is a list I'll publish in a second, country by country, through December of 22, the investments in treasuries that have fallen in the sovereign accounts. But my focus is on the pensions, insurers, endowments, and large European insurers. There has been an equal amount of buying of U.S. treasuries by private investors, including, for the first time in many years, U.S. investors. And I think that is a part of the story that is not being discussed. I'm very confident that even if we were to raise the debt limit and borrow an extra $1 trillion, that there would be more than adequate demand for that. And you could actually see that on Friday with all the fear. With, the only time I've seen a 40 basis point decline in a US government bond yield in history has been right before a recession. And that just shows how much demand there actually was for US Treasuries on Friday. And if you believe a lot of what people are saying, why didn't the opposite happen? If people were losing faith in the US government, why didn't US Treasuries sell off on Friday? So this is a question I had to pose for the audience. The second question I had to pose for the audience is that, okay, so let's say US Treasuries are bad. I'm just going to use, a 5-year-old language to describe the situation. Say, what if US Treasuries are bad? What are you going to buy instead of US Treasuries? Are you going to buy Chinese bonds with a $3 trillion real estate problem and off-balance sheet shadow banking of 350% debt to GDP? Or are you going to buy Japanese bonds where the government owns 60% of the 10-year and it's a complete Ponzi scheme and you have terrible demographics? Or are you going to buy bonds at the ECB where you don't even know which countries are going to be around in the ECB over the next 10 or 20 years? And the UK's Brexit is very, and their banking system, on top of kind of what happened recently with Brexit, is half as strong as the US. You look at the tier 1 capital ratios for Deutsche Bank, CS, they're zombie banks that are backed by the government. They're nowhere near. If JP Morgan didn't want to deal with all of their missed marks, right? JP Morgan could buy like half the European banks. So I think that if you're going to buy European bonds, good luck. If you're going to buy UK bonds after the gilt crisis we saw in October, good luck. You're going to buy Chinese bonds, well, good luck, all power to you. You can't even pull your money out. There are big investors out there that are talking about the fact that with capital controls, you can't even pull your money out of China. Are you going to buy Japanese bonds? Probably not. So all I'm trying to say is the way the capital markets work is, the US is the best of the worst. And crypto is not the solution. If you look at I have more friends that have lost money because of their accounts being stolen and because of attacks on their digital persona. The number of people I know that have actually made money in crypto who have been involved since 2020. I'm not talking about the people like me that were dabbling in Bitcoin in 2013 and 14, but the people who have actually made money in crypto are very, very few. And it's gone from almost a $3 trillion industry to an $800 billion industry in a few months, whereas the stock market is 40 trillion and the bond market is well over 100 trillion just in the developed markets. So, want to put all this in perspective, and the fact that most people who don't understand, how does a discounted cash flow work? How do you value a company? The U.S. has a senior priority right on the net present value of free cash flows from the best companies on the planet. And it has a net present value of the free cash flows coming from on top of your paycheck, if you're a W-2 employee, or from your 1099, of the wealthiest people in the world. The net present value of that asset dwarfs the 130% debt to GDP and the 25 trillion net of what's on the Fed's balance sheet, outstanding debt we have. And I would argue even the off-balance sheet liabilities, including Social Security, the value of our economy and the net present value of taxes from corporations and individuals is far larger than the amount of debt we have. So I do think it's fear mongering. I do think it's fear mongering. And then on the banks, last point, I think that the government is making progress. Like I said, this all happened on Thursday. And for anyone to think that the government would have a solution in 24 hours is completely on the ganja. Is 100% high right now, because there's no way anyone on the planet, there's no way anybody could have solved it.
To play devil's advocate,
can I respond now?
Yeah, Kim, go ahead.
I have been listening. Go ahead, Kim.
I've been listening patiently, and Jay, I would like to have the same respect from you, even if you don't agree with what I'm saying now.
Absolutely. Go ahead. You're right.
So you misrepresented the data. By the way, nice sales pitch for U.S. Treasuries. The reality is, and I've pinned this tweet on top, based on the U.S. Treasury tick data, foreign holdings in U.S. Treasuries have declined and are continuing to decline. Year over year, foreign holdings dropped by 11%. So there's no demand
There's only sales of U.S. Treasuries. Other countries want out of them for numerous reasons. One reason is, the U.S. dollar is now significantly challenged with this new petrodollar situation that is arising with Saudi Arabia and the BRICS countries now trading in other currencies. That decreases the future value for U.S. Treasuries or the security in them. The other challenge is, of course, to the U.S. dollar as a reserve currency through BRICS, where China, India, several countries have come together to say we are going to create a new reserve currency. We no longer want to rely on the US dollar for trade. And all of these things are having an effect. And in addition to that, the endless money printing by the US government has collapsed the trust in the US dollar, because the inflation that we're seeing around the world, not just in the United States, is the US exporting its inflation to other countries by printing more money on the backs of other nations. So for you to sit here and say this is misinformation and you trying to sell us the value of US Treasuries compared to other assets that nations could invest in, seems ridiculous to me, because I've been showing the real data and you're just ignoring that.
It's not the full data. You're not showing the full data. You're not showing private institutions.
I'm
not finished yet.
One second, let him finish.
Thank you. In addition to that, you say in your own profile that you've managed $2 billion at Goldman.
2.3 billion.
Yeah, fantastic. So you have a vested interest and a bias to keep U.S. markets going, and everything that you.
I do have a bias. Yes.
So I'm happy that you let me point this out, and I think it's important for people to know so that they can judge the points that you're making here. You're really just trying to keep your own business going, and you're not really interested in the facts, it seems, because I've posted the data.
Well, the U.S. You haven't posted the data. The U.S. dollar, as compared to foreign currencies, the U.S. trade-weighted dollar, and I'll post this in a second, is near all-time highs. If you are right, the U.S. dollar would actually be trading at very, very low levels. And the fact that you're pointing out data from U.S. central banks that Japan was suffering from, look at the Japanese currency. They had to sell reserves to buy back their own currency. You're misconstruing the fact that the Japanese central bank and the Chinese central banks are under a lot of stress. They had to raise cash for their own economies. And at the same time, private institutions like European insurers and Japanese banks are actually positioned to buy hundreds of billions of dollars of treasuries, outside of the fact that they weren't able to do so very rapidly last year because there's so much currency volatility and the currency hedges were too expensive. If you read the earnings transcripts from the Japanese banks, they'll tell you that the only reason there wasn't a bigger bid for U.S. treasuries by the Japanese banks, it was because of FX volatility, and they plan to restart buying treasuries in 2023. You're just showing high-level data without any explanation behind it. And if you look at the currency, the strength of the currency, no, it does not. It's only a small portion of the data.
No, it's not a small portion of the data.
It is.
Full foreign holdings, all foreign holdings.
It's foreign central bank holdings.
One second, guys. No, it's all foreign holdings, and they have dropped by 11%. So please stop lying. This is unacceptable.
So, I just wanted to kind of go back to this notion that the U.S. government and our treasuries, just the strength of the banking system. Because Jay, while I agree with you and again, I'm showing my hand, I do agree that the strength of the the dollar has never been better. And so therefore
it's never been better. And talking about like India, for example, my parents are from India. You can't even collect taxes in India. Like you're talking about like India and China and Russia and Iran replacing the US dollar. Even if it were to happen, it'd be 20 years away.
Well, they'd have to change the way that they even go. I mean,
they have to change the way they do business.
Exactly.
But the numbers you're talking about listen, the U.S. dollar is at all-time highs.
The petrodollar. Would you agree that this is already happening now in the petrodollar, with Saudi Arabia agreed with other countries to trade oil and other currencies than the U.S. dollar? How can you say this is 20 years away?
I think that is true, but it represents less than 3% of transactions globally when it comes to foreign transactions. Maybe in 20 years, we can restart the conversation. But you're talking about Saudi Arabia, Iran, Russia, which doesn't have an economy anymore, China, and India, which is still a U.S. ally, which still does a lot of transactions with the U.S. in dollars.
50% of the global oil reserves, my friend, and 3% is just the beginning.
I'm talking about actual transactions. I don't care about the reserves.
So kind of thinking about where we are today.
Hold on, guys. Slimey, before you ask your question, Slimey.
And by the way, how much oil are we going to be using? How much oil?
Just Jay, guys. Anyone that's requesting to speak, please do DM me. The space were such large numbers as yesterday, so it does glitch. We cannot see speaker requests because I know there's a lot of great panelists that want to come up. Go ahead, Simon.
Yeah, just a quick question, just on what Special said. Special, are you saying that when you said 3%, I assume you're specifically talking about Saudi Arabia and Iran, but you're not also including China, Russia, and India, and all these countries? All of them together can't be 3% of the transactions.
The U.S. does more trade in U.S. dollars.
What's the percentage?
Okay, when you think about all of the money flowing out of the U.S. to India and all the outsourcing that's happening, the U.S. has made India more wealthy than any country in the world. Okay, so to say that India is all of a sudden no longer using U.S. dollars in its trade is just completely farcical. And I understand that. I will say that you are right, absolutely right, that because of what's happened with Russia and China, that they are starting to create this petrodollar, and they are creating a basket so that if there are any geopolitical issues with the U.S. in the future, that they will have some way to trade. But I'll reaffirm that it's a very small percentage of global trade that is done using this alternative currency.
And also, Kim,
at the very beginning of it, it's just happening. It's just starting, and he's talking about a small percentage.
But Kim,
it's been happening for years.
Just real quick. What you have to look at is the longer term implications of that and what it means for trade around the world. All these countries that are now already starting to disconnect from the dollar are only going to amplify that and do that more because they don't want to be dealing in a currency where the US government says, hey, we're just going to hold your funds now and not give them to you, or we're going to put sanctions on you and seize your assets. They have done that for too long.
So what is China doing? I can't even pull $100,000 out of the Chinese stock market today and transfer it outside of China. What are you talking about? You can't pull any money out of China, regardless if you're their friend or not.
Well, you can buy whatever stocks you want at the Shanghai Stock Exchange.
Yeah, but you need to keep it in China. You buy the stocks in China and you keep it in China.
I have a trading account. I can buy stocks in China right now and sell them.
You can buy them in China.
So
but if you are, that's not right. Are you buying A shares? Are you living in China and you're buying A shares? And you can take your money physically out of China?
I can buy stocks right now at the Shanghai Stock Exchange and sell them again tomorrow and have the
yeah, you can sell them. But if you have a Chinese brokerage account, you can't pull them out of China.
So what are you talking about? You're saying things that are just completely ridiculous.
All right, guys. I want to talk about the long term because I feel like we're getting stuck at a specific point. So, Kim, as we talk about the long term, how does all of this change as the cost of energy goes to zero? I mean, we know that, let's say it's 20 years. If we are just at the beginning, Kim, how does it change the dynamic as the cost of energy goes to zero? Kim, I muted you. Sorry.
Yeah, I'm back now. So when you talk about the cost of energy going to zero, please explain that to me.
I mean, over the long-term horizon, sure. I mean, there's going to be a transition, but over the long-term horizon, the advantage that some of these natural resource heavy, you were mentioning about reserves, you were mentioning about other resources. Those resources, by their very definition, are going to become, since renewable energies are coming and we are at the beginning of that, over the next 20 to 30 years, I'm sure you agree that the cost, the value of those are going to go to zero. As that happens, how does that change the dynamic in your opinion?
Yeah, first of all, I don't agree that over the next 20 years that is going to drop to zero. You just need to look at the emerging countries, right? They are not part of this Green New Deal. They want to use cheap energy, coal, oil, and they will continue to do that to keep their competitive advantage that they will have against the US and other countries by doing so. And now that Russia is selling all their natural resources at a discount to Asia, whereas before the Europeans had a 40% discount on Russian gas, all of that discount is now going to Asia, so they are going to be even more competitive. It's illusionary to think that those countries are going to move to green energy in the next 20 years.
I want to quickly move off topic just to mention some breaking news that we have as we had Congressman on stage. So Jefferies CEO Rich Handler said the following. So the best solution will be a merger occurring, but more is needed. It appears realistic that any impairment of the deposits should be fairly modest. SVB's fallout said this event in and of itself should not cause a systematic risk, which I know a lot of people would disagree with this. He's working actively to find practical solutions to get depositors advances on receivables. Silvergate Bank has heightened vulnerabilities and could witness another handful of these in the next hours or days. So we could see more banks take a hit. And there's another one. What was that one called, Danish? That had a bit of a run yesterday.
First Republic.
Yeah, exactly. First Republic.
First Republic, PacWest.
Best way to restore order is for the SS Bank Regulatory Consortium to confirm before tomorrow morning liquidity strength of various banks. It's a letter by the CEO of Jefferies.
Hey, Matt, question for you on this. Do you think that I know that, you've written a book about crisis management. Do you think that in this moment, over the course of this weekend, is the U.S. government handling this crisis correctly?
Well, when I saw Janet Yellen's, comments, having been in government, you think about what she's really saying. They're sort of doing what they need to do. Politically, they're drawing a distinction between the idea of bailing out the bank, the institution, bailing out the investors, which no one has an appetite for, and then differentiating, but we need to safeguard the deposit holders. And I think that was the right language. So that telegraphed, what they're going to do. I now would be shocked if they don't have a full backstop, which is very different than when we were talking on this spaces yesterday. But here's my concern. So if they treat SVP as an isolated crisis because of moral hazard, and I think it's a bridge too far to now safeguard other deposits, does that really stem the tide that's already in motion? I'm getting emails from different portfolio companies, doing the right thing, communicating with their investors, saying, hey, we have no exposure. But in those emails, they're saying, we're going to be moving our money out of X bank into one of the big ones. Chase seems to be the beneficiary. So plans have already been laid in a lot of different places. Now, maybe it's not enough to create cascading, effects, but I actually think it's already in motion. So the question is, will even what we would have said yesterday was a full measure, which was to backstop all the deposits, is that actually going to be enough to stop the contagion? I'm not entirely sure.
So as an investor, is the sentiment on the banks, has it actually changed, or is there still time to intervene? Like, what could they do to prevent your startups from moving their money now?
That's a great question. Well, it really depends on how it's received. A lot of the people on this call will dictate that, right? The government steps in, they backstop SVP. That telegraphs to everybody here, well, they would do the same with another of these banks until we, right size those ratios, mark to market, everything we've been talking about on this call. So honestly, it depends upon reception, assertiveness, belief that they're going to do what it takes to stop this crisis. This is not just, isolated incident. They're going to work hard to shore up the health of all these, regional banks. I think it depends on the assertiveness of that announcement, and also if they actually do what we're speculating they're going to do. I think it honestly could be enough if depending on how everyone reacts to it.
And there's an emergency meeting tonight, actually. I know they have a scheduled meeting tomorrow, but they do have an emergency meeting tonight to discuss this situation. Naeem, did you have anything?
Can I make one more point too?
Yes, go ahead.
You look at the other banks, I'm not going to, again, and I've insisted on not naming names throughout this process, but if you look at some of the other banks, the ratio of insured versus uninsured is vastly different than it was at SVP, right? So let's just use an arbitrary number. Let's say 30% of the deposit holders, were below 250. That means that bank CEO can do island to island triage
and speak to various large holders and say, hey, stay with me, we're fine. So I think a combination of the Fed, FDIC telegraphing that they're going to do what it's necessary to step in should there be a crisis, and banks doing hand-to-hand combat with large holders, could be enough to prevent, that run.
Name?
Yeah, so I did do a little bit of research, and there actually is precedent set. It did happen in the past where the FDIC did give unlimited insurance for certain transactions. So this happened, it started December 31st, 2010, and it ran for 2 years through the end of 2012. So I'm just going to read the text. It's really short. So basically from December 2010 to December 2012, certain transaction accounts that pay no interest were entitled to unlimited deposit insurance coverage. Here's what's important. This special temporary protection was created by Congress to help maintain confidence in the financial system for depositors who had large balances in non-interest-bearing checking accounts, typically for businesses, but any depositor qualified. So that this has happened before, but it looks like when it did happen, it required an act of Congress to enable this. So I'm not sure. It looks like obviously it was temporary, a 2-year period, but I don't know if they would have to go to Congress again to get this sort of authorization to extend unlimited insurance if they were to do it again.
Across one bank or across multiple? Sorry,
this was FDIC insurance across the entire banking system. That
wow.
They, I can. I'll DM you the press
that'd be
release.
great. Thank
We
you.
should definitely we should collectively put that out because that's pretty remarkable. Also remarkable. We've been talking for like 40 hours.
I'll just tweet it out. Yeah, I'll tweet it out.
Yeah. No, I think that the concept. So it all feels so unprecedented, right? Like we were talking about this yesterday. We've never seen interest rates go up like this. We've never seen quantitative tightening move like this. We've never seen regulations change like this. But banks have broken before. Banks will break in the future. If we set up a new precedent, then we do have this concern around moral hazard. That Matt, we have to be honest about the fact that if we do this today, what stops the same thing happening again? This is the question that I keep getting, by the way, in my DMs on the back. I think all of us have been getting this, which is if we don't do this, if we end up doing this now, what is the rationale for those bankers not to do it in the future? And if the only answer to that is, well, we're going to change regulations, well, are we really ready to over-regulate or increase regulations on banking? I mean, it's a very difficult situation, and that's why I was asking: is the government doing the right thing right now? Are we actually in a position right now where everybody feels more certainty? And if you're feeling uncertain, in my opinion, and I'd love to hear from others, I think the government's not doing enough because we haven't heard from the president, which I'm surprised by. We haven't heard.
You think Biden understands the situation? You think Biden is smart enough to understand the situation that unfolded in 24 hours? He probably needs 48 hours of counseling just to understand what Basel III is, right? Like,
I don't know.
I don't think that's a fair characterization.
I was going to say, actually, it could cut both ways, right? If the president addresses this situation, does that feed a degree of contagion?
It could feed if he speaks incorrectly, and then when he gets questioned by the audience, he has no idea how to answer those questions. I mean, and when it comes to regulation, we have Dodd-Frank, the Volcker Rule, and Basel III. Regulation is not necessarily what caused this, and the Fed is not necessarily what caused this.
I could very much disagree with this, and we can talk through what happened in 2018 and how we rolled back Dodd-Frank, specifically when it applied to banks exactly like SVB. It was a mistake. In hindsight, clearly it was a mistake. We were not stress testing these banks, and that's partially why we're here. And I don't want to make this as much into a partisan issue. I agree with you that it might be a government issue. The government just does not react quickly. Matt, you were saying something.
I've just got a video to play. It's from
go ahead,
from Yellen, the Treasury Secretary. So I'll just play it.
Let me be clear.
In the meantime, as you prep to play this, Slayman, just thought I'd let you know. First, make sure the mic is close so the audio is good. And how long is the clip, by the way, Slayman?
It's 1 minute long.
I don't know why he keeps playing it.
And it's back.
Cool. Yeah, I'll let you. Okay, you got muted. I'll let you play it. Also, Meet Kevin will be joining us in a bit as well. So I've just sent him an invite. It'd be good to get his thoughts on this. But you go ahead, Simon.
Let me be clear that during the financial crisis, there were investors and owners of systemic large banks that were bailed out, and we're certainly not looking, and the reforms that have been put in place means that we're not going to do that again, but we are concerned about depositors and are focused on trying to meet their needs.
Can you say whether these problems were unique to Silicon Valley Bank, or can you say whether there will be other regional bank failures?
Well, look, let me just say that we want to make sure that the troubles that exist at one bank don't create contagion to others that are sound, and a goal always of supervision and regulation is to make sure that contagion can't occur.
So that was the Treasury Secretary.
What do people think about her response, Matt?
No, I mean, I think the same as earlier. No, well, so let's talk about the time before the crisis and the time after the crisis, right? The time before the crisis, the FDIC had already identified this, right? It was foreseeable, and then action wasn't necessarily taken. The time since the crisis, honestly, I don't fault the government. What are they doing? They're working. They're running an auction. They set a deadline supposedly for 2:00 today. They've telegraphed that they're differentiated between the investors and the deposit holders, trying to assure people that they're going to take actions. They know exactly how everyone in the space is going to interpret those statements from her this morning, which is exactly what we're doing as a signal that they'll backstop, right? So stop the contagion. I don't see anything that they've done wrong, to be honest with you, yet. What I worry about is most likely they're going to still treat SVP as an isolated incident, and they're going to say they're going to be looking closely at all these other banks, because at the last financial crisis, 500 banks failed. Every financial crisis, there's a rhythm of banks failing. So I'm extremely skeptical that they're going to announce tonight that they're going to extend that same backstop to everything, which is why I think this group should pivot to tweeting out that what happened in 2010, because that is.
I put it out on top with a link to the FDIC press release. So there is precedence. They've done it in the past.
I think in terms of realistic expectations, their behavior so far has been relatively mark to market.
Yeah, I mean, it's fascinating to just hear her walk through that. And, if the points that stand out is, one, no bailout for shareholders. Two, they're going to make sure that people get their money back in some senses. And as you mentioned, Matt, there has been a lot of talk about there being an auction ending at 2:00, which is interesting that many people are hearing similar things, and I'm not sure where it's all leaking from. But
well, imagine if somebody from the communications department wasn't managing this correctly, and they were using the wrong language, right? And they were saying we need to bail out the deposit holders, right? And then you turn off, all of America. So I think they're doing exactly what they probably need to and should do to set the stage.
Absolutely.
Kevin, I want to go to Meet Kevin. How are you? Your audio's not working, Kevin. Well, I'll DM Kevin to try to fix it in the background.
Yeah,
Can you hear me, Danish?
Yeah, I can hear you. Wanted to take the time to also get an opposing view. Did anybody feel like, Grant, would love to hear from you? I assumed you'd be the opposing view. Did you think that she handled it correctly, and is the government handling this crisis correctly, in your opinion?
Well, I've never been a big fan of hers, but any of these people that they talk mumbo jumbo.
We can't hear you.
What I was interested in, to Kim, is if treasuries are being dumped worldwide, why did the 2-year drop 50 bips in the last 5 days?
Exactly, and the dollar.
I would expect it drops another 50 Monday morning, because there's no way checking and savings accounts aren't going to move into treasuries Monday.
Well, of course, there are fluctuations in the market, but when you look at the overall picture, it's pretty dire, right? If demand for U.S. treasuries drops by 11% in a year, that should scare everyone in the U.S.
By the way, he's talking about $4 trillion of foreign holdings. Look at the graph over the last 10 years and all the money that's flown into U.S. Treasuries. I said it again and again. The foreign currency volatility last year prevented Japan from increasing their exposure. And if you actually read the transcripts from the Japanese banks, they plan to increase their holdings of Japanese Treasuries this year. The biggest buyer of U.S. Treasuries this year, believe it or not, will be U.S. and European investors.
Doesn't change the data at all. Nothing you say changes.
Okay, great. What if I told you that JP Morgan stock was down 5% in 2 days? Does that paint the story for the last 10 years and what's going to happen in the future? You painted a 12-month story. And it's only looking at 4 trillion of the 31 trillion of treasuries outstanding.
And to be fair, it's not even updated yet. If you include January in the data, it's actually 12%. So tipped by another 1%. The trend is clear. U.S. Treasuries are on the way out internationally.
Wait, you asked me my bias. What's your bias on the crypto side? Do you benefit by trashing the U.S. government?
No, I'm just reporting facts. You just have to look at the graph.
Oh, you're just reporting facts. I'm also reporting facts. Look at the
itself.
strength of the U.S. dollar and look at how much treasuries were bought on Friday. That's actually more relevant than your data from January and December and November.
What do you expect, Jay?
48-hour data is not more relevant than 12 months data. Sorry.
So, Jay,
I just posted 10 years of data on top of here going into 2022.
Yeah, 10 years are also not relevant because this is a new trend.
So you think 1 year is relevant, but the last week's buying in the last 10 years is not relevant. You don't know what you're talking about.
No, I know what I'm talking about because things have changed over the last year. And if you look at what happened after the war in Ukraine started, the sanctions that the US put on Russia, the pressure that it put on the EU, the terror attack on Nord Stream, all of these things make people very uncomfortable in foreign countries to trust the US as a steward for the international financial system.
So
you and foreign countries are
all right. We're getting back into that hole, and I appreciate you both going back and forth.
Let me read that story. We have one of our guests that we've had before on the show. Just got a message from them. Just want to kind of bring it back to the people that are suffering with all this. Sorry, I can't be involved right now, but you guys are doing an immense job. I have some heavy stuff going on related to one of my companies, and another of my companies had all our cash in Silicon Valley Bank, and we had just completed a raise. So then he continues about what they're going through.
It's absolute. I will tell you, I had a conversation this morning with a founder. She raised a large round in digital health, and her money's stuck, and it's absolutely heartbreaking. Again, for people that are not aware, this last 12 months for growth stage companies has been really hard to raise on equity. Raise a round, especially like a growth stage round. And, in all of this, what we're forgetting, it's okay to say, hey, we're just gonna, it's selection and it is what it is. Yesterday Vivek Ramaswamy was like, well, they shouldn't have put their money in Silicon Valley Bank, which I was very, as many may remember, very pushed back quite hard because that is just a random act that is affecting them. And it's not thinking about, in my opinion, the bigger picture. When you're talking about these founders and their companies, if somebody, especially in more traditional sectors like healthcare, when somebody leaves leaves a health system or a big biotech company and comes in and works for a startup, that's a pretty big change for them. And so, there is a humanity to this that we're not talking about at all. And again, looks like, Mario, that where we're going to see something happen that's going to get these people back to normal, but without these payrolls, payroll again is a reminder for people. In the U.S., payroll is collected on is 15th and 30th, and 15th, as a reminder, is this week. And so if they don't get their money on Monday, we're in a lot of trouble.
I want to ask a question, Matt. This one I'll go to you. And we do have speakers that will be joining us in a bit. So prepare some questions for them. Danish, I'll send you through the speaker list that we have for the next few hours. But Matt, the question I have, if we do get a bailout, we're seeing crypto rally. We'll see what happens when the markets open on Monday, tomorrow. But do you expect business as usual next week? Or do you still expect, because of the fear, that contagion will continue?
Again, back to the assertiveness of how they handle it. I think that the part that has changed, I mentioned this yesterday, is that so many of these companies relied upon the line of credit that was being supplied by SBP to project their runway, and that's gone. And I don't have I would be great if somebody could dig up the quantum of how much was in those lines. I'm sure we can figure that out. But that's a lot of runway that just evaporated. So behavior is going to change. Number two, there were tons of funds that had billions, tens of billions of dollars tied up at the bank as well. Those funds are going to be pulling term sheets. They're going to be paralyzed for a period of time, regardless of what happens here. And so that's going to freeze up. So there's going to be knock-on consequences no matter what. But those are secondary because they would have been happening anyway with the recession coming. Somebody said before, and I think they're right, recession solves a lot of the problems, conversely, actually, with inflation. So those things I look about, they're pulling forward what ultimately would have happened. So it's first is, can they stop the contagion? And two, regardless, there's been a fundamental change because of this.
Just going to bring up Mike McCarthy is coming up now. Danish, I'll just do an introduction very shortly. But I want to go back to name redacted, man. Anything to add to the discussion?
No, other than that thing I found on the FDIC that they've done this in the past where it was a 2-year program to allow unlimited protection as a way of ensuring confidence in the banking system. I'm not as concerned personally about seeing a run on banks this week. I think this was a specific situation where you had large high net worth individuals and companies or VCs pulling their money out of this specific bank. But I know there's debate over that. I get where Kim's coming from, and nothing more for now. There's a lot of news. We're going to get this is such a fluid situation. We're going to be getting a lot of headlines, and I'm still wondering if the regulators, Yellen or Powell, are going to give a press conference before the market opens. Because I think
we know they're going to do it today for sure.
It's 11:30 and one today as well.
Okay, good. All right.
And there's an interesting point here. A lot of talk about moral hazard, but if a bank ceases to exist and only the depositors are made whole, could this cause a bigger hazard than the moral hazard we keep talking about? This is a good question from the audience.
Moral hazard is very important. We don't want 2008 to happen again. But when you look at some of the programs that actually happened in 2008, you look at the TARP program, even the shittiest of the shitty banks, returned the money from the TARP program and paid the US government tens of billions of dollars in interest. So I know we talk about, we bailed out the banks, but I don't think you guys realize all the convertible preferred securities that the US invested in those banks were paid, and the US actually made a lot of money out of the bank bailout because the US essentially became a distressed investor.
But, ultimately with moral hazard here, is the more we actually bail out the shareholders, right? Getting people their deposits.
You can wipe the shareholders. I agree. You can wipe the debt holders. Just make sure that there isn't any contagion.
Kevin, I know you've had. What exactly do you mean by moral hazard here?
That if we make a decision today, we're going to have to live with that decision over time. I mean, that's really what the underlying point here is, that if we make a change today, that change will last over time. But I wanted to pivot to is your audio working now, Kevin?
I think so. Does this sound okay?
Oh,
that's perfect. That's perfect. Yeah, we just got. It's been like 20 minutes. Me and Kevin trying to sort out the technical issues in the background. So I'm glad it worked.
Thank you for that.
Cool. Kevin, how are you? Very
good. Thank you for having me here.
Man, what are your thoughts on what you're seeing today? Maybe Dan, I'll give you the mic. But what's your thoughts? Just a quick overview. Not sure if you heard our discussions yesterday with Bill Ackman and who else did we have? Bill Ackman, Jason Calacanis,
Mark Cuban.
Mark Cuban.
Yeah,
I'd love your thoughts on these discussions and the announcements we saw today.
Yeah, absolutely. I think it's very important, unfortunately, that depositors take at least some level of a haircut, because there does need to be a message sent that ultimately there is a risk that you have to evaluate when you have your money in a bank. For example, I have a real estate startup, and we had our money in a community bank a month ago, and I thought, the last place I want to hear about risk is banking. So I'm going to move that to one of the big four because I know the Federal Reserve will always backstop the big four. At least I believe that, and I'm willing to make that bet. So I moved my money to JPM a month ago, and I'm glad I did that. Now, it's unfortunate, but unfortunately, what you have is if you don't have depositors take at least some haircut in an uninsured level here, what you're essentially saying is everyone is 100% insured at every bank. Now, banks are actually incentivized to continue the risky practices like the lack of hedging for interest rate risk that happened at Silicon Valley Bank. You actually end up with potentially a greater crisis in the future. Now, I've been listening to the conversation, and I specifically wanted to point out Jay's comments because Jay did mention, look, you don't need that much of an FDIC backstop right now if you just say, hey, look, we'll backstop 100% of the deposits. I actually think that's a mistake. I think somewhere between a probably 10 to 15% haircut is unfortunately a lesson that we do need to have some risk management when it comes to where we bank, because we, after all, as customers benefit from the risks the bank takes. So we should not freely benefit from that. If the bank gives us easier lending,
you don't benefit from the risk that the bank takes as a depositor. You don't benefit at all from the risk.
Let me explain that. You actually do. The reason you go to a smaller bank is because generally they have better interest rates or looser underwriting requirements. Therefore, you as a customer of the bank completely benefit from the risk measures the bank is taking. If the bank is taking less risk measures, you benefit as a depositor. Depositors are not scot-free here, unfortunately.
Actually, I think in the case of SIVB, depositors were making 0% interest, so they did not benefit, but they did benefit from the loan side.
Yes.
I was going to say they benefited because if you look at a lot of the people who were depositors and then 97%, they're companies that were able to get lines of credit that they couldn't have got at the major banks. That's just a fact.
And so, you know, as you were talking, I was thinking about it, and I was because I also am a founder and we have money in banks, and we happen to be lucky not to be an SVB, like you just mentioned you weren't. But, you know, if you're a founder and you're thinking about your company and your startup, should you really be focused on, I mean, on your risk profile, you're telling me that bank run was on the list of things that you were worried about?
I'm a brand new startup creator, and the last thing I want is any investor in my company thinking there's any risk. And so I thought to myself, if there's even a 0.1% chance risk that this local community bank I was using has any kind of even slow movement of assets, you know, even if there's protection, but I lose access to my assets for a few weeks, even if there's a 0.1% chance of that, I don't want that chance. I'd rather have Jerome Powell on my side and be at one of the big 8 banks that are properly stress tested, unlike a local bank like SVB. Now, unfortunately, sometimes we have to go local.
I'm so sorry. I wanted to push back a little bit. You know, this is the beauty of spaces that we can do that. You know, SVB was one of the 15 largest banks in America. It's like number 12. It's not like your local community bank.
Right, but here's the thing. Remember that in 2015, they lobbied to essentially ask the government to raise the standard of what an SIB is, a systemically important bank, and they contributed to essentially the raising of that limit from 50 to 250 mil. Them sitting at 211 billion in assets puts them under that level. And I also take issue with this idea that Ro Khanna mentioned this morning. The bank was fully capitalized. I mean, if I go into their Q4 financials, I take out intangibles for liquidation, which of course you're going to do that, and you look at their mark to markets, you're already insolvent as of Q4 of last year.
You were already insolvent. Yes.
Yeah,
that's right.
Can I represent the great Mr. Wonderful on this Spaces, because he's on the plane right now? But we've been texting for his view. Is that all right if I jump in for a second?
Yes, go ahead, Matt.
All right. So he hold on a second. He tweeted out a second ago, and then I asked him for a follow-up to see what he meant. He put out basically, the combination of a negligent board of directors with idiot management is the potent cocktail that led to a disastrous outcome. Why should taxpayers bail them out? The lesson is simple. Never put more than 20% of your liquid assets in any one financial institution. That's what he tweeted. So I texted him just to be clear. You saying you wouldn't backstop deposits. And he wrote, no backstop over 250K FDIC insured limit. Otherwise, you perpetuate idiot management in banking that makes stupid mistakes like SVP did. So just
And Mr.
I mean,
Wonderful
that's
knows a
fascinating.
lot about losing money. So
I'm just saying, I'm just representing as the fine man who was just speaking. I'm sorry, I didn't realize who that was, but you know, intelligent counterpoints offering the endorsement of Kevin O'Leary for your view.
But hey, guys, can I chime in here real quick?
Go ahead.
I just think it's completely wrong to put the blame on depositors and say they should have done a better research or diversified themselves better. You know, we're talking about a bank here and not a small bank. And depositors should not have to worry about these things. The fact that a bank can even lose depositors' money, that is what is systematically wrong here. And that needs to be fixed because depositors need to be able to trust that the money that they put into a bank is safe. Anything else is outrageous to say that depositors are at fault.
But
I mean,
I want to ask you. I want to link to Tim's. Matt, I want to link a question to Kim's point. I want to add a question to you, Matt, and to Danish, and I'll give you the mic back, Danish. But why were depositors using Silicon Valley Bank? What were the advantages that SVB offered?
So that's why it's a good. You can go for it. It's why it's an important debate to have, because the honest, realistic answer is that this particular bank targeted this sector to go ahead and create a very big bank. And that's why they ended up with whatever 190 billion in deposits, and it's because they were very founder friendly to this particular sector, and they extended lines that other banks would not have done. You know, generally speaking, in my experience, looking at founders, and so and they were also very founder specific friendly, enabling them to borrow against equity. A lot of founders had different financial relationships with them, so they just went after their sector. So I do think the number one moral hazard argument would be because somehow that behavior beget the situation, but that's not the case. What beget the situation is that the FDIC has a public policy of insuring a certain amount of deposits in order to prevent a bank run like that. So why would they allow, pursuant to their regulations, 97% of the deposits, that concentration, to be uninsured? So at the end of the day, this is a failure largely of regulation. You're punishing the wrong people. But the best counter argument would be, well, you were into this bank because there were special benefits that other banks wouldn't confer, and you should pay some type of price. But I don't think that's on balance. It's not realistic to think that we can outsource, risk management in terms of diligencing your bank better than the government can. We expect the government to be able to take that role.
And to be completely fair, Kevin, if we took your approach, it would stifle innovation in finance, in banks in general. I mean, if everybody did what you did, we would only have 4 banks, right? It would just keep going up the chain.
100%. That was my point last night.
Yeah, it would be disastrous for the economy, and it would be disastrous for projects across the country. I mean, Bill Ackman was here yesterday, and he was spot on that a lot of small projects rely on these community banks because the big banks don't do them, not out of the risk of it, but out of principle. It's just not worth their energy or time. And so what do you say to that argument? That are we trying to kill community banks? Is that what you're saying is the right move, that we should have concentration of power to the big banks?
Well, I think these are very good questions, and it's an extremely fair counterpoint. I think the important conclusion here, in my opinion, is the federal government and regulators that need to lower the standards for stress tests to all banks. Now, unfortunately, to some degree, that is going to reduce innovation. That would be very normal. But I don't think if we subject the largest 100 banks to stress tests that we're suffering such a terrible risk to innovation that we've having problems, and now we can walk away from individual customers having to worry about that due diligence, like you all have mentioned.
But if everybody does what you do, we will have that problem. I'm sorry, I'm getting lost here.
That's fair.
Only for certain people that's okay, but other people should rely on the community banks. Sorry, we're just having a conversation here, but it's just because this is the question. By the way, the number of family members that have reached out to me, just to give people context, people use smaller banks all the time, just like you did. And so, if everybody has the same question, then that's bad, isn't it?
It is to some degree.
It
You're
is.
right initially, but what happens is in my opinion, you say, "Hey, look, systemically important banks, set the limit very low. Set it at 10 billion. Yes, it's going to be more expensive, but that way you could have a top set of 200 to 500 different banks. You'll have plenty of innovation amongst those. Do I think there should be an oligopoly of banks of only 4? Absolutely not. But do I think we need regulators to actually regulate, and that companies as large as SVB should not be hedging interest rate risk? No, absolutely not. That's terrible as well. So yes, we do need local fees.
But couldn't we do both, Kevin? Couldn't we also take care of this current situation, make sure that we don't have other bank runs, and reduce the bar and the threshold for what is systemically important or systemically critical?
Potentially, and I suppose that'll be ultimately up to the regulators and how they want to balance the potential aspect of, hey, look, here's our taxpayers now bailing out a Silicon Valley bank, right? The name certainly doesn't help itself, but that could create some populism issues. Some might argue there might be some inflationary issues, but then again, frankly, the Federal Reserve is tapering to the tune of $90 billion. I don't think the per month, I don't think the shortfall here would be anywhere near that. I think you're probably looking at closer to maybe a $50 billion shortfall max if you look at sort of fire sale pricing, maybe 25% haircut. But yeah, of course, the correct answer is probably a balance. But should every single depositor absolutely be guaranteed and basically spread that to every American taxpayer to 100% when they full well knew that they were only insured up to $250,000? No, because that does send too much of a signal to the entire banking community that you could do whatever you want. And don't worry, the government will come in and bail you out. It's like having an accidental damage protection plan on your iPhone and then taking selfies on a roller coaster because if you drop it, you don't care. It increases and encourages recklessness. And that's the last thing we want to do.
Hold on. So there's already been a solution that's come up, which is to create another version of an FDIC and another insurance pool for uninsured deposits. We're all talking about whether the taxpayer is going to pay for this or not. And to be very honest with you, the damage to the economy is likely to be much worse if you have several banks go down overnight. And I will tell you from experience that in a fractional reserve system where banking is based on confidence, you could actually have good banks go bankrupt. Actually decent banks that take good risks, that have 90% of their liabilities as deposits, because of the illiquidity of the loans on their balance sheet, you can actually have good banks fall for no reason. So I think that is being left out of the conversation. And you don't need a full bailout. You can actually have banks contribute to a new insurance fund and pay into it every year. Initially, the government backstops it, but in the end, the banks pay for their own insurance.
And to be fair, if we force everyone to go into a smaller pool of banks, this whole concept around 250,000 in FDIC, how are you going to take some as a startup if you have 10 million in the bank, which at growth stage is completely fair? You should have money in the bank because your burn is high and you're growing. Are you going to now take it across, how many is that, 40 different banks? There might not be 40 banks to give it to. And how are you going to manage your payroll? How are you going to measure? Because again, for a lot of companies, 250K can represent one payroll. And so, I think that we just have to have more common sense solutions here, focus very clearly on how do we solve this problem right now? How do we prevent a bank run? And, and I can't believe I'm saying this, but the solution that I'm seeing from the government right now seems to be along those lines. It's insane to say that they're acting. I still think that they should be more certain. Kevin, are you seeing amongst other factors?
Hold on. There's just a bit of breaking piece of information from Mark Kleinman from Sky News. A deal's not yet certain, but I understand that both HSBC and JP Morgan are exploring buying Silicon Valley Bank, UK.
Oh, yeah.
Okay, as for the UK.
Oh, Silicon Valley Bank UK.
Yeah, I read that at the end. Yeah, Silicon Valley Bank UK. I thought it was Silicon Valley Bank, so it's a bit surprising.
Yeah, you buried the lead. Everybody's like, hold on. JP
Yeah, I know. I read it at the end, so I was like, I thought it was major news, and I read it. It's just UK. So
well, it's better than Bank of London. It's better than Bank of London, that's for sure, because it's a bank that people know. I think that
JP Morgan saw Bank of London going in. They're like, okay, hold my beer. If they think it's worth something, we think it's worth something.
What's interesting is, and people may not know, but Optum banks with, I just heard this morning, banks with Silicon Valley Bank London. So that's not a bad account to have. I wanted to, really focus in on the response from the government. I know that they've, Janet Yellen went around and talked about this. I asked the team, if anybody here actually knows Representative Ro Khanna, please do have him join. We had, Thomas Massey come in and give the other side of the argument. I'd love to hear Ro Khanna's side. So if there's anybody in the audience that can ping him, that would be great. I know our team is reaching out as well.
Yeah, and if you do, and something to mention to the audience as well, I should have mentioned, if you do recommend any speakers, anyone at all, please do DM me, and the team is checking all the DMs that I get, and we'll be able to invite them and add them to the schedule. So yeah, Mike is yours, Danish.
Yeah, so as we're looking at the response, Kevin, I heard your thought on the response here, that ultimately there should be a little bit of a haircut. That, and I'm going to use my words, and I apologize. I know that's not probably what you meant, but we have to have some people feel the pain here, because while they benefit from the banks, just like they benefit from the bank's decisions, they need to also feel the brunt of what happens when they don't make good decisions, and there should be diligence. I'm going to ask you a tough question, but this is an important question, and I know you're ready for it. But when you switched over banks, how much diligence did you do outside of just the fact that they're too big to fail?
That's the only piece of information you need.
That's the only piece. But remember that they nearly did fail previously in 2008.
If you're investing in America, I think the rule of thumb of don't fight the Fed is probably the most important thing to consider. And so I'm a big fan of believing that, and I think that simplifies a lot of the work.
And with your work in real estate, do you feel like the Fed is the source of this problem, or this is just bad leadership and bad management?
No, I mean, well, it's a combination. I mean, ultimately, this is by design what the Federal Reserve is trying to accomplish. Job losses are exactly what they're predicting. And as much as it's painful, and Jerome Powell seeks to limit pain, as he said, because of the economic and human consequences, that's an important word, considering the fact that people suffer. Suicide goes up in a recession, right? People losing their jobs and their livelihood and going bankrupt is very, very bad. But unfortunately, some of the pain of people losing their jobs and businesses going bankrupt has to occur in a recession, and ultimately that's what capitalism does. Is capitalism essentially creates recessions through a business cycle, which can be amplified by the actions of the Fed, which they might be doing the wrong thing at the wrong time. For example, why were we printing money in March of 2022? That was absolutely the wrong thing at the wrong time. But we could criticize the Fed going backwards all we want. What we need to do is look forward. Yes, the Federal Reserve is creating this sort of environment where the riskiest of assets do face potentially going bankrupt. But that is a normal, dare I say, feature of capitalism.
Is the next step, so they wanted to do this until something broke. I think something's broken. Are they done? What do you suspect? What are you preparing for?
I mean, ultimately, I don't think we're going to see. I just had dinner with Kathy Wood, and I asked her about it. I think sharing her perspective is interesting. She mentioned she doesn't see the risk of Silicon Valley Bank as systemic, but there will likely be others. And I echo her opinion that no, the pain isn't over. But do we think that this is the moment where the United States dollar loses world reserve currency status and we default on our debt? No, I don't think we're anywhere near that. Look, all currencies that have ever existed, all fiat that has ever existed, has always gone to zero. Eventually, that reckoning will come to America. I don't know if any of us will live that long to see that, but I certainly don't believe, along with Kathy Wood, that that's this cycle. But yes, will there be more pain before the cycle is over? Absolutely. This is just the beginning of that.
Yeah, I do disagree with that, though, because we are living in different times and evolution is accelerated, technology is accelerated, and what's happening to the US dollar will also be accelerated. So you can't compare what happened in 200 years ago to what's happening now. Things are much faster, and you can already see it in the last couple of years how things are changing rapidly.
You know, it's fascinating because I'm obviously, I agree with Kevin that I don't think it's going to happen in this cycle, but these kinds of decisions are making me very suspect. I mean, going up this quickly, and you know, do you think that we're using outdated information? I know the jobs report just came out. You know, we're trying to break. You just said it, so I'm going back to it. You said, well, you know, limiting the pain. The goal is we do need to see some level of job losses, but isn't that a lagging metric? I mean, we've seen prices of commodities start to come down now. You know, are we just working with old data, and are they going to end up overcorrecting? I mean, one question that's come up, last point on this and question on this, are we overcorrecting? You know, now I think consensus view is that there's going to be a 25 basis point move, but is that too much still?
Yeah, it actually might be. So I think there's a greater likelihood of a 0 than a 50. It's all going to be predicated on CPI coming out on Tuesday. That'll be very important, of course. But if we have even a CPI report in line or slightly low with expectation, there's a very real likelihood of 0 because, yes, there is a risk of overcorrecting. I personally believe, much like Jay mentioned earlier, that I completely agree, that the disinflation is already here. There is no wage price spiral. There are a lot of folks in markets who have been, especially in the last part of last year, pricing in the actual fear that Jerome Powell might turn into Paul Volcker and purposefully push us into a deep, dark recession with a 10+% interest rates. I think that fear is way overblown. Yes, the wage gains we have right now are in retail hospitality, but that sector is still substantially underemployed than it was in 19. Healthcare is equally employed today as it was in 2019. But if we were looking at trend, we need another 900,000 healthcare jobs. So of course we're still going to have job growth here. So yes, absolutely, job growth is completely a lagging indicator, and the likelihood of the Fed overcorrecting is absolutely there. The good news is, if we read earnings calls from corporations, whether it's Johnson & Johnson, Target, Walmart, Tyson Foods, or really any company, what we're finding is the focus now is not raising wages any more than the catch up we're seeing of the miscellaneous wage increases like Walmart or whatever. The focus now is productivity and efficiency and automating, because they realize they can't afford to pay employees anymore, and employees are starting to lose pricing power. One last point on that. Read the Cloudflare earnings call and you'll see they mentioned for 1,500 jobs, they had 400,000 applications. Wages are no longer facing a wage price spiral risk, and that is good for preventing a Paul Volcker, and the Fed will realize that.
Hey, just wanted to, thanks, Kevin. Just wanted to welcome Dennis.
Yeah, I'll introduce. Yeah, I'll do that. I do want to mention one interesting comment that the Silicon Valley Bank's Twitter account is gone. For anyone going to look through their tweets, so they did delete it because there's some interesting tweets. Reading them through days and weeks before they close shop. There's an interesting comment here. I'll read out from. I don't know if they want me to share their identity, but I'll read it out. I'm in the spaces. I think it's to reset on the fact that Silicon Valley Bank doesn't have the assets to cover 50 to 75% of the deposits. So this isn't a case where those above FDIC limits lose all of their money. If the government comes in, it's to fill the gap of a portion of it. This portion's to be determined. So let me see if I should read out the rest. Okay, so we aren't in space where companies aren't making payroll once access is given anymore. The debate is on the debt facilities that company has using. So Dennis, good to have you on stage, man. Would love your comments what was discussed so far, and I appreciate you giving us your time.
Yeah, thank you so much, Mario. And, thanks so much to everyone who is putting on this conversation, because it's quite helpful and quite illuminating. And just a couple quick points. First, the debate about the desire in the rest of the world for U.S. Treasuries, whether it's strong or not, between Kim.com and special situations. Well, both gentlemen are working with different data sets, and no lies have to be involved here. And this is what makes a trade. But the fact is, if a crisis happens, especially if it starts in the US and spreads to the rest of the world, as we saw in 08, 09, the fact is the rest of the money in the world will flood right back into the U.S. That's why U.S. Treasuries, as someone pointed out, a special situation,
100%.
fell 40 bips in a single, a matter of hours. So even in a meltdown, the U.S. is the best house in a bad neighborhood. Next is that I keep hearing moral hazard, and this worries me because in 08, there was that. And I love the high level explanation more is that we're afraid of bailing you guys out here because you messed up. And if we do that, then other guys will mess up and they'll take more risk because they might be bailed out. So we can't do this. So what happened in 08, 09 is first Bear Stearns wobbles. So the U.S. comes to them. Then Lehman wobbles and the U.S. decides, dude, we can't keep doing this. Moral hazard. They don't bail them out. Later, after all was said and done, it might have been $6 billion difference between all of the swaps, et cetera, et cetera. This bankruptcy judge, I heard her later say, Lehman was never really bankrupt at all. It was just that fear thing. Okay, so they did all that. Government blew it. They wanted to play hardball. They blew it by not guaranteeing Lehman. All government has to do here is step in and say, we guarantee depositors. Depositors did not commit huge risk, nor did this bank really. After 08, they were forced in the reforms to no longer invest in ridiculous synthetics and CDOs and mortgage-backed securities created for no other reason than to allow someone to short them, and all that crap went out the window. And instead, you put it in safe government securities. And then what happens? They do, and the Fed comes along and raises rates so high, so fast. It's not just 400 basis points. It's a 13, 14, 1,500-fold increase, really, in borrowing costs. And then those bonds lose over half their value suddenly. And if no one ever had to sell them again, and there wasn't a run on the bank, this wouldn't have happened. There was no risk-taking here that was out of line.
So
Yes,
Dennis,
the bank
sorry, I
blew
just
it.
want to make sure that we get your thoughts on this, because I'm hearing something and I want to confirm. You don't think that the leadership at Silicon Valley Bank, they were working with the crappy cards they had, that they were not at fault for this meltdown?
Look, anytime a meltdown like this happens, the first place we look at fault is within ourselves. Yes, it is the leadership's fault. I talked to a senior guy at one of the biggest banks in the world that you guys have mentioned just today, who pointed out that, listen, the fact is we took $1 billion hit on the same type of stuff. We took a $600 million hit and another $400 million hit. We were writing off as we go. And SVB didn't do that. They saved it up, hoped they could get out. And then ultimately they did it all at once and took the hit. But when they took the hit, guys, it was less than $2 billion. It's 1% of their $200 billion in assets. All right, They blew that, but it was instead the run on the bank that caused it. They lost $42 billion in deposits in a matter of 2 days. It's 20% of assets. JP Morgan could not survive, could they? That kind of confidence run if 20% of assets were pulled out in a day?
Well, I mean, it's a fascinating question, which is, we were just hearing from others that, well, that the Fed is behind certain people, and so you should feel comfortable. You're scaring me a little, Dennis. So I want to make sure that I understand your point. Your point is that this was a bank run. And the bank just raised too quickly. They had invested in securities, long duration securities. Perhaps there was a mismatch. I mean, there was a mismatch. That mismatch then led to
That's so cool. You can track that. What do you get?
Right. They didn't tend to it right. Yeah, keep going.
Yeah.
Well, all I'm saying is that the problem was created by the Fed itself, and now the Fed's going to come in and act like the banks did something wrong. They were ordered to put their money, their cash, their securities into what is the phrase you guys must know? High quality reserves. And that was government-backed securities, which were really safe until the Fed went out there and made them lose over 50% of their value in less than, 9 months?
So
the very fact they raised that much, they got it wrong.
Yeah, so Janet Yellen is out there. Ro Khanna is out there. They're talking about, doing the right thing, making sure that people get their deposits back. No bailout. Which is good. I think everybody agrees the shareholders should lose in this. It's their job.
Yeah, the shareholders, definitely.
Yeah.
Jim Cramer
put their money in the bank.
300, poor guy.
Yeah. And then,
but not the depositors. And now yes, the depositors also are to blame. If you are Meghan Markle and Prince Harry, and you had 100% of your cash in that bank, even though FDIC guarantees only 250K, yeah, that's partly your fault. Just like when Bernie Madoff ripped off Kevin Bacon and Kyra Sedgwick, they had all of their assets with Bernie. That was a mistake on their part. There's always enough blame to go around. I'm just saying that if you think about it, guys, would any of it happen without the Fed raising rates so far, so fast? And guess what happens then as a result? Look what happened to the treasuries yesterday or the day before with the 40 basis point drops. Interest rates go down off of that base, and that's the opposite of what the Fed wanted. And so now what are they going to do? They're really in a crunch. I don't think they can raise here, or certainly it can't go 50.
So you think they're going to raise 25 or 0? I mean, 25.
I think they should. I think they should pause and go 0 and just say we really have to hold back on this.
Interesting. Name.
But one other thing, can I hear like special situations respond to this idea? Because I said this on CNBC at the time. I came up with something at the time that I called the Rob plan, based on a friend of mine. He said a government guarantee, just promising people, look, like if we'd come in and said we're gonna back these mortgage-backed securities, okay, we'll make it. Don't worry. It would have stopped the panic that spread because of Lehman.
So we
and
actually
here,
do.
A guarantee is a low-cost solution, isn't it?
I think it's a low-cost solution, and you can actually do it in a way that doesn't actually affect the U.S. taxpayer in the long run. And by the way, when it comes to mortgage-backed securities, they actually are guaranteed by Ginnie Mae, Freddie Mae, and Fannie. So that's a separate issue. But when it comes to the solution for uninsured deposits, there's several ways to go about it, and the easiest way to go about it without actually affecting the U.S. taxpayer in the long run is to set up an insurance entity like the FDIC, but for uninsured deposits where banks pay, 0.1% of income or 0.2% of income, or whatever the government agrees on with the big guys, right? JP Morgan can afford to put in $100 million every year, and all these banks can contribute so that it's going to benefit all of them. All their stock prices are going to trade higher. All their debt's going to trade tighter so that when they borrow from private investors, those yields are lower. And in the end, it actually will probably benefit the entire banking system. And guess what?
Don't you think they just
nobody has to put any money into it.
Yeah,
nobody has to put any money into it. It can all be paid back.
Jay, you're assuming that the banking fees are not going to be pushed over to consumers, right? That's the underlying.
Give me a break.
Guys, I mean,
do you know what the profit margins are on the big banks? They're not going to these. And by the way, do you know how much it would cost to actually, with the $18 trillion of deposits as a percentage, how much, even if it was put on consumers, how much it would be? Almost nothing.
It's de minimis. It's really nothing. I was surprised to hear the Congressman Massey, who was a great guy, for coming on your spaces. But I was surprised to say, well, I guess it could cost $20 billion if there were some kind of bailout. But then, where's the money going to come from? Hey, guys, you sent $100 billion to Ukraine, no questions asked. You found money for that.
This is the types of things I'm talking about. Like, we have all this pork belly spending going to like parks and all these local Congress
that's just
representatives.
I do worry, guys, that I love Hank Paulson of Goldman. I thought he did an amazing job as Treasury Secretary. He was underrated and underappreciated at the time. But if you look back, we were so lucky that he was in there, and Obama was kind and smart enough to let him stay in there and keep going for a while. And he did amazing. But to have Yellen there, who spent more time kind of shilling Biden policies for liberal stuff and diversity and inclusion and but yet not. I felt like her statement today on Meet the Press was poorly handled, jumbled, unprepared, unsophisticated.
That was the first time that I heard Janet Yellen, in my opinion, be that clear. I mean, that was incredibly clear.
Wow.
So I'll walk you through why. Every word seemed prepared. She didn't use the word bailout. She did not use the word bailout. She talked about shoring up deposits. She couldn't say what's going to happen exactly. I felt like that was good execution. Dennis, you clearly disagree.
I thought it was kind of halting and not declarative enough, not reassuring enough.
Mm-hmm.
She could have said things like, you know what, this is a great regional bank that did a great job for a long time. They got out over their skis, but we don't see it as systemic because of this and this. I felt like she could have been a lot more confident and reassuring, and that we have a plan. We ain't telling you what it is, but we got a plan and it's already underway. By the way, can I say one more thing? And you've been very kind. I apologize for filibustering, but Elon Musk, message to Elon Musk. Buy this bank. Use it to turn Twitter into X.com, the finance app. Use it to become a hero in Silicon Valley who hates Elon Musk for doing the Twitter files and revealing the censorship of conservative views, horrors. Use it to, then regulators will love you for coming to the rescue when Washington hates Elon Musk because
Musk needs a banking charter. So he needs a banking charter. And
Boom.
Twitter itself has about 1.5 billion of interest and is currently free cash flow negative. Musk himself said at the recent
other things to worry about right now.
right. Musk actually is trying to get Twitter to break even by the end of the year. So they don't have the ability nor the bank charter.
I'm just saying this would be nothing. This is really is the $2 billion spread. Really, if you get right down to it, all it is that $2 billion spread. Well, there's 15 billion also that are underwater on the hold to maturity, but I think the Fed will stop raising and that'll come back around.
And again, like I think it's a natural response for a lot of us to say, well, Saint Musk will come in and fix this. And, I think he's done that enough recently.
But also he could use the bank. He needs a bank charter. I think actually it's not a bad move and it's selling for cheap.
I mean, that might actually be true. Name, did you have a comment on what Dennis said?
Yeah, I wanted to add to what Dennis said. And if we want to talk about moral hazard here, that starts right at the Federal Reserve, okay? Because historically, the Federal Reserve has a tendency, we have seen this before, this is not the first time, where they will keep easy money policies in place for too long, which creates excessive risk-taking and leveraging into risky products. It creates bubbles. And on the flip side, strict on policy, like now, they pretty much force the banks into having to invest in these low-yielding treasuries and mortgage-backed securities, and the banks are limited on what they can invest in. Okay, they're not out buying stocks.
Right.
Okay, so
we actually raised interest rates 9 times between 2016 and 2019. We were going to enter a recession at the end of 2019. Most of you guys may not have been trading or may not remember, but what ended up happening 3 months later was that we had an exogenous shock with COVID. Actually, I think that the Fed would have been hiking up to.
Sorry, guys. Wanted to interrupt for a second. I just pinned this to the top. Someone just shared this with me. First Republic is now publicly saying everything's okay. Everything's okay. Honestly, it's a little ominous. I'll let people read it, but the first tweet is, in light of recent industry events, we want to take a moment to reinforce the safety and stability of First Republic, reflected in the continued strength of our capital, liquidity, and operations. For people, and again, this is the goal here is not to introduce FUD. The goal here, the reason why I put that up there is actually, if we can do anything in our little spot in the universe, maybe we can help First Republic not have a bank run. But this is, as many people will tell you, this is risk management coming out and saying, hey, we got to do something. They would have said nothing if they didn't have to. Suleiman?
Yeah, I mean, that was a similar message to what was said yesterday, wasn't it? Which is First Republic saying that the problem isn't there, that we have the diversity and this problem won't occur. And so the concern is that in trying to protect SVB, and the issue has been enlarged a lot more and actually causing the very thing that everybody's stopping. Now, my question to Dennis is, Dennis, you mentioned that, the US was able to send 100 billion to Ukraine. And so in terms of what the previous speaker said, Massey, that 20 billion more won't be an issue. But isn't that the problem? Like most people in America, and this is the other side of it, that most people in America are struggling because of those decisions. And therefore, a further decision to spend more money on solving an issue that was made, where mistakes were made, is another burden on the American
people. So a quick question. Sorry, to add on to the question, it's something I just heard you say that. When you say the US sent X dollars to Ukraine, they didn't send that in cash. Isn't that just weapons they have sitting there? So it's just weapons, the US weapons that they're sending instead of just sending capital. Just something important to differentiate.
Okay, so couple things. Let's just think now. First of all money is fungible. Whether you're sending in cash or you're sending in arms, the arms cost the cash. So I'm not sure that that distinction counts. Second, $20 billion to make sure that the banking system feels better and that you cauterize the wound and you stop the panic is a gnat on an elephant's backside in terms of the cost to the economy or to taxpayers or to anybody. It's nothing. And this government can't scratch its elbow without spending $20 billion. They're spending $1 to $2 trillion more each year than they take in. So it's a matter of what you spend it on. And in this case, to tell depositors who put cash in one of the top 20 strongest banks in the U.S. and said, okay, I'm going to be safe. They weren't speculating on, Bitcoin or Dogecoin. They were putting money into a strong bank, and then something happens. And the bank, those guys are going to pay a huge price. They've already paid it. My gosh, I can't believe how fast this happened. And that, guys, I'm wondering what you think. Does that make the system, the people in it feel safer, or does it instead raise more fears because you say, God, you guys couldn't even wait until the market closed? It was that urgent? You moved right in the morning and just shut them? It makes you wonder, are you worried about systemic stuff you haven't told us about? I don't think
they should be worried about systemic stuff. I don't think 20 billion is that big of a number. I think you're absolutely right. And I don't want to be political, but when talking about the situation in Ukraine, we spent $2.3 trillion outside just in direct dollars in the Afghan war, and including Pakistan. And there are estimates that the indirect costs were much, much higher, closer to $8 trillion. Yeah. There are 11 million registered army participants in Ukraine that are the military. We essentially are paying a group of 11 million people to fight a war for us, because if we didn't support Ukraine, who is to say we wouldn't be in a bigger problem where Russia would be encroaching on the entire Eastern European bloc? Yeah, when it comes back to the banking system, $100 billion to Ukraine, we are essentially subsidizing the Ukraine's defense against Russia without actually sending one soldier over there. So you need to actually understand the geopolitical ramifications and the benefit to the U.S. economy.
In terms of geopolitical ramifications, we've discussed.
I'd rather have them fight. I'd rather help them fight the Russians. I'm with you. Okay, I'm just saying that if we can afford that. I mean, long ago, Congress decided guns and butter. Remember, in economics, we can only have one or the other. Now it's both, right?
So Dennis, I mean, coming back to the point, the issue is this, and to be honest, we discussed this yesterday, and I got so many messages from Americans all feeling the same way. They were all basically saying, yes, why should we have to bail out the rich? And so we see people like, Meghan, Oprah, Harry, these type of people banking in SVB. On top of that as well, there's information come out that it was a very risk-taking bank in terms of a lot of the startups that went there went because they weren't able to get credits from larger banks. And also when they were getting credit, that was linked to them actually using the bank as debit. So all of this was that they were partaking in risk. So now, why should the average Joe who's already struggling have to basically help in that situation?
To answer your question, the average Joe doesn't have to actually give any money into it. Like we said, you could set up an insurance fund that up front, the government might seed, but the banks themselves will pay for it. I don't understand why everyone keeps going back to it. We are not going to pay for it. In TARP, all the money came back, and the U.S. government actually made money from TARP.
You're right, but also if I may say, gentlemen, if I could get in here, this is about image, and by closing down the bank so suddenly, they no longer have a messaging department, a PR department, and if I were advising them on messaging, you'd say we are not bailing out Oprah and Meghan Markle. We are bailing out over 1,000 startup companies who employ over 100,000 people. We are bailing out the companies trying to invent the next apps that are going to make life better.
Don't say we're bailing them out.
No,
we're temporarily backstopping them.
So
I want sure that they can meet payroll.
I want to say one thing on this. So just to give kind of throw a bone to those on the side of, let's just say, making depositors whole, okay? And I understand that, okay, because it is not their fault, regardless of whether they should have, diversified where they held all their money. But if we have a Treasury Secretary, Yellen, that goes over to Ukraine and provides support for Ukraine pensioners and pensions, if we're going to do that, then we should be taking care of our own people and in the United States in a situation like that.
Good point, department.
Do that in Ukraine. Okay.
And I'm not even saying that's right. I'm not even saying we should.
sorry, Special. What about precedent? So now you're basically helping this bank out, because we don't want to use the word bail. You're helping the depositors in this bank out. So next, is this going to now, because of bad decisions by the bank and some bad decisions by the people?
Well,
so is this going to happen all the time now? So is it every single bank going to be saved? From now on, are you going to save every bank?
There is precedence for this. In 2010, I guess it was through an act of Congress that the FDIC did have 2 years of unlimited insurance for depositors.
Yeah, it's not completely unprecedented. It's happened.
And I think an even better answer may lie in the example of Lehman. The government said no because at the second bank, Bear Stearns got in there. We can't bail out this one. And oh my gosh, the chaos that unfolded around the world because of that one little decision. And by the way, then we ended up doing the TARP thing that was like, I don't know, I could swear the original figure was $864 billion. And, in the aftermath, I was covering that. Nobody had moral hazard. No one was saying, hey, let's kite it up and do more risk. They were chastened. They had the hell beat out of them in public, in Congress, in their bonuses. They were whipped and beaten. And it took a while to get the animal spirits back. So especially this time when the depositors, they just put their money in a bank. And the bank didn't even risk it all that much. They just kind of did some accounting stuff that was bad. It wouldn't have had to do if the Fed hadn't, put them on a roller coaster ride.
So,
although it is their fault, yes.
Yeah. So that was the end of the point I was going to make earlier, was that the Fed is the moral hazard, where their easy money policies that extend for way too long create this risk of bubbles and leveraging. But then on the flip side, they pretty much forced, these banks had no other choice than to be investing in low yielding treasuries and mortgage-backed securities, and then to get rug pulled in a period of 9 months and literally saddle all these banks with losses over, in less than a year it's the Federal Reserve that creates the moral hazard.
I agree. And then to do everything they can to force this economy into recession, to jawbone it down, to inspire lack of confidence, and yet consumers don't get the memo. They continue to have a good time. They had pent-up demand, and plus the government had handed them $2 trillion even to people who didn't need it in the COVID stuff, and so that was still in. It just had a lot more velocity than the previous 08 meltdown. That money stayed locked up and didn't move in, but this moved into the economy, and so it's defying the Fed, and now they're going to do whatever they can to drive this thing into recession.
And on this policy of restrictive policy, they are going to go. They're going to keep it restrictive for too long, and there will be more. We'll be on these spaces in another month or a week or 2 months discussing another, institution that collapsed for the same reason, because the Federal Reserve, on their policy, they stay restrictive for too long and easy for too long.
Yep.
So I just
it's Danish. Danish, do you want to read the article?
Yeah, so there's 2 new articles that just came out within the last, just kind of talking about the sentiment in DC right now from both sides of the aisle, actually. And so I posted it up in the Nest, and I'm going to be posting. Just give me 1 second here. I'm going to post the other one up. There you go, up there. Both of those kind of going one side and the other. So I'm going to walk through this because and is a harbinger on what's going to happen as this comes inevitably. I mean, depending on where you stand on how high the contagion risk is, I think we're starting to see at least the narrative start to develop. So I'll start with the one that I just posted, which is the GOP presidential candidates react to Silicon Valley Bank collapse. It's from Fox News. And 3 announced Republican 2024 presidential candidates weighed in. So first, President Trump's campaign blamed the anti-America policies from the Biden administration. They kind of go into a little bit of history there. But, this is the response to some of the more progressive lawmakers blaming Trump for signing a bipartisan bill in 2018 that rolled back elements of Dodd-Frank. And they fired back today saying out-of-control Democrats and the Biden administration have pathetically continued to try to blame Trump for their desperate lies. such as the CCP spy balloons, the train derailment in East Palestine, and now the collapse of SVB. The Trump campaign spokesman, Stephen Chung, told Fox News, this is nothing more than a sad attempt to gaslight the public to evade responsibility. The fact is that Biden has presided over that has devastated everyday Americans and has caused misery across the country due to his anti-America policies. Nikki Haley also jumped in and she said, taxpayers should absolutely not, and here's the big words, bail out Silicon Valley Bank. Private investors can purchase the bank and its assets. It is not the responsibility of the American taxpayer to step in. The era of big government and corporate bailouts must end. Ramaswamy, we heard from him yesterday, and he again, Fox actually picked up, Mario, they picked up some of the commentary from yesterday, not only his tweets, but also in general, what he said, but SVB should be allowed to fully fail and that the FDIC should increase the guarantee level to prevent a run on the bank. So no bailout or help for depositors for deposits at SVB, according to Vivek Ramaswamy. And again, we had him on yesterday. That is very much in line with what he said. And it's very interesting to see that side of things. I wanted to contrast that before we start hearing from the panel. Wanted to contrast that to the other side of the aisle, who were all over corporate media today. And I'm going to pull that up. This is from The Hill. The title is actually kind of interesting. It said, "No appetite." So the lawmakers are in consensus on opposing potential Silicon Valley bailout. This bailout word is becoming very, it seems like it's coming out quite a lot from both sides of the aisle. So, they talked about what we've talked about, which is Janet Yellen ruling it out, repeating the words, "Let me be clear that during the financial crisis, there were investors and owners of systemic large banks that were bailed out, and reforms have now been put in place, which means that we're not going to have to do it again." And then Bob Menendez from New Jersey said on Meet the Press that he's not ready to offer Silicon Valley Bank a bailout by any stretch of the imagination. We have to see he said, we have to see exactly everything that is pertinent to the specific set of circumstances and to see what else is out there, if anything else is out there that we should be thinking about. And then they go into, Nancy Mace of South Carolina sort of says the same thing. But the interesting one was former Speaker Nancy Pelosi from California reportedly said at a South by Southwest panel, and this is crazy because for anybody in the VC world or anybody in the investor founder world, we are going through South by Southwest right now, which is one of the biggest events. And all of these founders with all of their money stuck are sitting on panels talking about this. This is kind of, I hope people can get some of those videos up. It's a crazy thing going on in Austin for people that are not aware. And on a panel, Nancy Pelosi at South by Southwest said that she doesn't think there's any appetite in this country for bailing out a bank, and that she hopes instead for another bank to buy it. Fascinating. I think it's really interesting. The sentiment across the board is quite grim. Jay, what are your thoughts from hearing that?
Sure. So there are so many things to unpack there, and I've been multitasking at the same time. I will say that there's some breaking news that PNC and RBC are no longer interested in buying SIVB. They're two of many suitors that
did they
were
give
looking at the bank. And the second part of it, when you were ascribing, when you're quoting Fox News, which, by the way, the commentary and the lack of education from some of the speakers, bringing in social media personalities and musicians to talk about the Federal Reserve, I just caution a lot of what they're saying. I don't think it's actually it's Trump's fault, and I don't think it's Biden's fault that SIVB collapsed today. Just want to reiterate that it's the CEO Beckett's fault for not hedging rates. It's also not the Fed's fault because they had to tighten the economy at some point. You can't have it both ways. You can't say, oh, the Fed kept interest rates so low for 15 years and then get mad at them when they actually raise rates. They could have easily hedged. And the second problem is with, Peter Thiel, that essentially forced a bank run. Now, I will say that if this was a systemically important bank and it was, category 2 bank versus a category 3 or 4, that they would have had to be part of the stress test. And I think whoever mentioned that earlier is 100% right. And I think for all along, I think what I've been saying this morning is several times that you could essentially set up an insurance fund where it's privately funded. You actually don't need a bailout, and depositors can get made whole through a new insurance vehicle where you actually don't need a bailout. It wouldn't cost anything when it comes to how big the U.S. banking system is to create that vehicle to backstop uninsured deposits. So I think we're all making this a really big deal. It is a big deal, but I think that there are very easy solutions to this. And in 2 or 3 weeks, I don't think this is going to be a major issue.
So special, but like for example, now we had Vivek on, and he made a very articulate, concise argument, and his argument was through obviously what his ideology is, which is capitalism, and he was saying in a truly capitalist society, you have to let the free market decide, and essentially what you want is almost to beat China, you're trying to become communist. So I mean, his argument actually follows through with his philosophy or doctrine. So what would be your contention against him?
I'm sorry, could you repeat that? I didn't understand the question.
Okay, so Vivek made an argument that the bank should not get a bailout, nor should the deposit be recovered. And the reason for that is because as a true capitalist that he is, based on his own doctrine, you let the market decide. And that's what a capitalist society does, rather than governments coming in or whoever coming in to sort the problem out. So the issue is this, that his argument is that I'm a true capitalist and hence why I'm following my doctrine. You are becoming when the situation allows, despite not liking communist China, essentially following communist ideals in certain situations and scenarios.
In many ways, the Chinese economy is not at all relatable to what we're talking about today. I will say that he's probably not a full capitalist, because if you were a full capitalist, you would give back all the money that you benefited from all the bailouts in 2008, and the fact that your S&P 500 portfolio has tripled over the last 15 years. Okay, you didn't want any of that money? Great. You can give it to me. I'll take it. The U.S. economy is not a pure capitalist economy, just like we're not a pure democracy. We are a republic, and we are a hybrid capitalist society. If you think that after the Great Depression that we were a full capitalist society, you haven't looked at economic history. The entire reason to set up the Federal Reserve, the entire reason of setting up the FDIC, the entire reason for setting up healthcare the way that we have it, the entire reason why we subsidize government contracts for defense and are the strongest military in the world. There are certain parts of the economy that are utilities that need some support from the government. That doesn't even mean bailouts. It just means someone to organize all of the banks in order to put money into a new insurance fund. Just like I would have loved the government to essentially get all the VCs with $500 billion of dry powder and say, hey, assholes, you forced all your customers to bank with 3 banks, Comerica, SIVB, and PacWest, and you concentrated all the deposits in one area. It's your fault. And then you guys created the run on the bank. Why don't each of you contribute 1% of your dry powder, or $5 billion, which is not a lot. You guys are promising your investors 2 to 3x, which is 30% IRR a year. So you can take 1% of that money, put it into an emergency fund so that the public doesn't have to bail out these guys, and you can essentially backstop all the letters of credit from SIVB to the public.
So I want to take the mic just for Danish, if you don't mind. So we talked a few hours ago about a piece by the Washington Post regarding federal authorities considering safeguarding uninsured deposits at Silicon Valley Bank. And that was from anonymous sources. We got Jeff. Jeff, pleasure to have you. I'd love you to introduce yourself and give us your thoughts on where we're at right now and anything you want to add to the discussion, and then we'll have a few questions for you.
Hey, thanks so much for having me on. Obviously, it's been an incredibly fast-moving situation from Friday. Yeah, and thanks for shouting out my reporting. I really appreciate that. I had a story today with a couple of colleagues. We have about, I think maybe 4 people now with direct knowledge of internal government talks who are saying that there is this conversation now going on between Fed, FDIC, and Treasury officials about can they insure, essentially retroactively insure the uninsured deposits. Obviously, this would be a massive, massive step, fuel a political firestorm. I think it's pretty clear from everyone we've talked to that the hope remains, both among Democrats on the Hill and people in the administration, that a buyer will come and at the very least mitigate the urgency or need to do, to take a step like that. The other thing I should mention here is I want to stress as much as possible that we don't believe a decision has been made to go down this route. And also that even if this is a route that, let's say, the senior political and economic leadership in the Biden administration does think they need to pursue, it would likely require approval of 2/3 of the FDIC board. There are 2 of 5 members are Republicans who, this is speculation, but it's unclear, at least at a minimum, whether they would be open to this kind of extraordinary expansion of government authority. I think it's worth keeping in mind, obviously, that even if the relative number of uninsured deposits that need to be made whole or would be made whole by potential federal action is not that massive at SVB alone, it would set the precedent that in similar future circumstances, the government's either FDIC fund or other Treasury backstop monies are responsible for assuring uninsured deposits, which would, I think, don't quote me on this, but something like double the existing insured deposits pool. So I've blabbed on for long enough. And
well, Jeff, I wanted to start with taking us back a little. I saw your tweet about 5 years ago. You had the story on that regulation that now, for some reason, Jeff, everybody's talking about, right? Which is the rolling back of Dodd-Frank. At that time, you had interviewed Senator Bernie Sanders, and he was livid. I mean, I can read what he said in your tweet, but in your original article. But, at that time, there were some people that were crying foul. Do you think that has played a big role in what happened to SVB? I know we've heard all these different reasons why this happened, but do you think that the rolling back of parts of Dodd-Frank led us here?
I will say that it is too soon for me to feel like I can confidently make a judgment of that. I just don't know enough about exactly what transpired. What I do know is that there's a lot of smoke there that reporters should be digging into. I think it's pretty well established at this point that SVB was clearly pushing for this deregulation, and moreover that they fall right in the category of the bank that was deregulated in part by that bill, and also that federal officials were extremely late to catch the really tremendous amount of volatility in at that bank last week, and questions about why they were not alerted to the fact that their treasury bets were going bust, and really imperiling the sort of financial stability of the bank. So again, I have heard a number of experts that I really trust that are saying, this is a proof, not just Bernie Sanders and his allies, but people who are more in the center of the political spectrum, if you will, on these kinds of issues. But, it's certainly worth evaluating.
Yeah, if it's Dennis Neal, guys, if I could just step in, I so hope that Washington can avoid politicizing this current crisis and instead work on a solution, right? Because let's remember that Silicon Valley Bank put money into government securities, government treasuries. Okay, that wasn't something that was allowed by deregulation that never existed before. So the deregulation fight has nothing to do with it. If you want, look at the regulation that came in after the 2008 meltdown, where they said you have to put it into safe government security. So it's not about that. They just put it into the wrong place. But Jeff, you said something. I needed to make sure that I have this wrong. Did you say that the talks for insuring a larger portion of the cash deposits, larger than the usual limit, did you say the talks are only to double it from 250,000 to 500,000? That would be, or
no,
did I just not hear that?
I don't know where you heard that.
Oh, good. Okay, thank goodness.
What I was trying to say.
Something about double.
Hold on, this is an important point to clarify. What I was saying is that my understanding is if this was to go through, and let's say that we establish the precedent that the FDIC picks up all deposits, bank deposits that are currently uninsured, it would amount to effectively a doubling of the existing pool of insurance deposits that the FDIC is responsible for.
Nationwide. It would
nationwide,
just
correct.
That one bank double that sum. I see. Okay.
Yeah. And so,
Thank you so much.
talking about this, and kind of walking through the timeline of it, we went all the way back. Now we're going to come a little bit fast forward. There's been a bunch of information that has come out around the actions, what led to this crisis. We talked a lot about this yesterday with the Moody's, the downgrade warning, that downgrade warning then leading to a scramble, the scramble then leading to action and meetings, those meetings falling through, FDIC coming in, taking over. And after FDIC came in and took over, all of this work starts. In your reporting, there was a very interesting, or in the reporting from Washington Post, there was a very interesting quote that you highlighted, which was that the Democrats said that they were praying for a buyer. This was Brad Sherman of California, member of the House Financial Services Committee. And then my favorite line: big buyer, small buyer, fat buyer, skinny buyer. We need a buyer. That's one of my favorite
all
lines.
buyers to
ever.
the dance floor. Yeah,
that's right. What happened? Why has Jay just special situations? Jay just mentioned that PNC and RBC are both off the table reportedly. So why have they struggled to get a buyer from your reporting?
Man, that's a good question. I don't really have much more beyond sort of people outside that process, unfortunately, and I don't want to speculate too much. My impression.
It comes down to merger accounting rules, but go ahead.
No, go ahead.
So when you have a merger, you have to fair value the assets. And one of the biggest issues when you have a merger with a firm that has a $15 billion plus hole, in my opinion, probably closer to 20 to 25 billion, given the duration of the MBS, that you actually have to market those bonds before the acquiring company can take them over. So the acquiring company is now responsible for that loss, is responsible for the unsecured bonds, is responsible for tens of millions of preferred shares to cover them. And at the very end, probably has to give a hat tip to the equity in order to take over this business. And even if they don't, I just think that the check that these banks have to write is much larger than the market cap of the company at the close and pre-market on Friday. So the actual check is a lot higher than people think it is. And I think that's one of the reasons why, PNC and RBC might be backing away.
And so, as this happens, Jeff, what is the sentiment, from your discussions? It seems like the sentiment is cautiously optimistic. I don't know if that's how you would describe it. What is the sentiment about a potential buyer or what they will do instead? I mean, you quote tweeted Sam Altman saying that the FDIC is currently reviewing the, covering everyone's deposit. Yeah. Is that realistic, really?
Yeah, I mean, no, I wouldn't have written that tweet or that story if I didn't have really solid information that is a live thing they're looking at. Again, I think there's still hope that we get to Monday and this is, with the Bank of America and it's all over. But I wanted to go back to that Sherman quote because I think it speaks to the impossible situation that congressional Democrats, particularly California Democrats, find themselves in, where they're simultaneously feeling immense political pressure to prevent the contagion from spreading, from layoffs from hitting the firms that were dependent on payroll processing at this bank, and sort of the economic fallout. But they are equally, maybe not equally, but they are also really skittish about, touching anything within 30 miles of the word bailout. And so the only solution that gets them out of either option is a buyer. And you see that desperation in that quote. And they will run up and down screaming as much as possible that if you say that the thing is not a bailout, then it's not a bailout. But I think, our job is to not, if there is special federal assistance, financial assistance to a private company beyond what the law, previously stated, it is hard to avoid the conclusion that it might in fact be a bailout.
And you're talking about the optics of this. What about the optics of the fact that it's called Silicon Valley Bank? If it was called, I've made this joke a couple of times, but if it was called Farmers Unions Bank, perhaps it would be a very different situation. Are the Republican side of the aisle struggling with that in terms of, different options that could be on the table?
Yeah, I was talking to a Republican who was like kind of sort of marveling at the political challenge here. And he was like, the only thing worse is if they literally called it First Woke Bank of America. I think that is super reasonable. But I also think a lot of Republicans would have an objection to this for other reasons. They don't want to invite the regulation that would ensue from any special federal assistance, right? Like the FDIC, when it was first created, was opposed by Republicans, not because they didn't believe in financial support for the banking system, but because of the strings that come attached with it. So
if I may add to that, Jeff.
Yeah, please.
This is Dennis, guys. A far smarter person than I has pointed out to me that if you remember, after the big TARP bailout and all of that stuff in 0809, here Jamie Dimon and JP Morgan Chase and other banks, they stepped up. They rescued failing banks and helped cauterize the bleeding and stepped up. And what did they get for that? They get called before Congress and railed by Elizabeth Warren and the Senate and you bad guys. And now look, already, as Jeff has pointed out, people are saying, we're not going to bail them out. These are rich people. Never in mind that's 1,000 startups, vibrant startups who want to meet payroll. And I just think that's unfortunate it's shaping up that way, because maybe the banks are afraid to step up because we don't want to be held up for ridicule for taking over this bank like we were last time.
It's much simpler than that, Dennis. The Republicans don't support the bailout because they know there will be a strong market reaction if there is no bailout. So they can shit on the Democrats for having caused that. What I think is happening here, the U.S. government realizes how important it is to restore confidence immediately to prevent a market crash on Monday. And the first Yellen statement was so wishy-washy that, I tweeted and said, this is going to cause a crash on Monday. And now you see news following up this first interview, now suggesting there may be a full bailout of deposits. And if they are not doing that, they will have a bloodbath in the markets on Monday. So I think there's a really strong indication now that they will step in and fix this.
Yeah, what is the thought, Jeff, on the contagion risk that exists of, this initial bank run leading to multiple other bank runs?
Yeah, I'm not saying anything you guys haven't heard before, but I think the government officials I talked to are quite concerned that the similarly situated banks will see customers fleeing for the GSIBs as soon as Monday, and are hearing reports of that. And I don't think anyone thinks that we're on the precipice of 2008, but the potential for these dominoes to fall and for something that seems contained to first spread to 3 or 4 other banks. I don't know if there was a chart going around that showed the number of banks that had seen their stocks collapse by 15-20% at the end of last week. Though there are, a handful of banks that seem kind of obviously like the next vulnerable targets here. And if those are really shaky Monday and they don't have a buyer, it's a pretty fucking scary situation. I think I've never, my first time as a journalist covering this, but it doesn't seem like a fun environment.
It's nowhere near as scary as 2008 was. By the way, I couldn't sleep.
I agree.
I couldn't sleep at night in 2008.
Yeah, right. 08, 09, when I was on CNBC covering, that was the first time in my entire career of 20 years or more covering business that I was truly afraid. And yet we came out of that. We came out great. And the other contrast here is, let's remember.
Do you remember their $200 ATM limits in 2008? People aren't talking about how bad it was.
I mean, we had exotic dancers who were granted mortgages to buy 10 homes. Okay, we had speculation going like crazy. We had CDOs. This time around, it's because the big banks have run up. It's $162 billion in unrealized losses in their government securities that they were pushed into buying as higher quality reserves after the last meltdown, and now they're getting bit in the ass by it, and yet it's not the super high yielding crazy stuff.
Can I ask? I mean, I'm curious to what extent you guys think the fears of contagion are self-motivated by people who have a direct interest in preventing the deposits.
Everyone has a bias in this. There are people who are long equities. There are people who are short the banks as of Thursday and Friday. There are government officials that want to grandstand if the market falls. There are government officials that want to applaud if this is solved. So when anyone speaks, including me, we all have a bias. Is the first thing that everyone should know on this space, and evaluate everyone's biases as they're speaking.
Well said. Hey, Mario.
Except for us, we have no biases ever in anything.
Yeah, exactly. Not the one.
No, I have biases. I love America. I'm a citizen.
You guys act like this is the only group that took out a bunch of 10-year treasuries that have unrealized losses.
No, it's 600 billion of AFS and HTM across the banks, but it's mostly the very large banks.
What about the $20 trillion of commercial real estate that's been purchased in the last
the 21 trillion of commercial real estate, 40% of which is office and malls, isn't a big issue. And we actually talked about shorting the CMBX BBB and how Icon is short the CMBX BBB 6 series. So there's a lot of coverage on the real estate situation, but that's going to unfold over the next 3 years. That's not going to unfold tomorrow.
And Jeff,
right, but I'm just talking about the fear of fear.
Grant, your audio is a little muffled, just so you know.
Yeah, I actually got to run back to reporting. So thank you guys so much for having me.
Enjoy, Jeff.
Thank you. Really appreciate it.
Really great job.
I appreciate it, guys. Have a good one.
Thanks, Grant and Wahid. You guys, I think we're speaking. Yeah, go ahead.
Grant, your audio is a little muffled.
Yeah, is that better?
Yeah, much better.
Yeah, sorry about that. So, 2008. I mean, we haven't. This thing hadn't completely unfolded yet either. So to compare this to the fear of that Monday is probably not fair. And this could be the first signs of what we all know from both sides, left and right, from Kim to people more conservative with have more hope in the U.S. economy. You guys all know we have problems, and they're not getting better.
Everyone has problems. Everyone has problems. We've always had problems.
I agree with that.
The media has made the problems a lot worse than they seem. And across the world, I will tell you that the problems in China and Russia and Saudi are a lot worse than the problems we have in the United States today. I can guarantee that.
Right, and I believe that. But I just know that, at least from my commercial real estate experience, there's a lot of debt out there that people are having to confront today, where 80% of their portfolios, huge exposures to adjustable money, that if that money doesn't get cheaper, it will not be able to be recapitalized at the values they have it on their books for.
Well,
that's 100% correct.
But the balancing point of that, if you'll forgive me, is that aren't there hundreds of middle range, mediocre, not great companies that were able to refinance debt at zero interest rates, and they've been walking dead and not really growing, and they're out there and not going anywhere, and yet they were kept alive by zero interest rates. And now that rates are going to 5% or 5.5%, maybe that separates the good ones.
That's true. But during COVID, the high yield maturity wall of the triple B minus and BAA3 companies was pushed to 2025. But with real estate, none of the banks were willing to push out their maturities. So commercial real estate is a bigger risk than zombie companies, although we can have an entire space on zombie companies. I have a list of over 180 of them.
Okay, you clearly know so much more than I do, so I'll just ask a question, though. Last time around, I remember we saw the big housing crash, and we worried on CNBC like crazy that the next thing to crash is going to be commercial. And you know what? It held up pretty well, didn't it?
It held up because a lot of the banks were able to push those maturities out. But the commercial real estate crisis is much bigger. There are still companies from 2007, 2008 that should have gone bankrupt in commercial real estate, but because banks didn't want to take those losses, they pushed those losses forward. I don't think they have the opportunity to continue to do that. And there's several $100 billion of, like you said, of commercial real estate maturities. And we actually saw very big asset managers that didn't need to do it, but Brookfield, PIMCO, Blackstone, and Starwood in the last 3 weeks all walked away, essentially filed bankruptcy on debt and defaulted on debt, first lien debt at banks from large office towers in San Francisco, in downtown LA, and in New York City.
Understandable, though, right? Given the whole Zoom revolution and the
I wanted to hear from some new voices who have been joined and had their hands
thanks
up
so
for
much,
a long
guys.
time. Thanks, guys. Bob, thank you for joining us. Did you want to weigh in on what's been discussed?
I did. Thank you so much. I been listening for a couple of days, and I have a little bit different perspective. I have a very good friend of mine, Dr.
Bob, can you fix your mic? Maybe get it close to your mouth.
Yeah, let me just get off these earbuds. I think that's the issue. Hang on one second.
Perfect. Thanks a lot, Bob.
Yeah, while you're
in the meantime, Wahid would love to get your thoughts on this.
Look, I apologize. I got off a flight. Did you guys talk about the Fed window already?
We have in what sense?
Sorry, we'll probably get an announcement that they're going to ease conditions and just put out a statement, even though the Fed window has technically always been available, to try and encourage.
We have not talked. Okay. Love to. Could you kind of do a deep?
So Bloomberg
about tomorrow.
So Bloomberg just broke the story, right? They're going to put out an announcement to ease conditions for banks to get to the Fed window, right? That's basically they go and they use the swap lines there and they post the collateral, and it doesn't technically. There's a lot of leeway that you don't have to market it the way you have to liquidate securities in order to shore up your balance sheet. Here you could just post the collateral and then use the swap lines to tap the discount window.
Wahid, could you share that with Mario and the team just so that we can post it?
Yeah, I think it's just on Bloomberg, right? So I apologize. I don't know. I'm really bad with technology, so I don't know how to do that. Mario,
Hey, I can speak now.
It's a headline from Zero Hedge.
What's that?
I'll look for it.
Bob, 1 second. It sounds like there's some new news on the Fed.
Yeah.
So just give us 1 second. Did you have something to add on that?
But the only thing I'd say is that is significant. There's no bloody way they're going to do that and panic and raise rates as aggressively as some had feared in the last week. Maybe they squeak in at 25. I wouldn't be surprised if they just halt. All that will be synchronized. So I think, unfortunately, you want to stop panicking when the regulators panic. That's the saying. And we're seeing a lot of people panicking now, right? Fed, FDIC, Janet Yellen. I don't want to say that's a good news, but it's reassuring that they're panicking early this time.
Okay, and we're just looking through the
So
article.
I've got the story. Yeah, I've got the story. Let me read it out quickly before you go speak about it, Jay. So Danish, I've sent you through the link if you want to post it in the above for everyone. Fed discusses easing access to discount window to help banks. Such a move would help banks meet any demands for withdrawals. Some banks already tapped discount window after Silicon Valley Bank collapse. So
this is a big signaling deal. It's not so tangible, but there's always a fear of looking bad when you actually approach that window. But it's something, and people don't have to actually cower to sell their securities for sale. They can just post that collateral temporarily, and especially if they ease the conditions.
Yeah, actually, Silicon Valley Bank had 55 billion of securities pledged to the Fed discount window. If they ease the conditions there and lower the cost of doing so, they could provide a lot of capital to banks that have securities, and they could pledge them through the discount window.
Can someone walk through the details of the discount window? I think the average person, we've got something like 16,500 people in the room. I bet you.
Yeah, Wahid would be great at this.
Yeah, Wahid, can you walk us through how banks actively use? And Bob, just give us a second. Sorry, with his breaking news.
I know, but I have all the answers you guys are trying to get. I've been trying to do it for 2 hours. I told you guys about the discount hour 2 hours ago. Okay, go ahead.
All right, Bob. Go ahead, Bob. Can you describe the discount window for us and how these banks could
I'm
use
a
it?
43-year veteran in the markets. I was an institutional trader in the 1980s when Volcker was raising rates like this, and everybody's talking about this never happened before. I'm laughing. Dr. Jim Baker and I, we had a conversation. I can't mention names that were on this call, but going back to Penn Square Bank and that failure, Jim was head of the American Banking Association, ex-professor. He's the father of asset liability management. If you look that up, it all is about exactly what's happened. He actually wrote an article 4 months ago about this exact event that's happening today. So let's talk about the discount window. The discount window is exactly what Volcker did. They did it bank by bank basis, and all this talk of bailouts and all this stuff is just ridiculous because this should SVB should have never failed. This was a panic by probably some amateur folks on the regulator side in California. FDIC came in. I think there's a conflict of interest that's very clear because Greg Becker was a director of the San Francisco Fed, for God's sake. So I think what happened is they panicked, they got caught, and they didn't do the right things. All they had to do was when all the VCs and Theo and all these guys pulled their money out, all they had to do is call the Fed up and say, hey, we have a liquidity issue. Can we go to the discount window and just fill this gap? We've got plenty of assets. We got good quality assets on the books. And the Fed should have said, hey, no problem. How much you need? 1.7 billion, whatever the number. And it was done. And this should be the case going forward. And this is just what the Fed said. And I've been dying to get on here. Thank you so much for finally getting me up here. But for hours, I've been tweeting and telling everybody, this is the solution. And this takes away the moral hazard. This takes away the entire conversation for 20 hours that's been going on in this stream about all this speculation and stuff. So I think this is probably what's going to happen. There'll probably be, since they've already taken the regulatory steps toward closing the bank and everything they've done, they are now stuck doing some of these other things. But I'm sure that we'll hear soon that there's somebody has stepped up to take on these assets. Some bank, whether it's JP or whoever steps up, it really isn't going to matter. But I think this discount window, this takes away all this contagion issue, and you do it bank by bank by bank. And let's face it, this whole deal at SVB is a joke. It's a tiny little problem that came up that if it would have been handled right, we wouldn't be, I've spent my whole weekend trying to figure out what's going on. I would tell you, we manage about $15 billion in equities. And I'm going to be live on my own channel here in a few hours, and I've got to have answers for our institutional clients and other people as well. So we, as somebody said, we're all talking our book. We are all talking our book. But the information, I've heard a lot of talk about 08 and 9, but nobody's going back. And this is one of the things I've been talking about for a while, is that too many people are narrow focused on what their experience is. And Jim Baker always says, he goes, I've been around so damn long, I get to say what I say because I was there. And I was there as well. I was in the Treasury bond pit in 1979. And, it was crazy times with what Volcker was doing. So we have seen something really substantial, even to the point where Volcker raised rates so fast that the money market funds were trading under par. And that really panicked people. I remember seeing lines in front of banks, people getting money out back in the old school days when you'd go get a check and actually get money. But just as far as the discount, real quick, and I'll finish. I know I'm babbling on here. But okay. I want to bring in a little bit different perspective because there's a lot of solutions other than what's been talked about for 2 days. There's so many, and they're very easy. And it's interesting that Jim and I were talking earlier. We had a little consortium of folks, and I would tell you that we all figured this out. This is all they have to do. And it's a very simple fix, and all this stuff goes away. And I always have a feeling, I'm sort of a contrarian, but when things get so loud that it seems so obvious and all this stuff we talked about, then the opposite, something different has to happen. And so it'd be interesting to see how the futures open here in 30 minutes and see what kind of other announcement, but that's all they probably had to do. I wouldn't be surprised if there's a bid in the S&P futures when they open and everything that comes on. But I really want, as far as the discount window, it is the solution.
Well, there's a spread bid.
Yeah, go ahead.
No, I was just saying the futures are up. There's a spread bettors in the UK that do a weekend market, and they're up sharply. And the currency markets, it's a risk-on profile right now.
Perfect.
The dollar is weakening.
Wahid, one question I have for you is, you know,
by the way, did anyone explain how the discount window actually works?
That's what I'm trying to say. That's literally what I'm trying to get to.
Let me do that very quick. So basically, the New York Fed, okay, I'm going to keep this very simple, but the discount window is a feature of the New York Fed where any financial institutions regulated, right, can basically post collateral. And there's 3 different ways to do this, 3 different kinds of loans. I'm not going to get into that detail, but they're generally short term, okay? And you go and you post your collateral, and then you basically get a line of credit. Now, by easing, you get to do probably a lot more and a lot easier because there is something that says you got to be a sound bank, right? So by easing, there's probably the 14 banks that Janet Yellen is quote unquote worried about. They will be invited to go to the discount window and post a lot more collateral than they usually would for a lot longer and get a credit line. I will say that the discount window has always been available, but you probably could not have posted enough collateral to do another 45 billion of deposit out.
Well, also the cost of capital is going to fall, right? That's the biggest thing, right? These banks all have NIM. So if you're able to put $100 billion in the discount window and pay a lot less than you were able to pay last week, it's going to incentivize a lot of these banks to do that.
Do you agree with
I mean, there is a stigma, but now by them going public and saying, encouraging banks to do that, that will relief. But I don't think it's everything. So I disagree with Bob. I think it's a very important move, but you do need to stop the run on savings and loans banks. And so some form of FDIC blanket, even if it's temporary, is very, very
and
essential.
I actually agree with you. I agree with you.
I wanted to add one thing, and Bob, I had a question for you. And yes, to add to the discount window, the banks that do go use that facility, it is made public. I don't know how quickly it is, but my question to you, Bob, I have a lot of experience too, not quite as much as you, obviously, but when the Fed announces a move like this, like easing the conditions to which banks can go to the discount window and borrow and maybe post different kinds of collateral, is that sort of a window into how they're going to act at the next meeting, like maybe not raising rates or maybe just a quarter point? What are your thoughts on that?
My thoughts on that are sort of mixed, because I feel like if some of the things that were discussed earlier, if the Fed came and said, hey, we're pausing everything, no more QT, we're not going to raise rates. In fact, let's drop them a quarter point. I think the equity markets would plummet. All that would do is emphasize how screwed up everything is, right? So by what they're doing, I think I think they still do a quarter of a point. I've got a terminal rate target about 550 on the Fed funds. And as far as I'm concerned, I think they still go there as long as they, and you're right, I forget who it was who was talking about the FDIC. Now that they've made this move, the FDIC absolutely has to be part of this, and the regulatory entities are there. But I think this could have been avoided initially on a simple phone call. The only thing I could figure out, there was somebody panicked in San Francisco Fed that there was some kind of conflict. That's speculation, and that's tinfoil hat a little bit. But the bottom line is something there that this should have been really easy to do that. And even if they did a one-off, like, hey, we need to make an exemption, just like what they just did for this bank, none of us would have spent our whole weekend doing what we've been doing. I had a whole different weekend planned, right? We've got a lot of money at risk and a lot of things. So as many of us on this call, we have to do what we do. But I don't think that they change much. I have been very hard-coded here as far as the Fed's going to continue to fight their inflation. And if they can stay on that track, I believe they do. If they pause, if they don't do a 25, I think the messaging could be kind of interesting. So we got a long ways between here and the 21st, right? So it's a long run, a long runway.
We'll probably get a leak from Nick over the Wall Street Journal tomorrow because there are in the blackout. I do want to say something that's not tinfoil at all. There is a reality. Janet Yellen was the San Francisco Fed, and the person who runs the New York Fed, John Williams, came from San Francisco as well, from that central bank. And I don't think it's crazy to believe that a lot of the banks there are making phone calls to people they know really well.
They have Beckett's direct line. They're talking to him in real time.
I'm sure of it.
Yeah. So they know this,
absolutely.
Right? So there is a leaning tilt that is friendly, right? It's not as hawkish as you would have otherwise think. I mean, the two people that matter a lot are from the San Francisco Fed.
Absolutely.
So I wanted to invite introduce Mark Cohodes. Thank you for joining us. Wanted to make sure that we let you weigh in on, obviously the whole world has changed in the last hour with this discount window thing. And again, it's starting to become obvious that the Fed is going to take significant action to prevent bank runs. Do you think that they're doing enough? Are they doing too little? Doing too much? What are your thoughts about that?
Danish, just to add to that, like Mark came on yesterday and it was quite surreal because at the beginning of the stream or the space, everyone had one position of view, and when Mark came on, the entire space changed. So I think Mark's got an alternative view to everybody else, so it'd be good to hear.
Yeah, Mark, would be very interesting hearing.
So, I was just riding horses. So I still think someone buys Silicon Valley Bank for very little. I said that last night. I continue to believe that right now. This discount window, I think the Fed and the FDIC are just a complete mess. They created this mess. So this is sort of more of a mess. Short term, fine, you can hit the discount window, the sickest banks. But the caveat to that someone's not bringing up is the Fed's going to force these sick banks to raise equity, to raise, the money that they're in the hole on. So you may be able to hit the discount window, but they're going to dilute the living crap out of their shareholders. And that's part of the dirty little secret that people don't know or have yet to kind of factor in this thing. So I don't know. I think this entire situation is a mess. I think it's been a shit show at every turn. I think this SIVB could have been prevented in the way that it was. I think the government and Thiel and all his Silicon Valley pals created this mess. And now the government, in true government fashion, tries to clean it up. But, you just create more and more zombies. So they're just sort of kicking the can down the road. I would have rather seen something different to sort of isolate these zombie banks and have less of them and let the good guys prosper. But we'll see what happens. I think the holes in a lot of these banks are going to have to get filled through raising equity. And I think hitting the discount window, in the short term it may keep
keep banks from having bank runs, but it's not bullish for the bank. It's not bullish for the equities of these banks. I think the strong will do better. I think the weak are going to suffer.
But doesn't the strong here represent the biggest? I mean, isn't that kind of what would automatically happen? I put myself in the situation of somebody that's working with a small community bank. If I'm constantly thinking about going to the strongest bank with, and especially with a rational fear, it is a rational fear that could be a bank run. Wouldn't that automatically just consolidate all the power in the biggest banks?
Yeah, on some ways, yes. But the bulk of the people, either on this Spaces call or in society, 250,000, you don't have 250,000 in a bank. So this is really addressing the upper 1% of the 1%. I mean, most people.
Well, you're assuming individuals here. What about businesses?
Well, if you're a business kind of worth a crap, you should be banking at Chase, JP, Wells Fargo, Citi, U.S. Bank Corp, PN. There's a ton of banks here. I mean, I can't stand Canada. I mean, it's Arctic Mexico, and the place is the eastern branch of the CCP. But there, at least, they only have 5 banks. So the government, de facto controls 5 banks. Here, you have more banks than you have restaurants in this country. And the question is, when banks get as out of control as Silicon Valley Bank, these accidents happen. And they do it because they had a stock and everyone wants to get rich and no one cares about risk and everyone wants to live for today.
So, Mark, I'm just going to jump in very, very briefly. So PNC Financial Group has decided against bidding on Silicon Valley Bank as regulators struggle. So PNC is not going to be bidding on Silicon Valley Bank. CNBC just reported.
Okay, and markets just dipped on that. I mean, they didn't go negative, but they lost a little there.
Can I just say one thing? And I have to leave after this, so to be very quick. I went through all the constituent list. I am a quant primarily, and I went through roughly 265 stocks, primarily in KRE, which is the Regional Bank Index, and QABA, which is a First Trust. And I did this analysis for them, and about 60%, this is interesting, we'll see if it comes out, but about 60% of the stocks that I looked at, that every one of them at least looked like they were going to rebound from what they did on Friday. So all of this stuff was being driven down, the hedges and everybody the algos were all over the banks. We all know that, selling. But it looked to me that a lot of these things were pointing out. And when we had our little private discussion several hours ago, one of the things that I brought up is that not all banks are bad because SVB went down. There are tons of really good banks. And matter of fact, some of the signals and things that we look at from our quant stuff, if you looked at them on Wednesday, you went, shit, this is a pretty damn good stock. I need to own this. Matter of fact, if I already own it, I should buy some more. And then Friday happened and it looks like a piece of shit. And then the reality is nothing fundamentally probably changed with a lot of these stocks. And these are the QABA and the KRE. Both are, there's a little overlap in those two indexes, but all of those are, community banks. The QABA is the Community Bank Index, and I think there was a total of 165 symbols in that. But I went painstakingly and researched every one of these damn things, trying to figure out if there was something there. And then Baker was out. He's the fundamental guy, balance sheet guy, because he's the asset liability management guy. And he has an article he's about to release on Seeking Alpha that's called the autopsy of Silicon Valley Bank, and he's going right through everything. So you might want to check that out. And he also wrote that article back. When Baker and I talked back in October, we had figured out that this depreciation in these bond portfolios were going to screw over every bank out there. So everybody, this is a systemic issue. I want to put that out there, but it can be controlled possibly through this discount window. And that was, I think I'm not because we came up with this earlier. I think it was a good idea, but I think it was the only idea that the Fed could do and actually keep some credibility without getting into this damn moral hazard. I know we had, I forget the senator was on earlier. Nobody wants to touch this damn thing because of 2008. And so I just want to put that out there that I did go through these banks, and there are a bunch of them I fully expect will rebound. And if the pre-market, we're going to have the open here in about 15 minutes on our futures. We'll see how they open up. But I just wanted to put that out there for you guys, and I'm going to have to take off because in about 2 hours
Thanks,
I got to
Bob.
be live. So
Appreciate
have a great rest of your space. I really appreciate you letting me up.
Yeah, thanks, Bob. Appreciate you jumping on. You know, Mark, on that note, on systemic issues and system level issues, are you concerned at all about the contagion effect? I mean, it sounds like you think it might be good to prune, or you're not worried about the contagion effect and how it could affect the entire system?
No, I'm not worried about contagion at all. I mean, there was William Cohn, my pal, he just tweeted something. It makes a lot of sense. He said, this is from Dennis Kelleher. He emailed me some serious wisdom late Friday night. He says, to me, the fundamental problem is that the Fed is trying to fix problems mostly of their own making while not admitting they had any role, never mind a decisive role, in creating those problems in the first place, which causes more problems that they have to fix, he wrote. Sooner or later, that leads to catastrophe. That's my point. You know, if anyone on this call, near or far, believes in free markets, this isn't a good thing. Now, contagion, like the only people who really complain about contagion are these fake VCs or people who made money on zero rates, who bragged how smart they were when they made, and now that things are a little choppy, are just begging for a bailout. It's just, look, it's just wrong-headed. The government's going to do what they're going to do. They don't give a rat's ass what I think, and it is what it is. But, you know, let the zombies go, ring fence certain aspects of it, and let the strong do what the strong do. And if there's less banks or less restaurants or less department stores or less taxi apps, it's not the end of the world. The problem is spending money to defend people who shouldn't be in business in the first place.
Mark,
they don't bail out hedge funds, I'll tell you that. And they don't bail out.
But in this situation, sorry, just to kind of play the other side, you know, in this situation, people, small businesses, similar to the ones that you've run, small businesses put their money in a bank. It was the 12th largest bank that was very connected to the community. And that bank, you know, put their money in government securities that were very, you know, it wasn't like they put them in risky assets specifically for that. For what caused this? What caused this was the long duration of those securities. And, you know, they did that. Interest rates went up. Why should those businesses and the employees of those businesses, you know, pay for, you know, if you're a small business and you work with a local bank, and especially a bank that, by the way, you know, my company went through Techstars, other people go through YC. These are people that are connected to these really well-established ecosystems. Why should those companies be the ones that pay here? It's not about merit. It's not about survival of the fittest. This is a 12th largest bank in America. We're not talking about, you know, a tiny little bank in Minnesota. No offense to Minnesota, but you know, we're talking about the 12th largest bank in America. You know, should they really be paying for this, you know, error?
So the bank itself is going to fail, right? The bank's failed. Now someone may buy them, and the small business can thrive or keep going. Great. My point last night, my point today is VC funds and private equity funds have trillions of dollars of dry powder. To your thought and in your spirit, any one of these swinging dicks can easily come in, create a new bank, bail out this bank, and help the small business. And I'm all for small business. I'm all for entrepreneurship. I'm all for doing things the right way. What I'm not for is bailing out asshats who screwed this whole thing up to begin with. And at a minimum, if you tap the window on this emergency credit or whatever they're putting out, you should also replace management and you should also replace the board, because your decisions put your bank in these bad straits. You know, no one tells these guys to invest long with rates low. You know, no one told Austria to issue a 100-year bond. I mean, people do things. Some make good decisions. Some make stupid decisions. But again, everyone on this call, no one's getting bailed out if you make a mistake. No one. The only ones who get bailed out, and it's usually the people who benefited from these fast and loose rates and cheap money, are all screaming poor today. And it's just hypocritical as hell that this goes on. It's just, it's wrong-headed. It's wrong policy. There's always going to be winners and losers, but that's the price you pay if you believe in a free market.
Well, I believe in a free market, Mark, but I don't believe in someone else's. Again, when you think about entrepreneurs, the last thing, Mark Cuban said this yesterday, the last thing that they're thinking, they were accounting into their risk, was a bank run. I mean, it was not even in the top 100. There's so many ways for a startup to fail. Bank run is not top of mind, but I understand your point of view, and I think it's about how closely do you stick to free market principles. Sometimes, these types of events happen and it's not nice and it's not pretty. But, moving forward, what do you think the Fed should actually do? Obviously, sounds like you're in favor of the discount window. It sounds like. What else should they actually do? Should they let it all burn? Should they say, hey, look, it is what it is. We'll see if someone buys these assets. And as these buys the different, we're going to chop up the bank. There's going to be multiple different pieces. People are going to buy it. As we get more money, we'll start giving people their money back. Is that how they should move forward?
No, I think if you hit the discount window on this plan, if I was king, first of all, let me digress. Anyone who talks about Silicon Valley Bank, my suggestion on your spaces or anyone, ask Cuban how much money he has in Silicon Valley Bank or his companies have in Silicon Valley Bank. Ask everyone who comments or asks for the bailout, ask them to disclose how much money they have in the bank, and then we'll find out what principles guide them. I have zero in Silicon Valley Bank. I could give a rat's ass about that place, and I would never, ever have a dime in that joint, just on principle. Now back to your question. If I was king, anyone who hits the discount window on this new plan, I would force them to raise equity to the tune of what they hit the discount window for. So if you need to borrow $1 billion or whatever, raise sufficient capital to keep yourself on sides to offset what you're borrowing, to get your company or bank fiscally sound. Don't, it's kind of a dual thing. Let it go.
They should raise equity, but one thing to know with the discount window is you have to give the money back. I mean, a lot of firms use the discount window as just a short-term loan. It doesn't mean that these firms are getting bailed out.
Okay, but here's my point. I agree. Short-term loan. Silvergate hit the discount window and they fell below requirements.
They have to pay it back, and then they shut down.
Exactly. So whoever hits the discount window tonight or tomorrow to offset deposits, we both agree it's a short-term loan. We both agree that their NIM is going to get destroyed because there's penalties to this. They're going to have to pledge assets. The assets aren't worth anywhere near what they're on the books for, and they're going to have to raise capital. The raising capital for a stockholder is going to dilute the living fuck out of
100%.
Okay,
100%.
So that is negative. So if everyone thinks that this is like a free ride, the equity they're going to raise is going to destroy the equity value of these companies hitting the discount window. So there's a penalty and a punishment to this. But
why is there a
good
penalty and punishment? Why do we want to punish banks? They were not investing in CDOs and synthetics. They were putting money into government securities. If they blew it and went too long term, here's my question, Mark, even though I agree with much of your ideology. If we could have saved Lehman instead of letting it fail without any expense of government, just with a promise of a guarantee, and avoided the meltdown that ensued, would we have done it? Should we have done it? You obviously must not think there's systemic risk, or do you believe there's systemic risk? Yes, and we should just let the system burn because they deserve it.
No. I think you're getting a little too aggro. I don't think that's the answer. I think you need to drink some water to save Bear Stearns and to save Goldman and to save Morgan Stanley, because they all were tits up. To save all those guys and let Lehman burn is kind of a, you pick winners and you pick losers. So that policy
it was because of LTCM, right? The only bank that didn't participate in the bailout after the Russian bond default was Lehman, and they all ganged up on Lehman at the end.
Well, that's fine, but that's again, depending.
I'm not saying it's right. I'm not saying it's right.
But if you're the government, it's not up to you to pick winners and losers. You have to have policy that's fair for all. So I'm not in the business of saying let it all burn. What I am in the business of is saying these zombies, whether you're a zombie bank, zombie retailer, zombie pharmaceutical firm, the zombies should burn. The zombies need to go. Because if you keep bailing out bad actors, that's what screws up the system. And if you work for a bad actor, find a better job elsewhere. I mean, it's just not all kittens and rainbows here, gang. If you work for a company that makes bad decisions, I mean, there's a lot of guys who are in the steel business who had to do something else because this country closed down steel mills, through no fault of employers. Or if you work for a fraud, you work for mimetics. Not everyone who works for them is a crook. But part and parcel of what goes on is people make mistakes. But if you make a mistake running a bank, an insurance company, a brokerage firm, you borrow too much money, you fail. People fail. And banks that kept loaning money to these venture firms that kept losing money, burning cash.
That's not what happened here.
That's not what happened.
What happened here at all. This is just they sold bonds because they had a
let Mark finish and then Dennis.
Okay. That's not what happened at the end. That's not what happened at the very end, but it was the culture of what went on there that got the thing so inside out. The end was not what was predicted. Well, look, okay. Peter Thiel caused a bank run because Peter Thiel was a huge customer of this place. What they did to Peter Thiel, I don't know. But when Peter Thiel, who's the Silicon Valley hero, says, I would advise everyone to pull their money from the bank, given who he is, that created the crack up. That created the crack up flat up, right?
Do you guys think that I can tell you they've not executed a transaction that Peter Thiel wanted to make, and it was delayed, and they didn't give him any answers, so he pulled out.
What was the transaction? It's really interesting. I'm interested because
it was just a large transfer that wasn't acted on. And when he complained, nothing was done. So he told everyone of his buddies that had money in the bank to pull it out and put it somewhere else. He got his money out, but it's interesting, how this all escalated.
Self-fulfilling prophecy.
Exactly. So that was the end. Okay. We can all agree that was the end. But there's a whole lot of mischief that led up to the end, including the management of this company not being able to touch their ass with their hands. And they had this fuck show going from the start. They were lending to wine guys. They were lending to everyone. They were allowing credit lines. They were saying, put into our VC fund. It was an out-of-control bank. And the regulators, when all this was going on, did absolutely nothing. I mean, this is an S&P 500 company.
But hey, Mario, just breaking news, just the markets opened and up around 0.4%.
Well, I would have
how any of this.
thought it would have been a lot higher than that. But anyway, to make this, to kind of try to simplify it for everybody, if I owned stock in a bank that hit this window, I would be out of it really quick.
I think every bank should go to the window. I think every regional bank should go together to the window so there is no stigma, because this was only to ensure them if there's a run on their bank and depositors want to pull out more cash than they have on hand, and then it can be paid back right after.
I honestly, I think you're out of your mind, but I think you should, whatever you do for a living, I think you should say, I think every regional bank should go to the window to do it. I mean, I think there's, it's kind of like steroids in baseball. If everyone's using steroids, why shouldn't I use steroids? Well, it's irresponsible, right? I mean, Ken Griffey never used steroids.
This is what the discount window is for. There should be no stigma. This is, a special situation. That's exactly what the discount window was designed for, isn't it? No?
Well, if they're,
I think
obviously happy.
They're going to have to give the money back, and they're going to have to raise money.
Right.
They're going to have to dilute their shareholders anyway. So it's a short-term fix. And I think, listen, everyone already uses it. There are hundreds of banks that use it already. So it's a short-term fix. They're going to have to raise equity anyway, is my opinion.
Can I hop in real quick and just to Mark's comments? Silicon Valley Bank is not the one choosing, what they're doing with their cash. They have a cash management team, probably works at JP Morgan or one of the big banks, that's choosing the duration of their cash and the bonds that they're buying. This was treasuries that they own. This wasn't, municipal bonds. It was treasuries. So that means that there is other companies in the same situation, not just banks. PepsiCo, Coca-Cola, they manage their cash the same way. So I don't know. There clearly is a bigger problem, and blaming the bank alone. What about the Fed? Raising rates as aggressively and quick as they've been is sort of the.
You can't fully blame the Fed. The management here was completely wrong. They didn't understand what a rate hedge was. It's like buying Fubo stock. It's like buying Fubo stock at like the top of the 2021 bubble, knowing that Fubo burns, several $100 million a year. Like he just needed to use some common sense and realize that rates were going up.
I agree with Special.
The management's not the one making the call, though. That's all I'm saying is, yes.
There's an important.
Are you kidding me? He's making the call. He's allocating capital of $90 billion to the mortgage bond sector. He's 100% responsible.
Man, the CEO is the captain of the ship. No matter what goes on, it's on him.
Okay, but the cash management guys.
What if just a second? What if the CEO of Silicon Valley Bank listened to what the White House told them when they said that inflation is transitory? Don't worry about it. You can buy government bonds.
Then he shouldn't be a CEO. He shouldn't be a CEO if he can't make his own decisions.
Then he's dumber than dirt to listen to the government or listen to anything the government tells you. The guy should make his own decisions. Special, I'm kind of liking you, Special. You're all right,
dude. I mean, it's his entire job. Like, what is his job? To allocate capital and to manage risk. If you can't do your basic job, why are you CEO of the bank?
Exactly.
When the government tells you not to worry about inflation because it's just a hiccup, it's not something.
Every single hedge fund manager on the planet knew that inflation was a problem before the government said that it was a problem. Everybody knew. Come on.
No, the point is the government didn't say it's a problem. It said the opposite.
It doesn't matter what the government says. The government's biased just like me and you are biased.
Because when the White House puts out statements like this, of course there are business leaders.
If the government said SIVB is fine tomorrow, would you believe the government?
Well, it's not a question of if I would believe it or other people who are educated about how often the government lies. But as a bank manager who has some faith in the government, and you can be sure there will be some of them.
Okay, why were the Federal Reserve members selling all their stocks in November, before November of 2021? You could look at what the Federal Reserve governors were doing and not what they were saying and make decisions based on that. Come on, you're telling me this CEO didn't know how to look at all those equity sales from all these big Fed governors that resigned right after?
Well, here's what's interesting about this whole situation with the government bonds, right? When the Fed was handing out free money for quantitative easing, giving them to banks at interest-free rates so that they can pump up the stock market and invest in, anything to keep the economy going. And then all of a sudden, we have a major inflation problem because of crazy money printing. They are now all of a sudden responsible because they were tricked into buying government bonds with government.
They were not tricked. They were bonds rallied.
Hold on.
Banks made a lot of money off
your
of
mic
it.
is muted. Watcher, your mic is unmuted.
So banks actually made a lot of money on this trade, by the way. If I was trading in a really big way when COVID started. It was originally short and then long. And when the stimulus news came out, it was signaled to everyone to buy assets, investment grade bonds, closed end funds at discounts to net asset value, and everybody made money. Now, if you're a moron, if you want to just keep that strategy going for 3 years in a row, and by the way, it's not like these guys bought bonds when the government told them to buy bonds in 2020. They literally top ticked the market 2 years later. This guy built up his MBS position last year. That's his fault.
Yeah,
at the end of the cycle.
What you don't seem to comprehend, just real quick, I'm not done. What you don't seem to comprehend is when the government is giving you billions of interest-free loans to prop up the markets, of course there's an expectation that you will then also buy some government bonds. So the way this works, the Fed prints the money.
What you're not realizing is they bought bonds 3 years after the fact.
Stop interrupting me, okay?
Stop interrupting me. What you don't realize.
All right, guys. I'll interrupt both of you. So, Kim, why don't you go? And then after Kim is done, Special, could you please respond? Thank you.
All right, very good. So here's the big problem with this. The US government gets the Fed to print money, right? The Fed then provides interest-free loans to major banks for quantitative easing, to pump the markets. And then some of the customer deposit money is invested into government bonds. So it's kind of a you pat my back, I pat your back situation. And now that the inflation is creating such a problem and the Fed has to raise the interest rates, all of these assets suddenly become toxic. And they are with the banks in the first place because the US government through the Fed provided free money to the banks to play with. So it's more than just listening to the government. It's a handshake deal where they both pat each other's back. And the losers in this entire scenario are the depositors who are now fucked out of their funds.
Can I respond because that was completely out of context? Can I please respond?
Go ahead, Jay.
Okay, so in April of 2020, obviously, there was a handshake agreement. BlackRock, all these banks, they all realized that the Fed was doing what they were doing, and they all bought corporate debt, they all bought MBS, and they all bought treasuries. SVB was not part of that initial group when they made the majority of those purchases. SVB collected $40 to $50 billion from venture capitalists over the last 2 years. And basically 2.5 years after COVID happened, they magically decide to not buy 3-month treasuries, which would have been a very reasonable thing to do. They went out and they bought 10-year mortgage bonds at the top of the bond market at 1.5%. The government did not tell them to do that. That is the most asinine thing I've heard today.
Why would they do that, Jay? Sorry, Kim, 1 second. Let me just kind of ask Jay, why would they do that? What is the reasoning? That's what
the reasoning
it makes
for doing this.
No sense.
is that this guy who is on the San Francisco board has no concept of risk management. If you open up any other large bank, I'm talking about over $200 billion of assets, they all have fair value and interest rate hedges in place. There are $500 million companies in the leveraged loan market that beautifully hedge interest rate risk with fixed to float options in the future, and using futures, using options, using treasury hedges, and they have almost no interest rate related losses. I'm telling you, the guy was a complete fucking moron.
Mark, do you agree with that?
You know, Jay, it's a good thing I don't like men, because you're really turning me on this weekend. I mean, you're a smart guy. You're spot on. You're dead right. Everyone should listen to this guy, because your view is bang on, bang on. I couldn't agree with him more. You know, people somehow get to these huge positions and they're just dumber than a bag of rocks. And that's what happened. And sadly, you know, the bank's going to fail, or the equity's worth $1 or 50 cents. You know, the thing I would hope is everyone learned something from it. And everyone learned something from this shit show, that, you know, smart guys should benefit and dumb guys should go out of business. That's capitalism. That's free markets.
Yes, sir. Nobody told him to go out and buy 10-year mortgage bonds.
What you guys are saying is, if the
Can I
US
say
government,
something?
if the U.S. government, right, makes recommendations to banks and not to worry about inflation because it's transitory, that they should just ignore that, right? That's what you're saying.
So, Kim, if I told you to buy Bank of America stock, if I told you to buy Bank of America stock in April of 2020, now 3 years later, and the stock's falling like 5 or 10%, I'm wrong? Are you fucking kidding me? It was 3 years ago.
Kim, where are you from?
I live in New Zealand. I don't know why that matters.
Well, because you don't live in the United States, and if you lived here and you have half a brain, you don't listen to the U.S. government on anything.
Well,
and if the government says, wait a minute, and if the government says if the government says,
look, I don't trust the U.S. government. Like, don't be an idiot,
so then why would you listen to them if they say there's no inflation?
So here's what you need to understand, right? All these people in the top executive of this bank were major donors to the Democratic Party. There is more to the story than what you're seeing right now. So if the U.S. government is telling these people who are in bed with their political party, right,
3 years ago,
to invest in government bonds because they don't need to worry about inflation, I think there's a bigger issue here, that depositor funds are being used to prop up the U.S. government, which needs money to send weapons to Ukraine and elsewhere.
Stop. And they're doing this through the Silicon Valley Bank? I mean, come on.
There's no tie there.
They're doing this through all banks. Just look at
Kim, clearly not all banks are going through this.
Look at the assets of all major banks and how many government bonds they're holding. Just do the analysis, and then you understand.
I think this is not a fair. Go ahead, Mark.
I just want to before anyone responds, Mark. Before you respond, just want to move on, guys. CNN is just reporting on the Washington Post story. They're adding. Hold on, Danish, you can't hear me. I think everyone can.
Can people hear me?
So the story, Mark, Danish, let me fix it up on your end. Hold on. There we go, fixed. All right, so American regulators are working through the weekend on an extraordinary plan to make Silicon Valley Bank customer whole after the financial institutions collapsed. So it's this reporting on the Washington Post story we saw earlier. If that does go through, if the extraordinary plan does go through, can we see things back? So Mark, I want to go to you. What do we see on Monday? What do we see next week? Could we see other banks fall, or could we see business as usual and everyone forgets about this in the next few weeks and months?
I'm one of those guys who is ready, aim, fire, not shoot, ready, aim. So I'll believe everything when I see it and read through it. So I don't know exactly what's going to happen next week. I don't know what's going to happen. I don't know what I'm going to have for dinner tonight. I just think that everyone needs to take a couple deep breaths, read and figure out exactly what's said. But all I really want to say in the message here tonight or this afternoon, wherever you are, is if you have to hit this window, your bank is sicker than you thought a week ago. And whether stocks go up or down or do nothing, I would not want to own a equity that's hitting this window. I would want to stay away from that and be in solid banks, because you're at a disadvantage if you do that, and you're going to have to raise a shit ton full of equity, which is dilution, which will hurt the price of your stock somewhere down the line. So you need to be very, very careful not to get whooped up into what the Cartoon Network, aka CNBC, tells you what to do. So I'm very leery of this plan.
So
KP, what are your thoughts?
Yeah, KP, go ahead. Sorry.
You're muted, KP.
Yeah, you hear me? Okay, great.
Yeah, man, we can hear you now.
So I get what both you guys are saying, and I think Grant said it earlier that, you know, if they even whatever they own, there's a ton of other. Before you guys interrupt, there's a ton of other banks and companies that own the same thing. But you know what I want to say again is I'm a former managing director at a regional investment bank. I know one of the largest cash management teams on the street. These guys run a managed account for these banks, for these Fortune 500 companies, and they're the ones selecting what to own. Now, if someone mentioned earlier, they own 10-year, they went out 10 years on corporate bonds. It's about the rating. It's A-. That's not unusual. So there's nothing, that points a finger at this company. I'm just going to say one last thing is, JP Morgan, on Friday, there was rumors they wanted to buy it. The stock was up 3%. All these other banks have said no. What does that tell me? They were probably running the money, their cash management team, and now it's a compliance risk for them. So there's a lot of underlying things that don't come out that are going to be worked out, but they're not going to let this thing just collapse where depositors aren't made close to whole. No way. So the risk of what they did and the clients they took on, that's a separate issue. They needed cash. They had a cash crunch, and they probably reached out to the cash management team. The CEO, the CFO called them. They said, hey, not a good time. Don't sell some stock, do a secondary offering.
Hey guys, there's breaking news.
What's that?
Yes. Go ahead, Wahid.
What is it, Wahid?
All right. So markets just absolutely spiked in the last 2 minutes, and CNBC saying the plan has been unveiled. So let's look at the plan.
Oh man, CNBC. Interesting.
Yeah, the futures just shot up 50 points, up 1.25%.
300 points to Dow, 50 points on the S&P. So let's see, what is it? Let's see.
US, I got a message. US says SVB, all depositors will have access to all their money tomorrow. Someone just sent me this now.
And that was really the only option they had, because everything else would have been a complete disaster.
Hold on, let's look into this here, discussing. Can someone share the story? So in that way we can kind of work through it on the back end.
I'm looking for the story, but all I see is Bloomberg headlines. U.S.
Banking regulators
U.S. says SVP depositors will have access to all money Monday.
I'm sorry, name redacted. Where is that from?
They're just Bloomberg
headlines.
Zero
Okay.
Hedge is putting them out. Yeah.
Right.
But if it's on Bloomberg, there's an article. I'm just looking for it.
Okay.
Okay, I don't know how to show. I'm going to read the CNBC. Banking regulators devised a plan Sunday to shore up deposits at Silicon Valley Bank, a critical step in stemming a feared panic over the collapsed tech-focused institution. The news came after Treasury Secretary Janet Yellen said Sunday morning that there would be no SVB bailout. We're not going to do that again, okay? But we are concerned about depositors and are focused on trying to meet their needs. The SVB failure was the nation's okay. There are also been discussion about the Fed stepping into ease. There's nothing new here. Nothing.
Yeah, I don't know what they're talking about.
No, I think you guys need to wait and see. The initial headlines are out.
Time out, guys.
There are 4 headlines that I just saw on the Bloomberg. The first headline is that the Fed is ready to address any liquidity pressures that might arise. Signature Bank closed today by state authority.
I got breaking news that's bigger than this.
Go ahead, Mark.
According to Zero Hedge, U.S. says Signature Bank closed today by state.
Yeah, they just closed. Just got the message.
Signature Bank is closed.
Signature Bank.
Signature Bank is closed. My
Yeah.
friend Mark,
They were essentially the
season
Silvergate.
has begun. I was talking to you. I was telling you,
They were
Mark.
just reading about it. Yeah. Jesus.
I was telling you,
fucking
Mark,
Christ.
the
Where are you?
contagion
It's
is coming.
Danish.
Well, Signature Bank is the piece of shit that was laundering money for bad actors, and I'm all over the place on Signature Bank. So that is a light. That is wonderful. Okay,
I remember that.
Huh?
It was the Silvergate and Signature Bank that were doing the Sen and the other crypto.
Right. So guys,
yesterday
I
it was
gotta
Silicon
go.
Valley Bank.
This is big for me. Take care.
All right,
I gotta
thanks,
go.
Mark,
Bye.
appreciate you. Thank you for jumping on. This is. I will let people know this is not me spreading FUD, as I've been told in the DMs, and not me. I mean, the things you all should read that come to my DMs. I don't know if it's because of my doc or whatever, but this is not about my concerns for contagion. Come from the fact that I'm based in the Midwest, and in the Midwest, which by the way, no one in the Midwest really knows Silicon Valley Bank from anything. And I've been hearing people saying, "Hey, can I put money in my community bank?" And that is the thing that's scaring the bejesus out of me, which is if the people locally are struggling and with this decision, I bet you that
It's closed. It doesn't say shut down. They're closed for Monday.
Zero Bank. Okay, so Zero Hedge says.
Hold on. I want to
word, right? So the bank run is going to intensify.
All right, guys. Can I get some information on Signature Bank?
Agreed.
What do we know? And if anyone has something, can they share this? Yes.
Yes, Signature Bank.
It's closed by the state authority. It doesn't.
What's the source?
Voluntarily closed. It's a regulator.
Source is Bloomberg.
That closed the bank.
Exactly.
Is that 100% confirmed?
Yeah, I just need
It
that
is
too.
confirmed on Bloomberg.
But shutdown is different than, closed is different than shut down. It just means they're not opening on Monday. They don't want people pulling their money because they're in the same business as.
Well, use whatever word you want. I think it's pretty clear what it means.
Sorry, I'm looking.
So,
Mario, I'm going to do a little.
Yeah, can someone give us more clarity on what that means? Yeah, what does it mean for Signature Bank to be closed?
FDIC through Bloomberg. The FDIC has closed Signature Bank by New York State financial regulators, and this was confirmed by the U.S. Treasury Department in a statement. All depositors will have access to their money from Signature Bank on Monday.
But then why did?
Can you? So okay,
They
so
failed.
hold
They
on.
failed. They closed.
And so.
All right, so special. Jay, can you read that out again, please, for the audience?
Yes. So this was Bloomberg through the U.S. Treasury, quoting the U.S. Treasury, and it's an article written by Ben Bain, Bloomberg reporter, that Signature Bank was closed by New York Fed state regulators this Sunday. The U.S. Treasury Department has confirmed this. The New York State financial regulators closed the bank. All depositors will have access to their money on Monday.
And there will be because no one will keep their money in a bank that has just been closed by state authority. And now it's not just a West Coast, it's an East Coast problem. And there will be more to come. You can be sure of that.
Well, obviously we're hoping that does not happen. I don't think that would be good for anybody, but this is what I was talking about, which is as the bank, we go from, again, there's some optics here around Silicon Valley Bank.
Right. This is not one of the best banks on the planet. Let's just put it in perspective.
But it sounds like
this is a crypto bank.
Again, I don't. Obviously, you're much more of an expert on banking than I am, understanding just the financial implications of this. But in terms of the behavioral implications, when you hear Silicon Valley Bank go down, there are enough shows on Hulu where they're talking about how bad Silicon Valley is. I think when you start talking about banks going down that sound like your local bank.
No, do you guys know what this bank does? Do you guys know what Signature Bank does? Okay, so Signature Bank, like Silvergate, is one of the biggest crypto depository institutions in the United States. This is not your mom and pop's bank.
Of course.
Okay, so just keep that in mind.
But again, for the average consumer doesn't
hold
know
on,
what this bank
guys,
is.
just quickly. So Danish, just check my DM. We've got Benzinga. Jason joined us. If you could tell us, you've got the press release with you, Jason. Jason from Benzinga. I think it's Jason.
By the way, US dollar 118 billion is the total asset size of Signature Bank. So that's not a small play.
Mario, I have the press release. It's from the Treasury. If you want me to go over that.
Yeah, please do. Name redacted.
Basically, it was a joint statement by the Department of Treasury, Federal Reserve, and FDIC. So the first part was addressing the Silicon Valley Bank, basically saying the depositors will have all access to all of their money on Monday. No losses associated with the resolution will be borne by the taxpayer. And then they move on to announce that it says we are also announcing a similar systemic risk exception for Signature Bank, New York, which was closed today by its state chartering authority. And all depositors of this institution will also be made whole. As with the resolution of Silicon Valley Bank, no losses will be borne by the taxpayer for Signature Bank. So it was a press release announcing that all depositors will be covered, and then also announcing that Signature Bank was also shut down.
Yeah, I mean, the big question is this the beginning of a contagion? And I know where some of y'all, KP, do you have a thought on this? Is this a part of a broader contagion?
So hold on, I have a question here for the crypto space. We had 3 banks. So we had, what was the one we interviewed a few months ago? Silvergate. Silvergate's closed down. Yeah. So now we have Silicon Valley, which is the big one that we all trust. Jason, I'm just gonna. So it's Jason from Benzinga's. Jason, yeah. Just want to make sure he's using the account.
Yes, it's
okay, cool.
It's Jason. I was just.
So we have, just Jason. Before I give you the mic, then we have Silicon Valley Bank, the one that most of us trusted. It was the biggest one, I think, for crypto. That one's closed down, and now we have the latest one, Signature Bank, closed down. So where does that leave? I want someone from the crypto space to come up, just tell us where crypto space is at, and then continue.
And Mario,
discussing
didn't somebody just say that when it comes to this bank, Signature Bank, it largely was for crypto? So most of their portfolio was related to crypto.
Yeah. I know. That's what I'm saying. Like for the crypto space, the 3 big banks that crypto uses, they all closed down. Let me see what crypto's doing now.
Well, the crypto market is ripping. Bitcoin's up 6.5%.
Yeah,
it's 7.5%. So there's no panic there on this. I mean, I think the main issue here is that deposits are all covered, right? So
yeah, I mean, if you're a crypto guy and you're going to get all your money back, well, that's great. The bigger risk was that this SBNY was just going to go to zero and people wouldn't get their money back on uninsured deposits.
Hey guys, just wanted to add that Signature Bank is also a VC, primarily VC bank. I know said crypto earlier. They have some crypto, but primarily VC, very similar to Silicon Valley Bank's model. So they're closest thing. So they're probably the second one to get hit. They were down 20% on Friday. They're trying to stop, that from becoming next, I guess.
And then KP and Jay, can you give us an idea of how serious is this in terms of a development?
Well, they have about 100 billion of assets. Everyone thought that these guys were going under based on what happened with Silvergate, that there was a decent chance that this was going to happen. And the fact that the deposits are all being returned probably is a sigh of relief, because there probably would have been a run on this bank this coming week. But the equity and the debt The equity in the debt are zero.
Announcement that came out. If you want me to go,
please,
into that,
if
the
you've got an
Federal Reserve.
announcement, please do. Go ahead.
So the Federal Reserve also, in conjunction with the release of the depositors being made whole, the Federal Reserve, if you go to their Twitter page, you'll see what I'm talking about. It says Federal Reserve Board announces it will make available additional funding to eligible depository institutions to help assure banks have all ability to meet needs of deposits. So they're creating this. This says the financing will be made available through the creation of a new bank term funding program, BTFP, offering loans of up to 1 year in length to banks, savings associate credit unions, and so on. So
yeah, I just
the press release is on their Twitter page. Yeah, okay, I'll put that up.
No, I just did
Yeah,
that.
send it through to me on WhatsApp. Cool.
So my question is this, based on what Dr. Danish also said. I mean, on Mario's thread, it said, in terms of Signature Bank, it fell by 23%, but then other banks are on the same level. So Western Alliance fell by 21%, PacWest fell by 38%. Yeah. So where does that?
Pacific Northwest. Hold on, 15%. I'm not gonna. Just to be very, very clear, we're not. If anybody in the audience is hearing any of their banks here, we have no information to be able to say that the bank is going to go down this road. I just want to be clear. We don't want to be the source of confusion.
100%. Yeah. We're just reading the data.
I interpret it different than SSR, special situations. I think it's a positive announcement. That's why the futures are up. That's why crypto's up.
Well, that's what we said on the when it comes to the depositors, it's positive. But the equity and the debt of this bank are white.
Well, hold on. They're saying that tomorrow, they're not opening the door so people can't reach money. But there's deals going on. This is, they have venture cap or private equity deals. So you can't not let them access their money. So you take it and you go to another bank with it. But Signature Bank is not in the same situation as Silicon Valley Bank. They're doing this so it survives. So, I think it means they're stepping in. It shows authority. And they're basically putting a safety net on the situation.
No, but
hold on, sir, man. So people sending me messages. Kraken, Coinbase put out an announcement. The exposure to Signature Bank for the crypto space is minimal as well. So depositors are assured, which is great, but as well as the exposure, it's not as big as I was worried. So there's just some clarity there.
Sorry, for crypto, what bank is the big bank now that supports crypto?
Let me see if Umbrella's here. He was requesting earlier. He'll have the answer.
Yeah, because
Umbrella, I know you are there. Yes, I'll bring him up.
Yeah, because it really does kind of beg the question about where is the relief here? I mean, and then does this tell us what they're going to do with the other banks?
So Umbrella, can you give us an idea for crypto? Who's left and the markets are ripping. So can you tell us a bit more what that all means? Umbrella, we can't hear you, so I'm not sure if can anyone hear Danish. Can you hear Umbrella?
I cannot hear Umbrella. He's connecting. While we're waiting for Umbrella, Matt, did you have any thoughts on Signature? I mean, we talked a little contagion earlier. Is this the beginning? And is now what should the Fed do now?
I mean, that name has been tossed around, right? I mean, we've all heard the rumors before, so I don't necessarily know if that's the beginning. But aren't we sort of missing the most important point about the backstop in terms of contagion?
I mean, we saw that the discount window is now open. It sounds the backstop, has that been confirmed, or are you referring to this new program that they're talking about?
You're talking about the deposit.
I'm talking about the new program
confirmed.
And what
the BTFP.
The $25 billion.
Yeah,
that's from the Federal Reserve. It's up in the nest.
Yeah, so we didn't really go into that much because we were still sort of reeling from from one thing, another bank going down. So just so that people are aware, there's a link up there. I'm going to read a little bit about this new program that Name Redacted brought up that the Federal Reserve has tweeted out right now, and just to kind of read through it very quickly. The Federal Reserve Board announces it will make available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of all their depositors. So, the liquidity pressures that are arising the financing will be made available to counteract it. The financing will be available through the creation of a new bank term funding program that will offer loans of up to 1 year in length to banks, savings associations, credit unions, and other
this is a game. This is game.
And other eligible
real
depository institutions pledging U.S. Treasuries, agency debt, and mortgage-backed securities and other qualifying assets as their collateral. So this is important. The BTFP will provide this additional source of liquidity against high-quality securities. Now, of note, the size that Matt referred to, with approval of the Treasury Secretary, the Department of the Treasury will make available up to $25 billion from the Exchange Stabilization Fund as a backstop. This is obviously huge news. Matt would love to hear from you on this.
Wahid, jump in first. I know you've got a lot to share there, and then we'll go to Matt.
Let me make this.
Sorry, guys, I had to leave real quick. I was calling my broker. I'm shorting the U.S. bank sector right now. This is a great money-making opportunity.
All right, okay.
Disagree.
So
go ahead, Wade.
Kim, before you do that, let me just share what this means. So so obviously all this is more than a discount window. The discount window is a very short term, could be a short to intermediate term facility. This is different. This is saying, don't worry about your maturity curve. Don't worry about your duration. Give us mortgages, give us securities that you are, mark to market in losses, right? But we will look at the whole term structure of those securities and we'll give you a loan against that. So this is a way for the Fed to say, if you hold government securities and high quality securities, if you have a duration mismatch, we will lend against that in order to cover your holes. That is
they're letting them pledge
deal.
Those at par.
That
not
is
at their loss.
Huge
That's
deal.
That's the big part of that, is they can pledge those.
That's a game changer, guys. That's QE. Exactly. Guys, that's QE. Okay? That's QE.
Do you think that a lot of the banks are going to use this, or
so
only
Kim,
the ones
don't
that
short. Kim, I like you. Don't short.
I've already shorted, and here's the thing. This to me doesn't change the underlying problem, which is this is now the second large bank in a very short time frame that is failing here, and there's more.
I actually think honestly, like we can't be a group of people that all get together and talk about how to manage the crisis. What does this mean for America?
Exactly.
And then all of a sudden, the government announces a $25 billion fund for existing banks.
Exactly.
That enables them to borrow against their collateral at par to shore up any of this disequilibrium, right? And so that's one signal. So then it doesn't help SVP and their, deposit holders, but what's coming next, obviously, right? You're not going to now not protect the deposit holders of that bank.
Yeah, and don't forget the shareholders of these banks. They are all losing a shit ton of money
that doesn't matter. Honestly, that doesn't matter.
That's not the point.
No one cares about
Nobody cares about the shareholders of those banks.
They want that. They actually want that.
Right.
No moral hazard.
Yeah. So that's why I was saying we're kind of bearing the lead because one bank went under on this phone call. The reality is the government moved within 48 hours to create, this massive fund. And second of all, what comes next, presumably, is that they completely backstop the deposit holders of SVP, I would think.
Well, they announced that already, that they're backstopping. All deposits are available Monday for SVB and for Signature Bank as well.
So they're doing
it's already been put into account. It does not hurt SVB holders. This is the beauty. They literally fixed the problem. They have now, at some level, fixed the problem. Now, as we all know, when you fix one problem, you create 10 new problems. You just don't know what those are yet. KP.
So Kim, shorting the housing, the financial sector, I wouldn't do that because this is positive news. If you look at that, Signature Bank is up in the aftermarket for that move. So the names are all so similar. It's like confusing. Silvergate was the bad crypto one that was hanging on by a thread. SIVB is the one that's going to make an example out of, even though they're sort of protecting, but they're protecting depositors. But they're saying that Anything that comes next, they're there. And the loan thing, that's basically a bridge loan, is going to help smaller companies. Those are the ones that if they lose some of their cash, they're in trouble. The big companies, they use multiple banks. A lot of them are well capitalized. But I think that this is great news. And in terms of the financial sector, sorry, my phone keeps going off. XLF, the financial spider ETF. If you look at it, closed Friday at $32. If you want to be a conspiracy theorist and say, "Oh, that's it for the banking sector," the prior sector highs were 2008, $24 to $25 it was at. If it goes below that level, then you could start making those calls. But
now I
market's
think
going to be up.
I have enough experience to be able to make these calls right now, and I tell you why. This is the second bank in a number of days that is failing. Yes, the government is trying to deal with it and swiftly, and they don't have a choice, because if they don't,
Who's failing?
Markets will collapse. But here's the problem:
who's failing? What do you mean second bank?
This may just be the tip of the iceberg, and my intuition is that there's more to come.
I think there's no second bank.
Guys, can I go back to something technical?
All right, guys.
Yeah, go ahead. Wahid, go ahead.
Yeah, go ahead, Wahid.
You got to unmute, Wahid.
Yeah, you got to unmute.
Oh, sorry. So just to go into technicals here, just reading more about this new facility. You know how they were saying that the FDIC could not possibly insure all deposits, and I was like always saying, look, all they have to do is say they have a big stake, whatever it takes. This actually absolves the FDIC from having to do that, because if you can post your collateral across any duration mismatch and get a loan against that, you kind of have alongside the discount window unlimited liquidity. Okay, so this really solves a lot of issues.
So, one thing that is incredibly interesting now is the narrative has completely shifted with this big piece of news, in my opinion, at least. Would love to get,
No, I agree, 100%. This is cute.
And so now, is the risk of contagion essentially zero? I mean,
yeah,
yeah,
and Wahid, I want to ask you that question actually, because you've been ringing the alarm about this, not just today, not yesterday, not last 2 days. You've been ringing the alarm for months now, since prior to the FTX collapse.
It's not, for me, it's not rocket science. I see the big debt whale, right? I see it all, and I know this is going to happen, because this is what happens when you have, the kind of leverage in the system. But I always said they're going to panic, and they're going to reintroduce liquidity pools in some form of QE. And this is what happens, right? The same thing happened in October with Credit Suisse and the Swiss National Bank, backstopped by the New York Fed. This is what happens. And so, I'm not proud of it, but they did solve this problem. There could be more contagion, but now with this backstop, I think there's enough of a stick. And unfortunately, investors are very Pavlovian. They want to hear the ringing bell, right? And then they go and they buy risk assets, and by buying risk assets and with yields going down, because now there's no way the Fed's going to be as aggressive, right? Then the system sort of cleanses itself artificially, but it does.
Kim, are you still shorting? We can't tell. I feel like it's a bad idea.
Well, let's talk about it.
I agree with you,
in
Kim.
a week, right?
If it was not a rigged system.
I would never
Kim, it's rigged.
question anyone's decision on their investment decision. So, Kim, if that is your gut feeling, then you go with that. And my experience in the past during the financial crisis is, a fire pops up, it's put out by the Fed, the market rips, and then within days there's another fire spotted in the market, crashes. So this is still overall a major fluid situation, and multiple fires keep popping up. And this is not going to be the end of it. Like Bear Stearns was
what is the next thing that you're concerned about? I mean, we're talking vague right now.
I can't even say what it is, because there's so much out there that no one knows. Right? I mean, I can't predict what it's going to be, but I can
expect it to come from the financial sector. I mean, we literally have this. You do. You do expect
I
it
mean,
in the
because
financial sector.
I've seen this before, and it never ends. I mean, I'm not so concerned about a bank run, but it's more like who's holding the bag here, who's going to have to go raise capital in the market. Are they going to be able to raise capital? Who's going to be accessing the Fed discount window, and those names are going to come out. So this doesn't just end usually with one crisis. And we saw that with Bear Stearns. Anyone who was around that time, the market gets exuberant and say, oh, we're good. We have one big blow up and it's safe now. But then a week later, you have the next boogeyman where it's like either Morgan Stanley or Lehman or whatnot. So these things do tend to spread. The market will get ahead of itself initially. But I mean, I wouldn't be surprised, and I'm probably wrong, but let's see what happens when we open up tomorrow and how the market's trading by the end of the day. And let's also wait and see how treasuries. I want to see how bonds
in a matter of days. You can expect some more news. So anyone sitting here saying, "Oh, we solved the problem and it's all good," you guys don't have a clue.
Yeah, and I will never second guess anyone's investment decision. I would just say that if you do, take the other side and go long.
So what's interesting is that right now, this news comes out. There's and just for people, we just had a big influx of people that joined the room, obviously because of this news.
So maybe you could refresh to them, Dan. Just refresh to them. What is the latest update we had? What's the news that we just shared with everyone? Just for anyone that just joined, maybe summarize it in like a minute or two.
They just came out about 31 minutes ago with a press release announcing that they're going to make additional funding available to eligible depository institutions through this program called the Bank Term Funding Program, which is a $25 billion fund from the Exchange Stabilization Fund that is now a backstop, and it's been approved by Yellen. It's already in play. And because of this, on Monday, at least from our initial review, all deposits will be back to the people that they were supposed to be Monday morning. This is now, and now there's a $25 billion backstop for any other bank that may suffer from even even a large bank run. I mean, this is in addition to the discount window that they just added as well. And so the fact that they added the discount window and this, while I agree with name redacted that everybody is free to do whatever they want, I think that this definitely, if nothing else, we can agree on, this definitely reduces the risk of contagion. Do people not agree that this even reduces the risk of contagion at all, Kim?
Not at all. I think this is a great money-making opportunity for anyone who knows how to go short. I think you should take
no on the stage.
I would say, in my opinion, but markets tend to overreact in the beginning of good news like this, and then once it's digested and we realize that the Fed actually panicked here and is having to use extraordinary measures, it means there's other stuff going on as well. We just don't know.
And let's see how big the bank run will be tomorrow. That is going to be quite an interesting situation. And then let's see how this all holds up, because what I'm reading into all of this is not that all depositors are covered. Is there even enough money to manage this? That is the big question, because we're talking about between those two banks, we're talking about 250 million in customer deposits. Good luck with that. 250 billion.
He would love for you to, I believe you have a counter argument here, but would love to get your thoughts on this. I mean, have we effectively contained the contagion risk at this moment? Or do you think that there's a lot?
Let me just give disclosure so people really understand my biases. I'm a hard asset guy. silver, gold, real estate, crypto. I mean, so I hate this shit. Okay, but I have to call it as it is, right? This is reminds me of COVID. He came up with one bazooka. Markets ripped, and people are like, wait a minute, the whole world shut down. It doesn't make a difference. And then he did another bazooka, right? And then the market ripped and then started falling again. And then he said, fuck it. I have an unlimited bazooka and I'm going to buy every single damn corporate bond out there. Okay. And finally, the market said, to hell with this. And I remember on CNBC, they were like, this isn't, a bomb. This is a nuclear atom bomb. Okay. And of liquidity. And then finally, we saw what no one thought possible, which is that markets would completely rip with an entire economy at a zero, like literally shut down. And that's what happens with liquidity. That's what happens with a phony fiat system. And so what I see here in the headlines is very simply a dare. Any bank that needs liquidity, you can come and tap it. Anyone who needs a medium-term, 1-year loan that absolves you from any duration mismatch on your liabilities, come over to us and we'll give you the facility. So you don't actually have to go and raise money from private equity or from another institution. You can come and raise it from us. No questions asked. That solves that problem. And I think people are very Pavlovian. When they see these bailouts, and I talk about a market bailout, they just buy risk assets. And by buying risk assets, credit spreads go down, yields will collapse. I think the Fed got what they needed to be a lot more dovish going forward, and the cycle restarts. Again, the entire European banking system, which I'm a part of, by the way, because I'm in Europe, right, was in complete meltdown. And then when he did the bazooka and say whatever it takes, everything sort of, all credit spreads start to narrow, and things started to normalize. I think we're in that moment. So I do not think, in summary, there's going to be a massive panic this week.
And that's incredible. I mean, that's a good thing, obviously.
It's a good thing. I mean, I find it to be, I always tell people buy inflation hedges. So I've been on the show for months and months and months, and I said you got to own real estate, you got to own risk assets, you got to own, gold and silver and some crypto and art. I encourage people to do that. And a lot of people say, well, he's just so damn bearish. Why are you asking people to buy? And I say, because this happens.
My opinion on this is we can just see the futures right now. They've pared back a little bit. We're up 1% S&P futures, but pay attention to how the Treasury market acts tomorrow and how the VIX acts tomorrow. And that will sort of guide you as far as the market's interpretation of this Fed sort of panic move and what other risks they are looking at, and also how the market is going to be pricing in a potential another rate hike of say 25 bips this month, and then going forward.
Yeah, I think we see steepening tomorrow. I think we see a bull steepening. I think short-term yields will go down, long-term yields would stabilize. I think fixed income will be buoyed tomorrow.
So
we'll see if that flight to safety reverses from last Thursday, Friday, because that was a historical move.
All right, guys. So I wanted to jump in and introduce Adam Korzenewski.
You got it.
Oh, wow. Okay. It's because I have a funny name too. So Adam, he's a former Treasury. He reached out to us. Adam would love to get your sense of the situation. Is this unprecedented? What is actually going on? Can you give us some details from the inside?
So it's not. So the thing that's unprecedented is the size, right? Like Silicon Valley Bank is, everybody's seen the chart. It's a big bank. However, this is kind of the normal process by which whenever there's a bank that's on the brink of collapse, the federal government and state regulators step in to basically liquidate it, right, and sell it to an auction to a bank that could actually manage it. In most cases, for most of these banks, most if not all of the depositors are actually still whole by the end of it. Typically, what happens is the unsecured debtors and shareholders are left on the hook. Senior management's liquidated, and so you kind of move forward. What's making this really unprecedented is the fact that Silicon Valley Bank has so much
social and political capital as well as actual assets and liabilities, that we were kind of like so tied into this, right? This saga, right? People who, who don't necessarily do business with it, people who don't know exists know about the story, right? And that's really the first part of the contagion problem that there would be, right? And this is why, we just had the statement out by the Treasury, FDIC, and Federal Reserve about the backstop that they've created, about how there won't be a bailout, but the depositors will be fully insured on Monday. People will have full access to their accounts. There's nothing to be worried about. So this is actually one of those instances of so far the system that has been designed is working the way it is. I mean, one of the things that's really important to understand about Silicon Valley Bank is that they were very badly managed, right? One of the they moved over basically their capital that they maintain so that they could actually have cash on hand from short-term loans. So loans are going to be mortgages that are going to be going from turning over in a year over to long-term debts, right, in order to increase their shareholder value, which has caused the fact that they don't have cash, right? And this is the start of a lot of their problems. But I think we're going to see some really interesting things come out of this auction process, and especially in the next coming weeks about what they were doing. I've just briefly read that they were involved in basically loans to startups, companies that don't necessarily even have incomes yet. And it's going to be very fascinating about how they justify this stuff. And I really think, we're going to see this kind of real reversal of fortunes for the banking lobby industry that has been so powerful in the last few years. Kind of getting put back on its heels.
So Adam, just wanted to get a sense of, just so that, because it's going to affect the questions I asked Vivek. Vivek, thank you so much for joining us. But just for context, is the Exchange Stabilization Fund a fund that is funded by taxpayer dollars? Or is it, I know FDIC and Federal Reserve has many different funds. Where is that money coming from to pay for this?
So let me, I actually have to look
I can
that
answer
back up.
that if you like. Go ahead.
Yeah, go for it.
Wahid, why don't you answer that?
No, that's completely Fed. That's the Federal Reserve.
That's the Federal Reserve. Okay,
Yeah, that's the Federal
that'll be helpful.
Reserve. So he basically does a loan. It's a loan fund. Okay,
got it.
So that comes out of printed money.
Awesome, Vivek. Thank you so much for joining us again. The world has
good
changed
to be
in the
on,
last
man.
24 hours.
It has. I just thanks for the folks who sent me a message. I think it's a great group you guys have, and I just published a piece in the Wall Street Journal, the opinion page, maybe a couple hours ago, before this news broke now. But I got to say, I understand that they've very delicately managed where the funds are coming from, so as to say technically it's not going to come from a taxpayer pocket. But there is no free lunch. And I think that the hard question that everyone's going to have to answer is, why bother having the charade of a cap on FDIC if we're going to treat it when there's certain darlings who end up being the ones that needing to go put their hand back in the cookie jar, who actually need it above the cap. Instead, just pre-specify it ex ante to everybody that the cap is something higher than the made-up $250,000 figure we applied. And it frustrates me to watch, and I think they succeeded. So kudos to the Silicon Valley establishment for actually getting what they needed to get done in their hour of need. You know what? The actual social insurance policies they had bought for years paid off. But you know what actually happened is that in their hour of need, they got effectively a bunch of tech startups that are banking with Silicon Valley Bank got bailed out for poor decision making, for, I think something that they shouldn't have been rewarded for. And the reason is that had this happened in a different situation where they hadn't mongered the fear of actually spreading a financial crisis, the whole justification of this bank being subject to a less stringent regulatory regime was precisely because under the cap for where the more stringent Dodd-Frank rules kicked in, because it was not supposed to be a systemic risk that they created. So the irony is that the very argument that Silicon Valley Bank would not have created a systemic risk was invoked right in their hour of need to actually result in what was really a lowercase b
bailout. And I think that you got to separate, for all of the people who were talking about this triggering a national epidemic of a bank run, you could handle that separately, right? And that's what my whole Wall Street Journal piece was about, is the FDIC could prospectively, temporarily raise the amount that was insured. The Federal Reserve has the ability to be the lender of last resort against good assets. There's a lot of things that were fundamentally different about Silicon Valley Bank than other banks across this country. And also, by the way, many of the people who were banking with Silicon Valley, I mean, I know how this works. They get venture debt term sheets. They get special relationships with Silicon Valley that give those founders and the owners of those companies added skew, equity upside, that the taxpayer does not participate in. But when the time comes, when their bell tolls, the public is still there for the downside risk. And so I just think it's a travesty. I think it will erode trust. People wonder where populism comes from. This is where it comes from. It comes from faux free marketeers who, when times are good, will let the money rain from on high. But when the spigot stops, effectively want special treatment outside of the rules that were pre-specified. And if those were the rules or those weren't the rules, why not just say that? Why operate under the charade that everybody else has to assume that it's $250,000 maximum, but when it's a favored darling, somehow those rules are out the window. So I think if you want to know where populism comes from, this is Exhibit A. We learned it. We see it on full display. And, there you have your answer.
And so it's fascinating because this is all in the context of the proposal from President Biden. His proposal is out. Obviously, you're a presidential candidate. And not the biggest fan of Biden's, but wanted to give you the chance to say, okay, how does this all fit together in terms of his proposal, which does aim to, shore up Medicare, shore up other entitlements, but to increase taxes along the way. One of your competitors on the Republican side, Nikki Haley, came out this morning and said that everything should be on the table. Do you agree?
So here's the way I look at it: is I think it is a false debate that the GOP and the Democrats have both fallen into and playing small ball between raising taxes and cutting entitlements to deal with the deficit, right? So you got Trump on one hand, who, a lot of Republicans don't like to talk about this, but absolutely spent a lot of money and contributed to the deficit that some of those very Republicans now like to complain about. But then I think you have a bunch of classical conservatives who like to play small ball, like a bunch of accountants talking about spending cuts, with Democrats talking about the only thing they know how to talk about, which is raising taxes. I think that there's a third way, and it's amazing to me that nobody talks about it, which is restoring GDP growth in this country, right? GDP growth, I said this in the last space we were on, which is it was over 4% for all of our national history until the early 1970s, when a few things went awry, both culturally and with the Federal Reserve going off the gold standard and expanding its remit to playing the kinds of games they've been playing for the last couple of decades by trying to play God according to balancing unemployment with inflation, which they've done a pretty poor job of doing anyway. But that's, I think, how we actually set an economic agenda that's centered on GDP growth. You hear from one party about spending cuts. You hear from the other party about higher taxes. Why is nobody talking about GDP growth? And anything that's on my train, I view myself as a freight train, and if you're on the track, I'm going to run through whatever obstacle that is to GDP growth. And if that's the climate agenda, let it be the climate agenda. If it's the anti-nuclear agenda, which is the most puzzling, I'd be running through the anti-nuclear agenda. But I think that we need to unleash actual GDP growth and productivity. We can grow our way out of this rather than playing small ball as accountants with spectacles as classical conservatives, or, for that matter, just go into the old liberal refrain of raising taxes. There's a better way.
So yesterday you had recommended, and I think in your article, I'm assuming it was similar, which was that in this situation, coming in, what they're calling, just so you know the talking points. The talking points right now are they're calling this a backstop. By the way, very interesting use of words, but it's not been called a bailout.
Of course.
Do you think that it is a bailout? And do you think that it's an opportunity for Republicans to show contrast here?
Yeah, I mean, I could care less for the partisan politics of it, to be honest with you. And I could imagine, and I've been very critical of Biden and on a lot of things, but I could imagine it being a Republican sitting in that seat that would do the exact same thing. So this is not really a particularly partisan issue. It was a Republican that actually was in the White House in 2008, when I think the ignominious bailouts of 2008 played out as well. I could care less what you call it, bailout, schmailout. backstop, schmackstop, doesn't matter. Okay, it's effectively rewriting the rules ex post after the fact to be able to save a darling in the game of, you want to call it what the actual name is, whatever you call it, it's crony capitalism. And I think that, you know what, you want to change the rules prospectively for everyone, fine. Say the FDIC cap for any depositor is high, fine. But you know what Silicon Valley did? Kudos, I say this sarcastically, but kudos to the people who managed to actually hold the nation hostage on fear of a bank run. If that's what you cared about, you would have dealt with that separately. You would have dealt with that separately by prospectively adopting policies that made sure the other banks across this country didn't have a bank run. But instead of throwing spaghetti at the wall for every argument and seeing what sticks, from competitiveness with China to saying that these are the engines of the American economy, to saying that, you know what, how about making a poor risk management decision and recognizing that you actually have to own it? Now, the argument that these startups are somehow going to disappear because their cash balance disappeared, that is false. Because you know what? Their business model today is the same as it was 3 weeks ago, presumably. And if that's the case, great. That's an opportunity for somebody to inject fresh equity capital. I know that sucks because if you're a founder or if you're an existing venture investor, that means equity dilution. But that isn't the scope of concern, I'm sorry, for public authorities in this country to use implicit or derivative taxpayer money to backstop, as they say. But that's exactly what happened here, is in the name of this false myth that these businesses were going to disappear. No, if the business model was sound, great. Just you have capital, you lost balance sheet capital, so be it. Take equity capital in. That's not great if you're a founder. It's not great if you're a Series A investor. But you know what? Life comes with accountability for the mistakes that you make. And it was a risk management mistake to concentrate in Silicon Valley Bank in retrospect. And so this existential threat and fear mongering was unfortunately successful in delivering a result that I think will throw kerosene on populist flames already raging across the country.
Where do we see these populist flames take us from here? I mean, is there going to be conversation about the role of the Fed, about the role of the executive branch?
The role of the Fed would be a productive place for it to go, at least. And I don't favor just fostering anger for the sake of fostering anger. If we can marshal it towards something productive, let it be towards actually reform of the Federal Reserve. And where I plan to take the energy behind this and hopefully lead the way on it is actually to have a Federal Reserve that goes back to restricting its scope to using the dollar as a unit of measurement and stops playing God. Because you know what? If it's been playing God, it's been a very fat-fingered God that has actually gotten a lot of things wrong over the course of the last 20 years, over the course of the last 2 years, over the course of the last 6 months. And I think that in many ways, wherever you are in the debate about what should have been done here with respect to Silicon Valley Bank, I think we can all agree that the Federal Reserve's, I would say, fat-fingered problem of its inability to actually play its self-appointed role of financial God in America is part of what got us here and part of what got us to the precarious position we're in, even from a GDP growth standpoint. So that would be a productive place to channel the energy. Yes.
And the other place that I've always wondered where you stand on this. And it's something that I think a lot of people, you were talking about populism. I think it's a very popular belief, which is this problem, and you mentioned it very eloquently, this problem came from Greg Becker and a lot of the banks lobbying to roll back Dodd-Frank. But that only works in a world where Citizens United, would love to understand your thoughts on Citizens United. And, if you were president, would you remove the money and the lobbying? Is that something that you would commit to?
So look, if I could wish it into existence, and I've said this since February of 2020, capitalism and democracy should not share the same bed. We need to execute a clean divorce. I said that for the first time in February 2020. I'm sticking to that too. So all that being said, the Supreme Court has held, and it's on First Amendment grounds, that there's some complexities because otherwise people could reorganize themselves as media corporations, because everyone recognizes that media corporations need to have certain latitude in order to be able to engage in political speech. And that creates a domino effect that makes for a complicated constitutional question. But put the constitutional question to one side. On first principles, do I want a world in which laws are made without heavy-handed lobbying or even light-handed lobbying? Absolutely. Do I want a world in which businesses go back to focusing on making products and services for customers, social advocates? Absolutely. And also, on the flip side, get politics out of the hair of businesses as well to let the actual free market work. And right now,
when you force capitalism and democracy to share the same bed, you're left with neither capitalism nor democracy, but a perverted form of both. And I just think what happened today is just yet another example of that on full form, full frontal display.
All right, I'll ask you more directly. So if the legislature could get their act together and brought something to your desk, would you sign it? That would
require so if you take Citizens United seriously, it would require a constitutional amendment. But if you're asking me, am I for a system of reform that gets lobbying and sort of the paid system of buying up legislation fixed? I'm absolutely in favor of it. Yes.
Perfect. And in terms of what is transpiring now moving forward, we're going to have a few weeks of tumultuous market. This is going to have significant ripples. What is your biggest concern about this decision in the next, not just in the next week, which I don't think anybody can predict unless you have a clear prediction.
But it's hard to say.
Yeah, what do you think the negative outcome of this is going to be? We're obviously dealing with inflation being stickier than expected. The Fed is trying to use a blunt instrument to solve this problem. Seems like their blunt instrument may not be working. They're probably, at least according to the experts on the stage, they're probably going to become more dovish. There's going to be less rate hikes or less impetus for rate hikes because they literally broke the system. So now, moving forward, are we in a period of Jimmy Carter style stagflation? Like, where are we going? What is going to happen? What is your prediction? What are you preparing for?
Well, I'm not doing this as a political analyst, right? Or even an economic analyst. I'm running for president to change the outcome for the better. And I just think if we reorient our energy towards actually delivering GDP growth, that involves a deregulatory agenda, that involves unleashing American energy, involves doing a lot of things that are near and dear to my heart, then I think that we can grow our way out of these otherwise very difficult trade-offs that we're going to have to make. And so I just think that it's shocking to me. It's part of the reason I'm running for president is that I don't hear either major political party actually being ambitious towards just putting us back to, I'm not talking about something crazy here, just 4+% GDP growth, even 3+% GDP growth. If we get to 3.5% GDP growth, we're sailing for the promised land and then some. That's what. But what about
inflation along the way? We can get GDP growth if we just pump a bunch of money into the economy. We've seen that story before. How do you balance inflation, especially with our balance sheet? Biden just came out with what he's claiming is going to save $3 trillion over the course of 10 years, a new budget, new proposal, but it's raising taxes on, according to them, the rich. And so, that's
we have a model. We have a model for how to do this, right? Reagan and Volcker, right? You have to raise rates. Okay, raising rates is yes, tightening and pulling money out of the system, fine, but do it against the backdrop of an aggressively deregulatory and unapologetically, let's just say, American innovation-driven agenda. I would say that with the way we treat our energy industry, both traditional fossil fuels as well as nuclear energy, is exhibit A for the degrowth agenda, the anti-growth agenda in America. So if you raise rates against the backdrop of taking that agenda for granted, you're right. That's a formula for tough times. And it's unclear that the Federal Reserve is going to be able to, on a reasonable time horizon, even curb that inflation, even through the monetary policy itself. But if you have the necessity of tightening monetary policy against the backdrop of actually fundamentally unleashing the American economy through a combination of deregulation, and I use the energy sector as just an example of what we need to be doing sector-wide, then I think that, yes, we have the opportunity to grow our way out of the problem. And I think that a big part of this also just comes from, the restoration of even this idea of American self-confidence in the next generation of Americans, in workers in this country. I think that that's part of why my campaign is centered. Yeah, I have a lot of economic policies we're going to be rolling out over the course of the next year. But I think this is fundamentally about reviving a missing national identity centered on the unapologetic pursuit of excellence. And I think that's one of the things that we miss as Americans. We have to apologize for the unapologetic pursuit of excellence. That's what the anti-growth agenda is all about. That's what the anti-nuclear agenda is actually at its core all about. And so that's why I've started the campaign. The whole premise is on actually reviving a national identity center, not on victimhood, but on the revival of merit, on the revival of meritocracy, on the revival of excellence itself as the heart of American identity. And I think that if we're able to revive that sense of cultural self-confidence, the economy will be one of the places where that manifests itself. But I think that the productivity that we drive through, then let's get to the reform of the Federal Reserve, reform of the energy department, reform of the EPA, reform of all of the constraints that stand in the way, the administrative state, the three-letter alphabet soup that represents a set of handcuffs on the American economy. That's really, I think, when we go in that order, when we're going to be most likely to be successful to say that, GDP growth makes the other debates seem small by comparison from spending cuts to higher taxes.
So one part of
just
we're looking at right now
Vivek,
is jobless claims. Kim, 1 second. So, one part of this that, I've heard you speak about, and I would like to get your thoughts on, is right now we have high inflation still. Inflation is sticky. Fed has been raising rates. We have broken at least a couple of banks that probably were weaker than others. But we also have one other part of this. The Fed came out and has said multiple times that they would like to minimize the pain, but the only way forward is by, getting rid of these. Right now we have the record low jobless claims, and so ultimately, is the answer. And one of the answers, we have too many jobs, not enough people to take those jobs currently. And so, one part of this is immigration policy. Again, Fed is likely going to be dovish. This is not financial advice. I don't think Vivek is even claiming it's for financial advice in any way, please. But, likely Fed is going to be dovish moving forward, especially in the wake of everything. What do we do in terms of immigration policy? How do we think about immigration? We don't have enough working people to meet all of these jobs, especially in certain sectors. How does immigration policy play in this? Vivek, you're muted.
Yeah, thank you, man. I'll give you two tidbits here, and then I got to rock and roll. And thanks again for having me, guys. But
you got it.
So one is on immigration policy, and then one's actually on education policy in the Department of Education. But let me address immigration first. I unapologetically embrace meritocratic immigration in America. Right now, I don't even talk about illegal and legal immigration because I'm, hardline against illegal. We have an accidental system of immigration, right? I think we need to talk about accidental and intentional immigration. I embrace intentional immigration. Accidental immigration, I mean, even the legal accidental immigration is like H-1B visas. Why on earth would we subject that to a lottery when we could just meritocratically pick the people who we actually wanted to make those contributions instead? And so, I depart from some of my GOP, fellow, let's just say people in the Republican Party on this one. I don't believe that we should have and fetishize a hard cap on the number of people who come in. We should instead start focusing on what kinds of people actually come in and apply an unapologetic points-based meritocratic system. And I think that it's not just about immigration, though, using to fill the gap. I think the last thing I'll say before I leave is this is an underappreciated contributor to the worker shortage is actually the Department of Education in this country. So I have been expressed, and now, I think a couple of others have adopted my stance a few weeks after I first announced it, which is that I would shut down the U.S. Department of Education. There's a lot of reasons behind that, but one of them is that the Department of Education effectively tilts the scales in favor of four-year college education for a gender studies major in California or whatever, without at all offering the same incentive to somebody who wants to be a welder or a builder or a plumber or a carpenter or whatever for two-year education. And so you get what you pay for, right? And so the $80 billion that flows through the Department of Education is actually tilting the scales, worsening, exacerbating the actual worker shortage that we also have in this country, because a big part of it is itself the product of training. So that's not an all-encompassing answer, but it gives you from immigration to education, the worker shortage that you see in this country. That's not the problem per se. That's just the symptom of a deeper problem of policies and a patchwork of policies that created it. And frankly, I think you got to have a president who understands that in depth, not just somebody who's reading up what they learned in a binder before they, showed up on a Twitter Spaces, which is normally the way of learning presidential campaigns work. So,
yeah.
Anyway, thank you guys.
Vivek, Vivek, before you jump off, Vivek, I want to say one quick thing, Kim, and just 2 seconds, Kim, if you don't mind. So, David. Hold on, Kim, if you don't mind. So David Sachs just put out a tweet a couple of hours ago criticizing you. If I get him onto this space, I'll see if he can join. Are you free later today to join him as well? I'll DM you if you are.
I think I'm supposed to be on a show with him tomorrow, so I'll have at it with him. But
perfect. It'll be good to watch.
I think the faux free marketeers are really what bother me the most. If you're a true free marketeer, great. If you're an anti-market person, that's fine. We can have the debate. But those who are clouded by self-interest and proximity to otherwise, you know what, I think David would, I'm certain he would agree with everything I'm saying if it weren't for the fact that he had a little bit of a proximity bias, but good guy, you know, and respect him for a lot of things.
One more point, Vivek, one more point. I asked this for every special guest that we have. Your thoughts on Twitter Spaces? You know, we've been doing this for a few months.
It's pretty cool, man.
A lot of great names joining. It's pretty intense and live, huh? Yeah, I know. You joined a few months ago for the first time.
Yeah, I haven't been on any other ones. I've only been on yours, so I can't really say it. But you're pretty proactive about like letting me know when there's a good one. So my experience is maybe it's a selection bias, but so far, man, it's pretty good, and I think it could be better than just the traditional modes of media, or even the new podcast direction that the society is going in. This is an added way to keep it real. So. Anyway, I love it. Man. And, the campaign world is still done pretty old fashioned. So I wish I could do something more innovative in terms of digital technology, but you still got to go to the website, vivek2024.com. And you know what? If you disagree with me, that's great. I think we need more debate in this country. But if you like even part of what you're hearing, like I said the other day, throw in $1, chip in a buck, and that actually helps advance debate in this country. It'll give me a good spot on the debate stage. So thanks a lot, guys. Appreciate it, guys.
Appreciate you joining. And breaking news, I know Kim wants to jump in, so I'll give the mic to Kim. The Biden administration will brief Congress tonight on the banking resolution. That's from the Washington Post. Just thought I'd share this. Kim, the mic is yours.
Yeah, unfortunately, Vivek left now. I just wanted to give him a piece of advice. If he's running for president, he needs to learn how to hold an audience, because we dropped 2,000 people from the space while he was talking. So maybe it can be a bit more interesting.
Thank you. I want to go back to the announcements from we've got the panel, KP and Adam. KP, I want to get your feedback as well on the announcements from the Fed that we saw over the last half an hour and what you expect to see next week. And we are bringing speakers that we've had over the last 48 hours that we're pretty concerned, and I want to get their thoughts on this announcement. So I'll do that in the background, Danish.
That sounds good.
I just wanted to point out one more thing real quick, because I think this is really interesting. For those who have listened to the space, you will remember that when I pointed out that the CEO of Silicon Valley Bank was probably listening to the advice from the White House about, interest rates being fine and inflation being a temporary issue. And then everyone in the space was screaming at me and saying, investors who are listening to the government are idiots, right? And then literally half an hour later, the government issues a statement about how they're going to save these banks, and all these same investors that have said don't listen to the government were all of a sudden cheering over this news and saying the banking sector is now safe. I mean, what a hypocrisy.
Well, all right. So we're going to switch back to discussions around this new fund. One of the questions that I have is around the size of the fund. It seems small. Is that just my initial perception of it? 25 billion, as we think about the bank run that occurred.
No, that's not how to see it. That's not how to see it. That's credit.
Walk us through the numbers here.
It's 25 billion credit protection. So that is total loss. So pick your non-performing loan, pick your default rate. The nominal amount will be multiples of that. So if your default rate is 10, that's 250 billion. If your default rate is 5, that's 500 billion. So it's 25 billion in credit protection, basically loss absorption.
But let's say that there's a bank run. How does this 25 billion kick in? So that's the assets that you're holding. The loss on those assets when you're going, is that what you mean by that?
Yeah, that's credit protection loss. Yeah.
Okay.
That's how I read it when I first read it. So.
Okay. And you think that will be enough across the country, across all the potential banks that could be involved?
It's irrelevant, because the first week in April 2020 wasn't enough. The second week wasn't enough, and the third week they went unlimited. So I wouldn't play. That's what they do, right? This will get tested. Very good question, actually, because what you're saying is, will this get tested? And to Com's point and all this, could we, stop the euphoria next week, etc. One thing that this Fed doesn't like is to be called chicken, right? And to lose a game of chicken. And so they just up the ante every single time to just basically get the reaction that they want.
So Adam, can you give us a sense of what would need to happen for something like this to occur? I mean, the levels, the levels of leadership that would be involved, and how something like this can come to pass. It seems like a pretty big initiative that came out of thin air over the course of a weekend. Can you walk us through the size of what we're talking about? And is there a precedent for this?
I mean, I think a couple speakers, I couldn't really tell who was speaking earlier when I was just in the listener section, but I think the comparison somewhat to the COVID-19 response is very apt. So, full disclosure, I was in the Trump Treasury Department, so I don't know what people's political affiliations are. I kind of don't care. But a lot of the CARES Act items really required like a whole government approach to this. So, you really had basically an army of bureaucrats from different departments, oftentimes never ever meeting each other, really working together, especially when something this important is going on. You have constant communication between the various departments and the different bureaus and the non-governmental governmental corporations that are affected by this, right? You have a tremendous amount of communication going back and forth. So you probably had hundreds of people working on this all through the weekend, if not even sooner, earlier this week, working on this. I don't know where you want me to take this, so I'll kick it back to you.
Yeah, I think the big sort of question for me is, Kim has mentioned that this is a, scratching each other's back kind of thing. But really what I'm trying to understand is, was the threat level that high do they know something about the contagion that could have occurred? And of course, the contagion can still occur, but what level of information would they need to be able to do something like this? I mean, that's sort of the big question. I mean, we haven't seen this before.
Well, something I pointed to earlier is that we actually see, I don't want to say they're common, but the banks do collapse. There's been multiple banks that have collapsed since the 2008 financial crisis, right? And this is something that's like semi-routine, right? This is something that these people who are, especially in the FDIC, specialize in, right? There's a whole process to this, which is, one of the things that was very awful about some of these tech billionaires going on Twitter and getting a lot of their subordinate companies to start pounding the table about this risk to them, to their personal finances, because this is actually so far going pretty standard for the operating procedure that they have, right? One of the reasons why the Treasury Department in that joint statement that they put out can say that this isn't a bailout, but they can that people have access to their money come Monday, is that typically when these banks go to auction, depositors tend to actually have all their money afterwards. They tend to actually get fully, like the assets tend to be liquidated enough that whoever comes in to buy the bank is actually able to cover the value there. And so there's a lot of things that we don't know yet because they're pre-announcement. I expect for us to have more announcements coming into the opening morning in the pre-trading hours tomorrow. But this has been kind of going according to the typical plan. The thing that I think is interesting is the Federal Reserve funds, right? And I think the reason why they announced them now today with the same announcement that the money will be made available for both SVB customers and also Signature Bank is precisely because of the panic that was being generated on social media, right? And I think that's something that's kind of the unique part about this, is that there's actual responsiveness to a lot of the panic that was going on online, that was kind of driving a lot of this national and international concern. Obviously, like you look at this panel, right? We have people who don't reside in the United States commenting on something that's like supposed to be a regional bank, right? But this is something that's become so important that the Federal Reserve has had to go in, step in, and actually
put together what is looking like a very robust plan with FDIC and the Treasury Department.
Yeah.
So just going to quickly jump in, Adam. We do have Danish here. I'll let you read the news, Danish. But USDC is pretty much almost at parity now. It's at 0.9923. So it's about to be completely pegged, which is good news. But I'll let you read the news on what led to this, Danish.
Yeah, sorry. You're talking about the tweet from Jeremy.
Yes.
Jeremy Allaire. Yeah. So Jeremy Allaire tweeted out, with the closure of Signature Bank announced tonight, we will not be able to process minting and redemption through Signet. We will be relying on settlements through BNY Mellon. Additionally, we will be bringing on a new transaction banking partner with automated minting and redemption potentially as soon as tomorrow. We are committed to building robust and automated USDC settlement and reserve operations with the highest quality and transparency. I mean, this news could not have been better for at least USDC for now. This is so, you know, again, the reason why it's packed is because everybody knows that the money from Silicon Valley Bank will now be returned. So it's good for the crypto industry for sure.
Matt, we're just gonna see. We're just seeing like it's just nice. The sentiment is just completely reversing. And like I'm just going through the audience. Yeah, it's insane. The response was so swift as well. Matt, could we see things get worse again? I know Kim was a bit bleak. Aside to this, could we see more go through trouble next week and the contagion to continue, or was it just too much support for the system like that?
Mario, you're cutting. Can you repeat what you've just said?
Yeah, not sure. Matt, did you hear the question?
Yeah, I heard it.
I'll bring you down and back up, Kim. Yeah, go ahead, Matt.
Yeah, no, I mean, again, it's a little bit of whack-a-mole, right? So I think you have to conclude at the moment we're still in the whack-a-mole, but not this problem. I think what they did, government acted decisively. You have to give them credit. It's probably because of the spaces, right? They did what needed to be done, and so it's hard for me to fault. But I return to the regularly scheduled program of the existing crisis of the American consumer laboring under a mountain of debt. And there are specific knock-on problems from Silicon Valley Bank going under. I just tweeted this out. It's an old article from 2021, but it was talking about the percentage of their loan portfolio that was to VC and private equity funds. It doesn't specify the number in the form of lines of credit, but there's the lines to the funds were obviously to pre-fund capital calls to bridge the gap. You know, those are gone. Those could be replaced with some time, but the bigger issue is all these companies that were relying on those lines of credit in order to fund runway. Those are gone, right?
So I'm going to ask you a very direct question, Matt. Is venture debt, is it dead?
Say it again.
Are we going to see venture debt still? I mean, is venture, obviously.
I think it was largely. You mean in terms of one of these venture companies, pre-profitability getting these lines?
Yes.
I mean, it was largely dead outside of Silicon Valley Bank anyway. So that's my point. A lot of these companies now, the next phase, these founders are going to run around to JP Morgan or other banks saying, "Hey, can you give me a line?" And it's not going to happen. So it's going to accelerate those down rounds and some of these companies going under. But that is more of an inevitable byproduct of the era of free money and crazy valuations, less this crisis. But it's going to pull forward that happening.
So has the Fed reached its goal of job losses? I mean, like, we're going to see a bunch of people lose their jobs from what you're telling me.
Yeah, I don't think it's reached its goal. I actually believe I believe a quarter point's coming. I'm not in the crowd that thinks like they're suddenly going to wake up and believe all their indicators are lagging indicators. So I think they've resolved this particular crisis at the moment. I can't foresee how they haven't reassured everyone, right? But with these moves. But that doesn't change the fundamental fact about where the economy's at.
So, I asked Vivek some of this stuff, but I wanted to make sure to hear your thoughts as well. We've seen all of these different levels react. Which part is of most concern to you?
So
we're talking about the Fed's behavior. We're talking about inflation, the new Biden proposal, the debt ceiling. There's just so much going on all at once. It feels like it's all happening all at the same time. Which of those is the one that you're most concerned about in terms of your own, business and your own, investment?
That's a great question. I think the legacy of those trillions of dollars of stimulus, right, that propped up the consumer and sort of created this fake economy, right? Where you got $1 trillion of debt, you have all these canaries in the mine still with late payments on car and negative equity. Like nothing's changed just because we're breathing a sigh of relief on this call. My biggest concern, frankly, it was the rollback of the regulations that enabled the Silicon Valley Bank to be below that $250 billion threshold, that enabled the bank to have 97% of its deposits, uninsured. Like, what other rollback of regulations are we going to feel the pain from? And again, it's hard to anticipate, but that's my biggest concern. But in reality, nothing's changed other than this crisis was averted.
Mark, do you agree that nothing has changed? Mark, are you there? You're muted.
Are you talking to me?
Yeah, I'm talking to you. But my question for you was more around, of all the different crises that potentially are facing, business, someone running a business, which of those crises, inflation being sticky, interest rates, at least according to Matt, seems like they may continue to move down the way they are. Our balance sheet's getting worse. We have a proposal out there by the Biden administration and a debt ceiling that's looming. Which of these issues actually would keep you up at night?
Well, I hope I don't drive a motorized bank being seized. Who knows what shape I'm going to be in a couple hours. But it's, I think if I was the average person or running a business, I think inflation is like a huge problem. Because it's more than just the price of stuff. It's that people now have an inflation mindset. For example, in California, where I'm at right now, I have 2 propane tanks with 2 different propane companies. One is charging $4.22 a gallon, the other is charging $5.23. And in Montana, propane is $2.25. So people in California think they can gouge, and the price of living is very, very high, and it's getting worse. And I think the Fed and the government are having a hard time stopping it. And for the average person who's not in the 1%, inflation is like high blood pressure. It will kill you. And I think that when things get out of hand like they are now, it takes a long time to fix. And we see now with these banks that things can break and break fast and hard. So that's the part that has me going, because I'm not a paycheck to paycheck guy, but the price of stuff is very, very expensive. And if it doesn't get fixed, it's going to become a real problem.
So should the Fed continue on its warpath against inflation?
Prior to these guys doing this stunt they pulled tonight, I thought if you would have let some of these guys squirm, I think it would have been a huge tightening. I think they have to tighten very, very, very hard and break this inflation mindset. Because I think, depending who you are, the economy is not bad. And if people get pricing and they have pricing going on, it's something that needs to be corrected. So everyone keeps talking about recession. It's not really here, but the prices of things are really going up. And, certain banks, you got the deposit thing going, but if you own Signature Bank tonight, the stock's going to go from 70 to 0. And that's a big deal if you're an equity guy. So just because depositors may get saved, you still can get absolutely destroyed in equity. So it's a dangerous time. It's sort of no reason to celebrate, and everyone needs to be careful, because if things in the United States are breaking, things in the third world are really going to break, and things in Europe can break hard. So that's the kind of stuff that has me going. And whenever I go out and get something, I say, damn, 2 pizzas for $80 in Berkeley, that's a lot. That's a lot. And a year and a half ago, it used to be $29. So I think it's something that people need to think of. And that's what would bother me.
Ram, do you agree? Is that what you're worried about as well as inflation?
Yeah, look, we've been in the higher for longer camp for quite a while. You've got the inflation rate at the same rate as the short-term Fed funds rate. So in the eyes of the Fed, in my eyes, it's not at the sufficiently restrictive level to quell inflation. That's just reality, guys. I know there are a lot of people here that want lower rates, and I just don't believe we're there. And you're at full employment. You are seeing a turn down in commodities. And certainly bank runs are deflationary, but hey, guess what? No bank runs. So the Fed is in kind of like a checkmate position, right? If the Fed raises rates, you're going to get an unwind of a number of carry trades. There are a lot of carry trades that got built up over the last 14 years of ultra low rates and QE, right? You could borrow short at 0% and buy a muni bond, buy a treasury, or buy a riskier asset, capture that spread on leverage. Markets were rewarded for, taking on that liquidity. And so what you're seeing over the last year with the most rapid pace of rate hikes since 1981 is the gradual and then sudden unwind of these carry trades. I don't know if you guys are familiar with the concept of carry trades. I know Pranav and Mark are, but it's where you borrow short in one currency, you lend long in another. Grayscale Trust blowing up, that's an unwind of a carry trade. Even Silvergate, in a sense, right? They lent out deposits at 0%, and then they earned a spread on that. So, I think that's what's happening here in the housing market. With the rates going up, there's less incentive again to borrow and then own a real asset and capture that spread. Banks, same reason. Banks borrow short and lend long, right? So they borrow short-term deposits that are liquid. They lend long-term. They capture the spread. Well, what happens if short-term rates are higher than long-term rates? You do not borrow short and lend long. That's the definition of a carry trade. So you're going to see inflation higher for longer, and the Fed's in a very tough spot. I don't think there's a Fed put at historical strike price levels. It's out there somewhere, but not where we are now. And there's no fiscal put. There's no appetite for bailouts. You saw in the Fed joint statement, the bank regulatory joint statement that they said that there's no taxpayer funding, and you have debt ceiling in the background, right? There's no budget. So yeah, I think the next few years, you're going to have a lot of policy volatility, and that policy volatility is going to translate into market volatility and business cycle volatility.
So taking that
I was just going to say, you sort of had an assumption there about what happens with inflation that was kind of predicated around this idea that, no more bank runs. And I don't know if I can personally conclude that just at this point, right? To a point Grant made a little earlier, which was, if you own Signature on Friday, you're going to wake up tomorrow with not, that equity being gone, essentially. And if you own Silvergate or Silicon Valley Bank last week, that same thing happened. So I don't know if it'll be interesting to see. Your mic,
Pranav.
Oh, sorry. Is this better?
A little bit.
It's a bit better. It's okay.
Sorry. I was just saying, the market tomorrow will tell you how regional banks will perform over the short to medium term, right? So which is, on the one hand, regional banks will have to increase their deposit rates and their net interest margin. Well, they'll just have to increase deposit rates to keep depositors there. And that obviously hurts the net interest margin, which is not good for these equities in general. But at the same time, the risk reward of owning one of the regional banks is also a lot different now than a couple of days ago. So I think that it'll go back to the question of what depositors at regional banks ultimately do, and what does that mean for that entire sector. And that generally, I think, influences what happens with inflation, right? Do small and medium businesses continue to hire, and does wage inflation continue to sustain itself, or does this slow things down to a point where, things.
So Pranav, you're not calling victory over contagion, I guess.
Yeah, I don't think it's clear yet, right? I think we'll have to see over the next couple of days how ultimately, if I have money at a regional bank, I look at the stock price of the regional bank tomorrow and day after and decide what I should do with my deposits.
That's fair. Did you guys break down the joint bank statement that came out about an hour ago, or no?
The joint bank statement about the new fund? The $25 billion fund?
Just the announcement from the FDIC and bank regulators regarding Signature Bank and SVB.
Yeah,
yeah.
We spoke about it, but what aspect of it was most
I'll share a few things around that. So one is, earlier this afternoon, the Treasury Secretary Yellen and the former FDIC Sheila Bair indicated that this was not considered systemic and there would be no bailouts. And that, again, was to be expected because that's the first message you want regulators to say, because they are trying to think about moral hazard risk. That was kind of chess move number one, right? But in the 6:30 statement, again, that took place 30 minutes after the Asian markets opened. That's what I was expecting yesterday, 30 minutes late, but still not bad. And in that announcement, there were two key things. One is they cited the systemic risk exception. So they graduated their perception of the risk from not systemic to systemic. And of course, they also made depositors whole. And so on the safety of the banks, that risk has diminished rapidly. There's a key question around First Republic on Monday, and I agree with Pranav, we're going to look at markets. We're not totally out of the woods yet, but the fact that they cited that systemic risk exception, they're not going to make the mistake of having saved two banks and the third one fail and then undo their efforts. They are trying to snuff out the flames of bank contagion, and that's what they intend to do. Now, the second part, though, is this. Signature Bank is gone. Silvergate is gone, and Silicon Valley Bank is gone, and those were all related to crypto, right? Those are key crypto fiat ramps. What's going on there, right? Now, I think, and I don't think this is like a conspiracy or tinfoil hat thing. If you look at the reporting from the Financial Times regarding the decision around Diem, Fed Chair Powell, and again, Diem was a stable coin that was going to enable digital transactions across checkout.com, Lyft, Uber, Facebook, the big VCs around it. It would have made digital money on chain, brought into the regulatory framework and really accelerated crypto adoption. And by the way, Silvergate would have made a ton of money on that because they would have been the issuer of the token. Well, in any case, Powell had approved it, and Yellen indicated she could approve him in that. Now, of course, Yellen is a Treasury Secretary, and so she's got the big thumb in the room. And, fast forward to where we are today, my perception, and we'll find out with books will be written on this and journalists will learn more, we'll get the transparency. My perception is that, Secretary Yellen made a policy call not to save Signature Bank, which is unfortunate for crypto. So there's a win for the banking system. There's a loss for the crypto sector. I don't think it's a fatal loss, but it does set back the sector for 2 years in terms of access to fiat ramps.
So walk us through what are the access to fiat ramps left? Just want to make sure that people realize that it's not the end. Again, no more FUD. But
Right. So that's exactly the question. So what are the ramps for fiat, right? So Coinbase, the bank behind them was Signature Bank. Signature Bank is gone. The deposits are whole. So monies on Silvergate or on Coinbase are sound. So there are not many fiat ramps out there.
BNY Mellon?
BNY Mellon is not a fiat ramp. BNY is a large custody bank. I know one or two banks, but I don't want to call them out because I don't want any bank runs on these guys, right? But there are a couple of banks out there, and they support exchanges and bringing money onto the platform. There's a shot on goal for Stripe to play the role of a fiat ramp into the sector. Stripe has two partner banks that enables them to conduct that function. So when I say 2 years, by the way, what I'm getting at is how long will it take for a new fiat ramp to come to light? By the way, it might take another presidential election or certainly a new Treasury Secretary. The people in those roles matter, right? And it's not necessarily a political thing. Like Larry Summers was on the board of Digital Currency Group. He left the board in December. Larry Summers is the former Treasury Secretary, and he was runner for Fed chair. So the person in that seat today who made that decision had a slant, is my read. That wasn't favorable to crypto. Could have been someone else. In the past, Brian Brooks, the former chief legal officer of Coinbase, he was the head of the OCC, the national bank regulator. And in his position, that was an incredible gift for crypto because he approved Anchorage and Anchorage has the sole national bank charter. They cannot accept deposits, however, so they're not a fiat ramp to custody crypto, and they've got an extraordinary position. So, the people in these seats matter. I'm looking forward to the reporting in what happened in that room. What was the decision making? The banks are safe. I think they're not going to let First Republic or the regional banks fail. Although, to Pranav's point, want to see what markets do. This is it's cold water on crypto. I believe that is a conclusion.
Interesting. Simon, would love your thoughts on that. Do you agree that this is cold water on crypto?
There's suddenly a big premium for staying in crypto because it's going to be very hard to get in and out. So if you've got Bitcoin or if you've got crypto, you're in a closed loop ecosystem at the moment. So I just was on a space, and when it came out, I was on with Jesse Powell, the CEO of Kraken, and at the time he was making a press release, and there are going to be a lot of crypto exchanges that wake up on Monday without a bank. We've gone quite far back here. So, a lot of these exchanges are now crypto to crypto exchanges. And, the fact that USDC is backed now, that's a good thing. But
Simon, if there's no fiat ramps, that hurts the ecosystem,
of course,
for sure. Yeah. Douglas, do you agree?
I mean, I don't think it's. Hey, everyone again. Thanks for having me back. Hey, not great for crypto. I mean, I guess this is what I wanted to say. In light of the number of exchanges that have folded over the last year, this is clearly not, adding. This is insult to injury, but relative to the troubles that crypto has had with, on ramps before this event, I would love to know your thoughts on how big this is relative to, I think, in my opinion, the much larger problem that has occurred over the last year. So yeah, I mean, I agree. This is not good, but it was pretty fucked up before we got here as far as trusting exchanges over the last 6 months to 12 months.
So Coinbase, we need to see an announcement from them because Signature was one of their fiat ramps. Now, Signature in receivership, depositors will be made whole, but how does Coinbase operate? What does this mean for Coinbase's stock? Do they have a backup fiat ramp? They've been moving from, and other exchanges are also moving from bank to bank. So I think they have a bank. I do believe they have a bank. I don't know who Kraken's fiat ramp is. If someone here on the call does,
Cross River Bank. Not Kraken. Not for Kraken, for Coinbase.
I know Cross River very well. I was an executive at Cross River. So Coinbase relies on Cross River. Cross River is the fiat ramp for Coinbase for ACH and wires. So I think that'll be okay. But
Kraken started in the Euro ecosystem and JPY ecosystem, and basically they're going to have to go back to international ACH. ACH is not there, I don't think, at this stage. There's a lot of moving around, and
So what we need is a spreadsheet of all these exchanges and who's their current fiat ramp, and then just go down the list. I tell you, it takes like 1.5 to 2 years to get onboarded at a bank that's tech forward, even a bank like Cross River. You're not going to see some overnight switches. There could be operational disruptions for customers.
I just want to say Coinbase just came out with something on Twitter.
Eleanor, tell us
more. What did they say? Yeah.
So they say all client cash at banks continues to be protected by FDIC pass-through insurance. Due to FDIC's hold on Signature transactions, we're currently facilitating all client cash transactions with other banking partners. As of close of business Friday, March 10th, Coinbase had an approximately $240 million balance in corporate cash at Signature. As stated by the FDIC, we expect to fully recover these funds.
What are they doing currently for transactions? Are all transactions halted then?
Not clear. Let me.
Because that's also.
I don't think so. I just
Kavita, would love to hear from you.
Hi, sorry.
Yeah,
I just moved something. Yeah, hi guys. I just moved something to transactions are happening on Coinbase. Can you guys hear me?
you're cutting in and out a little bit.
Yeah, we can. Yeah, your audio isn't great, but yeah, you're saying transactions are working fine, yeah?
Yeah, transactions are working today. Yes, I made some transactions today. They were working as of like 5 p.m. EST today.
Okay. And Kavita, I'd love to get your thoughts also just broadly on the effect of signature going down on the ecosystem.
Sorry, just to confirm that, when you say transactions, do you mean you were able to ACH money in, out, crypto to crypto? What were you able to do?
I was able to get some money. Yeah, that's a good question. I was able to get money back to my Bank of America account, which is connected to my Coinbase. And this is my institutional account for Delta. So I was able to move that, and I got a confirmation email that it would be settled tomorrow. So I'm guessing some sort of an off-ramp is still working.
Or has not cleared yet.
It's Sunday. Yeah.
True, it's Sunday. We keep forgetting it's the weekend.
Actually, now coming back to signature, I have thoughts, but the reason I wanted to come up is, here's the question. Does anybody have any sort of insight or thought process why Treasury decided or FDIC decided to save Silicon Valley Bank, but not really Signature Bank? Like, do you guys have any idea, any top 3 thoughts around that?
Yeah, I mean, I don't think there's any political will to service a crypto bank, but there's a lot of political will to service a technology Silicon Valley Bank.
Do you think the way most of the VCs from the Valley like created big posts around everyone coming together and supporting Silicon Valley Bank had a lot of political impact, which we were not able to create from the crypto community? Because without Signature Bank, the community in US is definitely going to suffer in a big way.
Yeah, I mean, well, Silicon Valley Bank is, you could frame it, for those that were looking to benefit from this deal, or try and save the deposits, you know, it could be framed that not having creating disruption in Silicon Valley and the tech sector is a big political problem because of the technology war and the technology race at the moment. So anything that would slow down the rate of investment in AI, big data, big computing is a political disaster for the competitiveness of the US. Now, slowing down crypto, well, you know, that's fine for them. They get the opportunity to execute their progress their CBDC. They're way behind on that. They need a bit of time to do that, and now they get to just really think about how they let the adults take over the industry and let JP Morgan step in and let Goldman Sachs step in and figure out how they're gonna service that.
Clarify,
Douglas.
Sorry. What's the distinction in the treatment of Signature Bank and SVB? So depositors made whole in both cases, right? New York State Signature. Is SVB resuming operations, or did I miss something?
No.
So then,
no, it's just the deposits will be returned.
Right.
Oh,
So
they're not resuming operations. I thought they were.
Right. So
they're all being treated the same.
No,
they're all treated the same then, right? So meaning.
Yeah, I don't know of just some sources unconfirmed that it's classic East Coast, West Coast hip hop rap rivalry, but I can't confirm those sources.
I think they made depositors whole, but they shut down the operations of both banks.
That is my current understanding.
Yeah, that's how I read it.
So my feeling about Signature Bank and Silvergate going down, one of the biggest fear is we have been trying to get a bunch of our portfolio companies and a lot of people in the space, some of the multi-billion-dollar blockchain companies, to move to Bank of America or JP Morgan. As a fund, we had some really senior people in the fund. But we have realized that they have some sort of a not clear on the paper distinction, but the KYCs for the companies who have tokens out have been just like going on for ages. And it seems like they are not even ready to do it. But they don't say that this is delayed or KYC is delayed because you have tokens in the market. But if it's just a blockchain technology company without token in the space, at least for Bank of America, we have seen accounts getting set up in 4 to 5 working days.
You could get. I think all of the companies would love to get accounts there, but they can't get them. If you can get a Coinbase and all those companies an account in 4 to 5 days at either of those banks. They jump at it, but I don't think they can.
So I think based on the technology company, again, it goes back to how they are doing the crypto KYC. So 2 companies for sure who are just pure equity companies without any tokens or anything were easily able to open up their accounts. We helped them. It went through
Is that
last
just
week.
because they're so small, no one really knows what they're doing? Or?
Probably.
Yeah,
That could very well be the reason.
If you're a Kraken, you're going to spend the next year significant meetings, and they're just going to want to open up your whole AML policy. They don't necessarily have all the API technology culture that you're looking for. Like it's that's if it was just a question of sending in some documents and opening an account, that's just not the case.
A week and a half ago, and sorry if that was already said before I got here, I think there was a Blockworks article about Kraken reducing their reliance on Signature Bank. And I think it has something to do with them wanting to start their own bank. But I was hoping to find in that article who they do rely on. And unfortunately, it just said number of partner banks. It didn't specify which one. But, as of 10 days ago, it was reported they're just reducing their reliance on Signature. So that doesn't, sound great for Signature as far as their interactions with large exchanges.
One thing you won't see is exchanges launching banks or acquiring banks or any new de novo charters. Anchorage came along at a very special time in history where Brian Brooks was the national bank regulator and the former chief legal officer of Coinbase. Again, a big gift to the industry. It's hard to get a de novo charter, even if you're not a crypto business. So I know there are a lot of business plans out there talking about that. It's just not going to happen. Not with this administration.
What's interesting is the spokesperson for Signature Bank in that article wanted to make it clear. It's the only quote in the article. We're not just a crypto bank, and we want that to come across loud and clear. Yeah, it's pretty silent, I guess, now.
So is the situation now? I mean, obviously in the non-crypto financial sector, the situation seems at least for the short term, have been resolved. I think Pranav brought up a really good heuristic, which is we're going to look at the banks, see who's really getting affected, where stocks are dropping significantly Monday, Tuesday, Wednesday, and then make our decisions around what happens to our deposits. But in crypto, I mean, I hate to use the word, I know that, but is this, we
and where people probably don't want to go out of crypto unless you have to, because they know it's going to be challenging to come back in, or they just want to get the hell out and never come back. And I think the majority want to stay in. So it's a bit like, I got to work through the game theory, really.
How is it not a massive opportunity? I mean, maybe I'm looking through rose-colored glasses and I'm just a eternal optimist here, but early days for crypto, I'm an early adopter of the space, a decade ago, and I still think we got a long way to go, clearly. But how is this not in the wake of all the carnage that has taken place in the last 12 months? You can take the other side of this and say, wow, that's one hell of an opportunity for someone to actually get it right and to get some trust and have things work out. I know here in the short term, it's bleak. Crypto winter is an adequate term, nuclear winter, if you will. But I've been around since Bitcoin's been $400 and have been through God knows how many drawdowns. I expect that will continue in the short and the intermediate term as well. But still, massive opportunity out there for someone to get this right, regardless of how difficult it is. I mean, big rewards come to those who are obviously willing to take on the toughest challenges. It's a massive challenge, but
do you mean on the banking side? For a bank?
Yeah, on the banking side for sure. I mean, someone to come in there, establish themselves as the bank, collateralize it right, get it right, earn that trust, be respected, might be several years off from that, but God, is that just one absolutely massive opportunity for whatever organization manages to figure that out, and obviously a great thing to have in the crypto.
I will say
ecosystem.
just so people are, so I don't know if you all know Geeklist, but the founder Ruben Katz sent me a message in the back saying actually that this is the real point. His belief is that Yellen actually planned this, and I believe that this is going to be the narrative in the space, not with you, but in general in the crypto space, that the goal was always to shut down tech banks and fiat on-ramps in crypto. This is the real story. Is that just us losing our minds because we've been on spaces too long, or is that a reality?
Yes. Well, so first off, I totally agree, Douglas, with your point. There's a gap in the market for a trusted institution. We've seen the demise of Genesis, Gemini, BlockFi, Voyager, and a number of these banks. And trust still matters in a trustless world. You need a place that you can custody, store, and move money, and you need a 24/7 TradFi layer to sit on top of the 24/7 crypto layer. So I totally agree. It's a big gap in the market. I know several people working on that. So if anyone wants to get involved with that, DM me. It is a multi-year play. You got to have people that have known the regulators, have worked and operated in banks, so that the regulators trust that management team to stand up a bank and enforce compliance and the laws of the land. I think on the latter point on Yellen, it's not a conspiracy. She has made policy decisions that don't favor crypto. So yeah, look, that's the case. She's the person in the Treasury Secretary seat, and that's her prerogative. That's a decision she's making, unfortunately, for crypto.
Could they have saved signature in Silicon Valley? Mario, did you have a break?
Yeah, I want to move off quickly from crypto. I know I brought up Umbrella could give us more insight there, but I've just Zero Hedge asked the following question. I'd love some thoughts on it. So the $25 billion bailout, I'm going to quote what Zero Hedge said. With approval of Treasury Secretary, so the question essentially, will that stop the bank run? Is $25 billion enough? I think Wahid touched on this earlier, Danish. Maybe you can mention what Wahid said, because you asked him that question, I think.
Yeah, Wahid's point was that, as we look at the, so pre-run, Silicon Valley Bank was only asking for 2.25 billion in equity raise. And so 25 billion is actually this open window. It's sort of the idea here being that when you sell the equities that you have, you want to just cover your losses, and those losses, those defaults can be 10% of the total amount. And so that's really what they're shoring up, which will, you take 20 billion, it's 2 billion. So that's the example that he gave on the space. Ram, do you agree with his estimation that 25 billion will actually in fact be enough?
I would say I would look at it differently. It's not so much the dollar amount, it's the tone, the message that the regulators are sharing around how they want to handle the situation. And what they did is they invoked the systemic risk exception, right? So they pulled the red fire alarm and they took steps to ensure depositors were made whole. Remember, that was a big debate, Mario and Danish, that we had yesterday, right? And the view, my view and Akim's view is they would make depositors whole, but zero out the equity. That's what they did. So that's the most important tell. It's the size, the 25 billion. That's not really it. They're going to pull out the stops. They've already labeled this as systemic. So look, we'll see what happens First Republic Bank tomorrow. I would expect that if you see a line around First Republic, there's 10 times that size line digitally. But the FDIC is going to do whatever it takes to ensure that there's no further contagion.
I got a very reassuring email from First Republic Bank today. As someone with multiple six figures of student loan debt refinanced with them, I want to make a joke about if they go under, my debt goes away. I know that's not the case, but again, very reassuring email. $60 billion in collateral. I can't see all jokes aside, can't see First Republic Bank having any lines outside its door. I did have some clients over the weekend who bank with them express their concerns, but they weren't They weren't that great. I think their deposits were worthy of having some concern here, but I hate banks in general, and I got to tell you, this is a biased statement, but First Republic Bank is actually one of they're not paying me to say this, but one of the best banks I've had the opportunity to actually work with, and trust me when I say it takes a lot for me to say anything like that.
So just want to ask you, if anyone can give us an update on the markets. Someone sent me a piece from CNBC talking about Asia markets, Asia Pacific markets trading lower. You got the ASX at 0.24 down. Do these Nikkei, Hang Seng, they're all down? Is that the what you'd expect from the markets? I thought they'd be pumping.
How much are they down, Mario? What percentage? While you pull that up, Maker is pumping 25%, which is really interesting. So Maker, of course, had exposure to USDC, and crypto is trading down on Friday, so kind of like a double penalty. But that's all reversed. So now Maker's pumping 25%, and obviously crypto assets are up like 8 to 12%, green across the board. And then
what's driving
which is around exactly like that. That's a bit odd. Like we're talking about the concerns, with Simon earlier about not having an off ramp.
So to give you a bit of an update on Maker, so Maker have their own stable coin called DAI, which is effectively just wrapped USDC, because most of the exposure on their collateral is actually USDC, even though they're more decentralized in the fact that they don't have blacklist functions within their contract. So, but because of their being the exposure mostly USDC, and they actually have a token available, i.e. Maker, they got impacted quite hard with kind of the USD and the SVB announcements over the last couple of days. So obviously that's now that everything's in the clear, we'll be recovering quite nicely.
And Umbrella, your thoughts, Umbrella? Sorry, Douglas. Just quickly, Umbrella, your thoughts on why the crypto markets are pumping?
Well, I think it's got simple to do, and I worked in an investment bank and treasury departments building treasury systems for many years. So I know exactly how banks work, and I think it's a simple, bank runs, perpetuate the need and the use for crypto. Where else can you custody your own assets that can't be bank run? It's simple, in Bitcoin and Ethereum. So I think that narrative plays well. Obviously, the tech side of it's quite different, and that's more what I'm involved in. But I think that narrative's simple. So the more contagion and bank runs we potentially will see down the line is actually more bullish for the narrative around Bitcoin.
But also, you do want to say quantitative easing will pump crypto, as a message from Joe Santos, which is a good point as well.
I think so too. Obviously, more money coming into the system helps, push prices of risk assets. So I think that's natural. Obviously, crypto is still seen as a risk asset. So that will naturally, obviously, more money that comes into the system will push those out.
Ram and Douglas, I want to get your thoughts. And sorry, Dan, it's just I'm a bit curious. What do we see? What do we expect from the Fed now? And if the Fed does ease up, it's a bit less hawkish. Do we see a reversal in equities and crypto?
Yeah, so first off, Coinbase is operational. That's why crypto's pumping, right? So that's critical. By the way, let's see what Coinbase stock does tomorrow. Curious. I think it'd probably move in sympathy. So that's one. On the Fed's it's a business as usual now, right? So I think the Fed lays the course, does 25 bips. Now, by the way,
Douglas,
before the Fed announcement, we got a CPI print coming between now and then. 1, 2, we're going to see how markets open in the next few days. And 3, we're going to see whether contagion was in fact. So anything we say now, by the way, is total speculation. No one knows. We got to live through the next 3 days to find out.
Really, Ron? Really?
Great comment.
Yes, Douglas.
We never speculate here.
Never. No, everything here, source, trust me, bro. I think on Friday, so a few things. Number one, the main headline on Friday, right, was around jobs. And then you watched, before 10 o'clock came around, Silicon Valley Bank literally spooked the markets and trumped the largest headline of the day, which should have been the largest headline of the day. There were 3 narratives happening on Friday, so it was such a noisy day. The third narrative was, we literally went from Thursday, the Fed Jerome Powell coming out and being like, yo, you guys wanted this pain to stop this summer, get the fuck out of here, that ain't happening. We'll go hard and heavy if we have to. And then you got a 60 to 70% priced in on a 50 basis point hike literally within 24 hours because of this bank scare. The market starts to price in and starts to head back towards that 25 basis point hike. Now with where you see yields on the back of bank failure, I actually agree. I think that CPI print probably drives everything. Wait for that. That will dictate.
To be fair, we know the jobs print that just came out, so CPI is likely going to be positive as well.
Yeah. Well, listen, I'm not going to even speculate on it. I'm just not. It's so wishy-washy, week to week, month to month, that I'm just going to say that CPI print is almost going to be all the marbles for what the market's going to bake in on a 25 versus.
If the CPI comes in hot, do we expect possibly going to 50?
Yeah, if that comes in really hot, market's going to go right back to that like 60 to 70% pricing in a 50 basis point hike, which I'll put my tinfoil hat on here and be like, JP is just going to head fake you on that. Let the market price in 50 basis points is my wishful thinking, and then deliver 25 market rip. But that kind of nonsense and commentary and speculation all aside, the thing to point out here is you went from 50 basis points priced in on Thursday to 25 within 24 hours, and now we're going to have to wait on the CPI print. So it's all fun to talk about. Let's see what that inflation report looks like. That is literally what everyone, or at least the Fed, is looking at in terms of how good of a job they're doing here on the rate front. So hang tight, guys.
Rates being cut this year?
Rates being cut this year? Yeah, if fucking shit hits the fan, we're going back down the other way. QE. I mean, this is my take is how, if there's in mass layoffs, if the other shoe drops, if whatever, causes the capitulation in the markets and primarily the job market, we're going straight to rate cutville and easy money once again. And there's no shortage of commentary from real smart people and dumb people alike saying, that's what's going to happen, and you can almost guarantee it. And I'm not in the game of being like, this is certainly what's going to happen. I mean, anyone who says they know what's going to happen is probably full of shit.
Yeah, we all are at some level, I guess. But
we're all full of shit.
Yeah. So, it seems like the situation, at least at face value, on the financial side, on the banking side, has been resolved. We still have to watch the CPI report. We still have to see how things will go. Ram, what are you looking at outside of the CPI, which we just discussed? Outside of that, what are you really looking at on Monday to make?
I'm looking at the S&P futures, where if there's a market up down, and if it's severe, like 1.5%, 2%, I'd be inclined to lean into that and be a buyer, just from a tactical trading, not offering any financial advice. By the way, I'm not expecting that. What I'm saying is,
I was about to say, I'm 2% down at the
right
moment.
now. I'm not expecting. I'm saying if that happens, because people take time to process the news, right? So if there's some news around coals and all this other stuff, and you're starting to get more. The Wall Street Journal, Barron's headlines are moving into kind of retail press. So if there's a retail overreaction, I would take the other side of that. I don't know that that's going to happen, but sometimes you see these things happen. I would look for that. The other thing I'd look for is the regional bank index, and also the stock price of a handful of regional banks. And obviously I'd look at the VIX too. But look, I think a lot of quality names sold off. Baby got thrown out the bathwater on Friday, right? So, Morgan Stanley, JP Morgan are very different than these regional banks. So I think there are some opportunities there. And if the implied volatility is still high, you can reduce your cost basis to get into some good positions with some high quality brands with a good moat that I think can do well.
Yes, yeah. There's probably discounts out there on regional banks and financial stocks. I make no investment advice here, but if you're looking, that's the thing to pay attention to. We've, I guess, in light of this news, all but should feel pretty comfortable. We're not going to allow deposits to be at risk at any smaller or regional bank that. And if I was the Treasury or the Federal Reserve, I would be deeply interested and looking for, hey guys, who else kind of fucked up here with long dated treasuries and fucked up their duration risk management. And hopefully they're smart enough to come forward and be like, yeah, we fucked that up too. So that is something to definitely look at when you're checking out stock prices and battered up companies. Just an interesting play. Again, not investment advice, but that's a really good point.
One idea to add, I'd love to get your take, Douglas, too, is on the bonds, right? We saw credit spreads blow out as well, including like preferreds and others. And I think, look, as I said, my view is higher for longer. I think you have a kind of a slow grinding down in the economy, especially as the excess savings burns off. I think, look, we've had 6 quarters of earnings decline. I think you're going to see 2 or 3 more quarters of that as well. So that creates pressure on S&P earnings. And of course, with yields higher, that creates pressure on the PE ratio. So it's hard for S&P to get above 4,100, obviously going to the 2 most bullish periods of the year, March and April. But I like bonds. Bonds are great. Short duration, senior bonds. And if you get an after-tax return of 7%, why wouldn't I pull those down and then wait for some kind of dislocation and then then lean into risk? But Douglas, I'd love to hear your take on that.
Yeah, no, I love that you're talking about fixed income and the bond market. That in my opinion is really where the action is. And if you're paying attention to what lights are flashing there, you kind of really are tapped into the economy. Everyone, I get it, loves equities. They're sexy, no doubt about it. Bonds tend to be boring, but obviously the much bigger market and a bigger dictator of kind of state of play. So to answer your question, whoever took the Fed at their word in the beginning of last year, end of 2021, and went short duration, because again, by taking the Fed at their word, that means you believe they were going to hike rates, and boy, hike rates they did, right? So you go short duration on fixed income, you avoided, or hopefully mostly avoided, the worst year in fixed income in a century. Think about that. Worst year in fixed income in a century. Now, what's the other side of that, right? Opportunity, right? You're going to go buy that dip. And if you then said, okay, kind of the bottom's in here and I need to go back long duration, or now is the time to go longer duration, you were handsomely, you not only started to get delivered those rewards, but you left Friday in the market looking at, duration just kind of drop there. So look at the 10, you look at the 10-year, right? We were flirting above 4% just a week ago, and right now it's 3.669, I think, something like that. Nice. So you're kind of getting rewarded there. And the way I think about fixed income is this: Fed's made it clear, at least at this point, that they're going to continue to hike rates. Obviously, rates go up, bond prices go down. But if you want to hedge against, truly disaster on the horizon, or a hard landing into a recession, where you want to then believe the Fed is going to go back to QE and lower rates, boom, you're making money, obviously, on buying bonds at current yields. And there's the opportunity that you're mentioning. So, again, I'll always say this because I have to. It's not investment advice, but I view the fixed income market as something that's particularly worth watching, and perhaps full of some opportunities here. I mean, 10 years at treasuries at 5%. Reinvestment risk is real on that, but wow, you haven't seen it in 15 years, folks. So I appreciate you bringing up fixed income. Nobody likes talking about the boring stuff, but perhaps
I will say that surprisingly, while we've been talking about fixed income, the number of people has increased. So I guess there's a lot of people are interested in fixed income. Which is weird.
Welcome to the bond show, guys. Let's all get stoked for treasuries. And I just want to say this one last thing, because I've been hogging the mic and shoving food in my face at the same time.
Well, what I was going to say is, I've been getting a lot of requests in the back end, and just want to let everybody know that's been sending me DMs. We have reached out to a lot of the VCs that were affected, that were going around and doing these talks, including Jason and others. We're going to give them a victory lap, but I'm more interested in seeing how this actually affects VC decision making moving forward. And so, as people are going through this, happy to chime in. Douglas?
Yeah. I'll finish on this because I've been hogging the mic. Number one, again, back to opportunities. It's going to be hard. It's going to be hard not to imagine that a lot of money over these next few days and weeks is going to flow out of these smaller regional banks and into your too big to fail banks because they're spooked. I think you're going to see a lot of that, and I would be interested in knowing what the ramifications are for those banks and watching those deposits leave in mass. So watch that. And then number two, I regret it was so kind of fresh yesterday when we were doing this space, and it went on forever. But nobody pointed out, and this is just the humor side to me, the absolute irony that a bank that specializes in venture capitalism, their mistake was with the safest and most boring investment.
Exactly. I mean, like, it's how ridiculous.
On treasuries, you guys, come on. Just if you follow my account, I basically tell jokes and find the humor and try and educate in this. You have to laugh at that irony, and I say laugh in a way where we're not laughing at people who potentially could have gotten really hurt here. But come on, VC-backed bank makes wrong bet on safest investment on earth and causes what we've all experienced over 70. You can't. This shit writes itself. Come on.
That's right. It's craziness. And so what's really interesting though is as we were talking about ramps for crypto, the actual VC industry relied on SVB for smoothing out and speeding up the VC world. For people that are not aware, and again, if VCs duping them in, and let us know, send Mario a DM on the back end and we'll get them up. What's really interesting about what's going on is there's been Silicon Valley Bank gave VCs the ability to be able to wire funds before their capital calls. That sped up the VC industry by a crazy amount. Just imagine you come across a founder, you come across a company, you're getting into a deal, and you don't even have to wait for your LPs to get the money into your account before you can wire money. It was a crazy time. This is not just 2021. This is 2021 and 2022.
Yeah, But that's kind of like the big lesson here that I would hope, the VC world takes to heart here, where maybe some pause, maybe a little half step to a full step back of how you want to be running operations and thinking about fundraising and thinking about banking relationships and thinking about risk. There's absolutely nothing wrong with taking that half to full measure conservative step here, especially at a time where it's extraordinarily clear, the 2020 through 2021 and a little bit in 2022 days are done, for lack of a better word. And that's because of rates. And holy shit, what a lucky break that, these deposits are being backstopped. The cardinal sin would be for this particular type of thing to repeat itself in the short term because VC didn't get the fucking memo. But I think they will. I hope they do, because as someone who is very much pro-capitalism and loves seeing success stories out of entrepreneurs and is an entrepreneur himself, there's something very nice about there being an institution that back that kind of American dream startup type stuff. I'll disregard, this was this by the way could have been spun absolutely shittily, pardon my language here, it's not a word, in the direction of, this is just wealthy VC, Silicon Valley. This country would not have appreciated a lot of the optics around this. And I think here in these chats, we do, right? We do. You hopefully can take the objective stance of realizing that people weren't going to get paid from payroll, that founders who went all in on their businesses and our success stories are being dealt almost fatal blows if this didn't go the right way. And at the same time, like, two things can be true. Like, that super sucks. And on the other hand, bank made fucked up decision, a bad decision with greed over with 40 basis points in yield, and simply believed that we were going to exist in a zero interest rate world forever. What a bobo move. And there were stock sales from officers leading up to this. I seriously hope that we all can view this in an objective light and know that these two things are true here. And again, the cardinal sin is walking away from this experience and not changing behavior in the slightest. If that doesn't happen, then everybody's going to get what they deserve when the water goes out again.
I mean, we did have 2008, and it was the same people that, if you read all the stuff. Lots of people from Lehman and the senior leadership at SVB. I feel like some people just never learn. But I was going to say that, again, our goal is to now start exploring the different sides of what's happened. So we talked a little bit about the crypto side. Name redacted, would love to get your thoughts on the banking side.
Actually, I'm going to ask him a different question. Name redacted. 3 minutes ago, Congressman Massey tweeted something that you'll find very interesting. Now, for anyone that doesn't know, Name redacted has been in our space. He's anonymous, but he's been in our space multiple times, blowing the whistle on censorship. Now, I don't want to start discussing censorship because it's unrelated to this topic, but it's a perfect tweet. He says the following: just got off a Zoom meeting with the Fed, Treasury, FDIC, House, and Senate. A Democrat senator essentially, a senator essentially asked whether there was a program in place to censor information on social media that could lead to a run on the banks.
Well, did you have a question, or you want me just to go?
Yeah, but
yeah, I mean, as we've discussed on the other spaces, when you get into, and I'm not going to go off on it, but the short story is, the CISA censorship apparatus that was created ahead of the 2020 election. We've had multiple government officials say that, at least in the work I've done, that they're using this and they view this partnership between government and social media as the model of the future. So yeah, we know that, they censored COVID information, any sort of misinformation that they thought would, fall under that, that machine that they built. So, I mean, that is actually an interesting tweet that Massey put out, and I don't know what they would do there. I mean, yeah, technically, if people are posting videos online of lines outside of a bank that could cause bank runs or whatnot, or fear or panic, that clearly, a threat to the banking system by, say, fake news, or who knows what it is. Yeah, I mean, they could use this same model to censor that sort of stuff, because you could see people in the financial market be short these securities and start spreading, false rumors online. So I wouldn't put it past them to be discussing that for sure.
Hey, Mario, no, it's a great topic.
Yeah, go ahead.
There are two policy topics here. So one is, of course, these are banks born of the internet: SVB, Tech, West Coast, .com, etc., and then Silvergate, Signature, born from crypto and also destroyed by the internet, meaning the speed of digital bank transfers and social media. But what we've also seen is how quickly social media can be used to impugn the reputation or defame a banking institution. Now, all banks rely on public trust. All banks are doing duration mismatch. All banks are borrowing short, lending long. There's no liquidity ratio or tier one capital ratio that can make a bank immune, right? So it's a legitimate question. I stand for censorship resistance. I find that's a very attractive property around crypto. A lot of people around the world in certain regimes don't benefit from censorship resistance. At the same time, though, these public banks are institutions and they provide credit growth. They play important roles in intermediation. So it's a legitimate policy question. The second policy question is this: well, why couldn't SVB and Signature be bailed out by Blackstone, Google, Microsoft, or just venture capitalists or entrepreneurs? That needs to be fixed. There are antiquated laws. Now, for those of us that are lived through two cycles, I'm sure, Douglas, you probably sympathize with this. Remember, like in Walmart, they tried to buy a bank and they were denied. There was a big pushback from incumbents. Incumbents means the legacy banking layer today that we deal with. That's brittle. I'd like to live in a more vibrant world where you have capital, private capital from tech, from private equity stepping in, and new technology. And the current laws don't enable that. And that's why only banks can buy other banks when they're in distress. And banks don't want to buy other banks when if you're JP Morgan, you can get the deposits, you can acquire the customers, and you don't want to be in the venture debt business. So those are the two policy topics that we need to focus on.
Yeah, so one other thing on the censorship aspect, I honestly don't even think that's going to be possible to do, because you have someone like Charlie Gasparino, who is very plugged into, Wall Street, and has a lot of good sources. He'll put out, according to sources, X, Y, Z is going to happen. And he did report on, these decisions that ended up happening on Silicon Valley Bank. So, he could also, and what happened during the financial crisis, he was one of the main reporters putting out, sources are telling me that, such and such bank is going to slash their dividend, or they're going to do a capital raise. So that's, technically hearsay. So, if they get into a censorship type game, then where do they draw the line? Do they start censoring, media, journalists like Gasparino? Because his reporting back in the financial crisis, people watched what he said on CNBC, and he would come out with something that would drive the market down 2% in like 10 minutes.
Yeah, we would see often, one of the things we talked about post-COVID was how everything they put out there, the stay-at-home orders, the censorship, these are just tactics, right? And essentially the Democrat on this call is calling for permission to use those tactics in what they term as an emergency. But coming back to the question of the day here, the two other banks that are going down now, I mean, obviously they may have been impacted by some of the rushes that we're having over the weekend, but I'm guessing that the balance sheets on these two guys were always crap, at least for the last little bit. And now the Fed is like, oh crap, we better just get ahead of this now, which means they probably took their eye off the ball. Am I right?
It was a bank run. Bank run took them out. That's it. Right? SVB, you could argue, had issues in their venture debt portfolio. I would make the case that venture debt portfolio is not worth par value. Right? These are loans to unprofitable tech companies, and those valuations are a lot lower. But Signature had a diversified business. Their crypto deposit base was much smaller than other banks. But if you have a bank run, no bank can withstand a bank run. The bank goes down, and Signature was exposed.
Yeah, and that happens so quickly too. I don't know that the regulators really had a time, because they had 42 billion withdrawn in a day. So that's all they had.
I can't speak to the how quickly the regulators sniffed it out and got involved. But if you're SVB, you've been watching this happen for a while now, and I can't be convinced out of that. You've been watching your bond portfolio, your hold to maturity portfolio just go down and down and down in value, and you've been watching outflows of deposits increase and increase and increase for weeks, if not months. So yikes. There's certainly a lot of time there, relatively speaking, for the regulators to say, what's going on over there, whether they kind of snuck in for an audit or they caught some kind of whiff of this happening here. But yeah, I'm trying to be equal-handed with really a fuck up, an error on the bank's fault here in the decision they've made to simply not manage duration of that portfolio. You made a bad move, and there's a lot of other shit that happened that doesn't look great either.
To be fair, would that have happened had there not been a bank run?
That's a great question. Certainly things were trending that way. I think it would have, and I'll take a stance on that, to the extent that those withdrawals from the pot, they were watching those outflows happen because they couldn't offer attractive yield. So depositors were like, shit, I'm going to go get yield elsewhere. So you're watching that mount, and you're also watching your unmarked portfolio of treasuries here get absolutely fucking wrecked. At some point you have to say to yourself, if this continues, or if there's an acceleration of requests to take money out here, we're fucked. And on top of that, again, you can't escape the fact that officers are selling their shares into this shit. It looks bad. They're like, why are we glossing this over? It has to be talked about, and it has to be looked into. I'm not trying to be the cop here. I'm just looking at fucking what happened right in front of me, and we don't talk about it enough in these conversations. It's fucked up. They made a bad bet. They fucking made a stupid decision. They didn't have a chief risk officer from April of last year who also sold shares before they left until January of this year. It's shitty management. No matter.
Yeah, and if you look at her profile, the chief risk officer, she spends an inordinate amount of time talking about ESG. In fact, every single panel she's been on, everything she's been, has all been around ESG and DEI and all these, acronyms that sort of kept them in favor with the crowds. And I think there have been some outrageous, maybe over the top remarks on that. But I think there's some truth to the fact that maybe, their attentions were held elsewhere.
Well, also to add to the mismanagement and how bad things were being managed at Silicon Valley Bank, they had if they wanted to, they could have spent the last 6 months raising capital through like at the market offerings.
Bingo.
To bolster their capital base, and they did nothing. And once it became too late and they tried to do an offering, it failed. And
it's all just so classic. It's almost cringy how classic it was. And the video. I mean, come on. It's just like for real. And what bothers me the most is the amount of people that are like, huh. And then you have the minority of people being like, the fuck? Like this is happening. This is the same shit as it ever was. It's just history repeating itself here. There should be outrage about that. People definitely need to be held accountable for the atrocious management here. Everyone's so quick to be like, they shouldn't do a bailout this, they shouldn't do a bailout that. Why don't we first just pay attention to what actually happened in terms of bad management, and then we can go talk about backstopping things here. But again, both can be true, guys. I'm trying to view this from both sides as equally as and objectively as possible. So I appreciate y'all entertaining.
I want to mention one more thing, then I'll be quiet here on this part. But while we talk about capital raises and this firm, Silicon Valley Bank had the time to do this. They knew they were sitting on these mark-to-market losses, right? Well, we now obviously know that there's over 600 billion in these losses sitting on across the banking system. So the problem now, though, is as far as I'm aware, we haven't seen any banks go to the market to raise capital. But now, after 2 banks have failed, it's sort of going to be a stigma if any bank announces they're going to do a capital raise, and you may wind up with the same thing. So that sort of worries me going forward.
That's why some of the things you guys are saying, I disagree with, because I pinned to the top the chart, found water. He's held to maturity security.
They only had 16 billion in treasuries. 75% of their assets, investable assets, were tied to mortgage-backed securities, commercial mortgage-backed securities, or collateralized mortgage obligations. That's 75% of their 120 billion portfolio.
Yeah, I understand that, but the ones that were most underwater were actually the treasuries. They're worth probably 30 cents on the dollar if you look at them, just if you were to go to market right now.
Right. Well, the solution is stop bank runs, and that's what the FDIC is intent on doing. If the banks can hold to maturity, they'll make money on the bonds. I did expect that First Republic and at least one other bank would do a private raise of the week, and haven't seen that yet. I expect that may still happen, and it might be a condition of the FDIC creating a ring fence. One other thing to point out here, though, is that it's not obvious that Signature had bad management mistakes. SVB did. SVB also had board oversight issues. But Signature, it looks like they were just kind of too close to the flame. And again, the velocity of withdrawals and their proximity to crypto. So I don't know, my heart goes out to them. It feels like, a bystander there, got taken out. We have to learn more about that, but it doesn't seem like a management mistake.
Yeah, the one question I was going to ask, and this is for kind of everyone, is what is the perception internationally? And the way I'm looking at it, I can be looking at it totally wrong, but the way I'm looking at it is we just gave our biggest treasury buyers a credit line, basically, right? And we're not doing the same for the countries who bought our treasuries who are now underwater. How would you go back and buy the treasury again, or would you look elsewhere? You're like, they treat different treasury buyers differently, and that's kind of the question I'm battling with. And I don't have an answer. More of a question.
Yeah, Joe, I'll take a stab at that one. I think, if I can break down your question into like a more simple question, is you're really asking, like, is this enough, right? And from my experience, settling tri-party repos over time, and spending most of my career in the financial plumbing markets, when liquidity issues arise, the question is always, is it enough? And right now at 25 billion, I think it is. If you remember, just 2 days ago, Silicon Valley Bank was only asking for a 2.25 billion equity raise before the bank run, right? So that's what they had anticipated needing in terms of equity financing to kind of close the initial gap. 25.
Yeah, it wasn't so much that, Darren. It's. I'll make an analogy. You buy a $10,000 note, that note from me, and my mother buys a $10,000 note. But as soon as she buys a $10,000 note, I also give her a $10,000 credit line. Would you buy another $10,000 note from me, knowing that I treat certain buyers differently? And the analogy I'm making is, you are the international governments that are buying our bonds, and my mom are the banks. If that makes sense.
There's some joke in there, but I won't attempt it here. So
Yeah,
we need some humor. We need some humor.
Yeah, I'll leave your mom out of this. I would just say that globally systematic important banks have come out of this stronger, right? So if you're global systematic important bank, you already have access to liquidity as needed, basically from reverse repo operations right now, and you can get that very cheaply and overnight rates. The regional banks are not part of that primary dealer network, right? So these 103 primary dealers are trading counterparties with the Fed. They're expected to make markets and bid on a pro rata basis treasury auctions at reasonable competitive prices, right? So they have the obligation to step in and buy in those treasury auctions at those competitive prices, and for that they do have a competitive advantage. Regional banks, were not part of that primary repo system, and for that they came under a liquidity crunch. I think, ultimately at the end of the day here, the JP Morgans, with the Wells Fargos of the world are going to come out smelling like roses when, ultimately this multi-tiered system that you're identifying now has already been in place for decades.
Okay, well, I have a question to pose, Ram or Douglas. Your expectations of the next Fed meeting. We have, the S&P futures up 1.25%. The dollar DXY dollar index is down 50 cents. So I saw Zero Hedge tweeted out that the 2-year rate's down like 12 bips or 6 bips, I forget. But what do you think, in light of 2 bank failures, that the Fed's going to hike at all?
I think we and no problem diving into it again. I think right before you came, we actually talked about, or at least I did talk about this. Happy to do it again. And what we had said, just a quick little summary on that, is like literally from Thursday into Friday, we saw a 50 basis point hike with a 60 to 70% probability as far as what was baked into the market, what the market was thinking, and then that immediately removed within 24 hours when the Silicon Valley Bank news broke. It is clear, it is very difficult for me to see heading back to 50 basis points. But in conclusion of what we were talking about last time, it was really, hey, what's CPI have to say? Like that will dictate pretty much what we should be expecting. if that comes in like super scorching hot, I guess 50 basis points could be back on the table. Like that would have to be absolutely scorching hot. I don't think that, but that's just a guess, speculation. 25 basis points is where I'm at as far as a reasonable take as to what you can expect the Fed to do. And to the other side is if that print is showing inflation cooling and going in the direction, if not significantly in the direction, then yeah, maybe you'll start to see some action on no hike. But to your point, Name, I can't imagine 50 basis point in light of bank failures, anything greater than 25 basis points. And I will now entertain, contingent on the CPI print, which I think again will dictate all of this. I guess no hike, but nah. My gut tells me we're probably more back to business as usual, as if it was Wednesday of next week, and we would still be waiting on the CPI print to see if Jerome Powell would come off of that threat of a 50 basis point hike. Because you got to remember on Thursday, I think it was Thursday, which is why there was that sell-off. He was just like, fuck your calls. If you wanted us to stop this summer, get a grip. We might go 50 basis point rip. So sure, I'll put a little bit of probability on a no hike in light of this, but you're going to need a really chilling CPI print to really push that envelope there.
Well, on the CPI and inflation in general, that seems to be what we come back to again and again.
Yes.
And we could probably hold an entire spaces on that, right? Because there's a lot of concerns, a lot of criticism. I'm in sort of the camp of Jeffrey Snyder. I believe there is this kind of whiplash thing that a lot of the deflationary stuff that we're seeing is because of the loosening of the supply chain issues happening through COVID. But I want to get some takes up there. Obviously, it's a huge influencer on this entire endeavor, and I don't think I have a clear vision as to whether it's Yellen. This is transitory. I think she's been proven pretty wrong there. But there's stuff that's sticky, stuff that's just transitory. It's a mess out there, and I think that's part of the problem. It's just a whiplash scenario, right?
Yeah, exactly. And by the way, this is to your point. This is not new. This has been the consistent theme. How many prints have we seen that have pushed and pulled us in a multitude of directions? The bad news is good news narrative, I think, got injured a handful of times over the last several months, but more in favor of we really haven't controlled inflation to the extent that Jerome Powell and the Fed want to see it. And yeah, Justin, I think you just hit the nail on the head here. Like, there's just been nothing consistent. Here is now another rather large noise factor that, I guess we'll see come tomorrow where, futures are up. They like it. We spent the front end of this here this evening talking about crypto and it being resilient too. I wouldn't read into shit. I wouldn't read into any of it. And I would just look at that CPI print to really be the thing that's going to dictate the next leg.
Yeah, I'm sitting here at a kitchen table that I ordered in July of 2021. It didn't arrive until March of 2022. Somehow they found it in the morass of the boats off of Los Angeles. I'm here in San Diego. But, a year, maybe just over a year ago, the ports were like packed to the hilt, miles you could see out into the distance to Catalina,
Justin,
and now it's completely empty, right?
Justin, we just got the warning that Mario's having connection issues, so the space is going to crash in less than a minute.
We'll probably regain, because we're really keen on this thing. We've got 15,000 people here, so I think Mario will probably restart that. Let me ping him before he goes off in the Netherlands here and make sure we're going there.
We're still alive, guys.
Yeah, well, we're still alive. Go ahead. Yeah.
No, Justin, finish that thought. The ports were backed up out to halfway across the Pacific Ocean, and now they're empty. And you would think that, hey, all right, things have been resolved here. Inflation should be coming down, but goods and food have been leading the charge here. We've memed to death the cost of eggs, which wasn't going up in price for the reasons that people thought it was, but be that as it may, again, all roads are leading back to the main narrative the Fed wants you focused on, and that's around inflation, and that's around the CPI print, and that will dictate what rates are, and that is dictating the stock market and the capital market.
Douglas, you know what's funny? I follow something, a website called Trueflation.
Yeah.
And basically they tried to create a real-time CPI or inflation index on chain, and it's done a pretty good job. I've been following it for a long time, and they're typically within 1 point. This is the first time they're 2 points off, and it's printing 4.6 on Trueflation. So I'm wondering why. Like, why are the numbers off for the first time ever? Is it because they want it to be? Did they change the basket? Like, you know how it is.
Yeah,
they're always doing things to get their way.
Yeah, I want to answer that. Oh, there's our host is having connection issue again. We're on thin ice, guys. I want to answer that with, I think there's a huge entertainment factor into finding that site. It is very interesting to see that margin.
Just to let you know, if it does crash, we are definitely restarting. Sorry to interrupt. Please continue.
Oh yeah, no worries. It's always cool to see new reports like that. I usually chalk it up to mostly entertainment value. At the worst, at the very best, another data point that we can all use with all the other noise and data points that are out there to hopefully draw a reasonable conclusion of which way are things going to go. But again, I'm lucky. I'm mostly a buy and hold, pretty beta passive guy here. These things, don't faze me. It's about discipline and behavior. So I have the luxury, just full and fair disclosure, I have the luxury of listening to all of this and sorting it through and knowing that it's really not going to create too much of an impact to what I'm doing for the people that I serve. But hey, good on me for having more fun than people who have a much more stressful job and day to day when, these bits of information they act on and make investment decisions around in hopes of generating alpha. Tough job. Hats off to all of you doing that.
I've got a question. Hopefully, I get an answer before it crashes. But basically, in the report from the Federal Reserve, it says SVB depositors are going to get their money on.
Right, we're back. Can you hear me, Slayman? Is it working?
Yeah, we can hear you.
Well, Joe, how are you?
Oh, good. If you want to make me host temporarily, I can help bring up some of the people.
No, it's
and
all
then
good.
take me off.
Watcher Guru's. No, all good. Watcher Guru's here. Just takes a few seconds to bring everyone up. Takes me a couple of minutes. What was the conversation left at, Joel, before it dropped out?
We were talking about the Trueflation indexes and how they don't match with
What's your thoughts? What are your thoughts on the developments we saw in the last few hours? Because you're generally the more pessimistic person when it comes to most things, not everything.
Yeah, I mean, I always try to play devil's advocate with things, and a lot of times I do agree with what people are saying here, but I still try to bring a different point of view. And I'm a bit worried. First off, we're doing QE again, basically, right? So exactly what we were trying to stop, which was inflation. Although bank runs stop that, QE starts that back up. And then I worry about what the next round of bond sales are going to look like, because I feel like although regional banks and the big banks get treated differently on these bond sales, there's one more competitive advantage for American banks to buy treasuries, because now they have a credit line for their depositors, and places like China or Germany or France who also buy these treasuries don't have those same benefits, although they're also underwater. So I'm wondering how many of them are going to jump in back to buying one of our bonds. I'm sure if we start to lower rates, that changes because it'll be attractive, but I'm just curious. I don't know the answer. It's just what I'm kind of debating. But overall, I think they acted a lot faster than I thought. I thought the Democrats were going to be soft-handed because they were worried how this would look. I think they got around that, and they were able to act sufficiently enough to make sure there weren't bank runs. I think this is a strong enough message that people aren't going to be lining up outside their banks on Monday.
I mean, I was asking a question just before it basically crashed, but my question was this, that from the statement from the Federal Reserve, it does say specifically that SVB depositors will receive their money on Monday. And it's not as very precise in terms of from Signature Bank. Do we have any specificities, or do you think it's going to be?
No, they said the same thing for Signature.
Do you have the link for that? Because a number of people were asking me actually, specifically from Signature.
I don't. It was pinned in the nest before. I'll look for it again and pin it.
Thank you. So, going back to what we were talking about, Douglas.
Yeah, I'm curious, guys. I'm actually Douglas and Simon. I'm actually genuinely curious what we see for crypto over the next few months. We've been through. Maybe I go to you, Simon, first. Like, we've been through hell. The last 6 months for crypto. Like, imagine a year ago, 2 years ago, we're having this discussion. We're like, hey, by the way, FTX is gone, Signature's gone, Silicon Valley Bank is gone. A lot of FUD around Binance. Luna's gone. There's not, and now with the off-ramp potential issues with the off-ramp, while new banks might come in, but none have come in yet. What could we see over the next 6 months? Could we see a drop in liquidity?
Geez, yeah. I got to bring back the optimist take I had earlier, which is massive opportunity to build something here that is trustworthy, that's reliable as far as an on-ramp and off-ramp into crypto is concerned, when almost all others have failed in the most horrible of ways with fraud and scandal, and it's just gross. Good riddance. It shouldn't have ever been that. Unfortunately, it was. I am not, full and fair disclosure, I'm not a Bitcoin maximalist. I'm just a Bitcoin realist and an early adopter and miner in that space. I've had a lot of time, an inordinate amount of time relative to the history, I guess, of crypto going back 10 plus years to hold and learn. The one big takeaway I had from everything over the last 12 months was just upholding my belief in there being a room for a digital store of value, and that's a good place to start. And again, all roads for me kind of have led back to crypto. I appreciate Ethereum. I don't really know what to say about all the other stuff I've experimented with. Web3 NFT is kind of, bullish on its next iteration, not so much flipping JPEGs. Anyways, that's my macro take there. Liquidity issues by removing. There's a part of me that feels like when there's a will, there's a way. And as long as there are on-ramps and off-ramps in existence, converting crypto into fiat can get done. Someone had mentioned earlier, actually, I think it was Ram, talking about, hey, all eyes on Coinbase, because as long as Coinbase is around, the most legitimate, exchange out there, given that they're a publicly traded company. Don't discount Gemini. I have actually respect for the Winklevoss twins. I've used their platform before, other than their staking and yielding platform kind of crumbling there. As an exchange has proven to be pretty dang good. So with that being said, I'm not fully convinced it's going to be the apps. We're already in crypto winter, trademark. Are we going to find ourselves into even colder sub-zero temperatures? Again, bias in this statement. I don't think so. I'm looking to the opportunities that now exist to create that real stable ramp that needs to be in place. God, if I was smarter and knew how to code and had more friends in the space and the time and financial wherewithal, I'd probably be working on that. And I think the more boring and straightforward that ramp is, like literally we do one thing, we get you in and out of crypto, we don't really fuck with anything else. I think that's kind of the play here. I generally believe in all investments, whether it be crypto or securities. The sexier you get, the more opportunities you create to just kind of screw up or make an error. I mean, come on. I mean, that's kind of like the backdrop here, a little bit with what we've seen with the banks here. And I mean that in the context of, yes, of course, the bank that deals with the toughest deals, and there's something very positive to be said about that. When we're talking about Silicon Valley Bank here, they took on that risk. They took on those. They took on the responsibility of working with VC, which is quite the risk premium when we're thinking about things you can invest in here. That's a lot of rambling on my part, Mario. I love that.
No. So Simon,
go ahead.
Just a similar question you're asking, Simon. I mean, Bitcoin has gone up by 10% in the last day or two. I mean, if you can explain what you think the reason for that is, based on what we've seen happen, and then in addition to that, where you see things going.
Yeah, sure. I mean, so in terms of just the short-term trend, I think the logical place for your bank deposit and your stable coins was to Bitcoin, a flight to safety. And I know short term that there's a lot of volatility there, but that's the logical place where you can ensure that
Sorry, Simon, can I just add one more bit to that question as well? Mm-hmm. And when it comes to Signature Bank, apparently 17% of their they were basically dealing with crypto. 17% of their portfolio was crypto as well, as far as I know. So if you can explain it in that context as well, please continue.
Yeah. So I know, Mario, you say that the drama's been insane, and the drama has been insane, but it always has been. It's never stopped. The moment I found Bitcoin, this has just never stopped. It's just constant up and down of craziness. Like, no one said it was going to be easy we created an exit from the traditional financial system and digital hard sell money. It was never meant to succeed. I just can't believe we've got here. So when I look back at the drama, Bitcoin has always been going through these 4-year cycles, and I expect those 4-year cycles to continue. The very first one was just about surviving centralization. So Satoshi Nakamoto mined 1 million Bitcoins. We went from, mining on computers to mining on graphic cards to creating specialist computer to the institutionalization of proof of work. And that first cycle was just about, could this be, from one person mining, could this actually create this distributed network that a government couldn't shut down? And we got through that cycle. Then the governments tried to shut it down, and we had, regulatory attacks. We had FinCEN, we had SEC, we had the Japanese regulator when Mt. Gox went down. We had all sorts of regulators and drama and all sorts of things, and we got through that regulatory crackdown in the second cycle. But then we forget about it, and the third cycle was about each one has halving, and we reach new all-time highs, and we have the drama and the 85% corrections at every cycle. The next one was about surviving money printing. So everybody just started creating all coins and tokens and ICO bubble. And, that in its peak started looking like it was going to disrupt the securities market and all sorts of stuff. And at the end of the cycle, Bitcoin just survives and all this stuff comes and goes. This one was actually about surviving quantitative tightening. So we obviously got created in 2008, last time the financial system had its systemic risk event. And through that whole time, we had low interest rates, we had quantitative easing, and for the first time in Bitcoin's history, we went into a quantitative tightening cycle. Now, was Bitcoin going to survive quantitative tightening? Well, it turns out that you can't quantitatively tight. You can only quantitatively ease. And so the system just finds the traditional financial system just finds a new reason why you have to quantitatively ease, because you got to keep the perpetual machine moving. You got to keep the debt going. And so it looks like the quantitative tightening cycle is over. So the next cycle, as we get through 2024 halving, and the next 4-year cycles will be CBDCs. What does Bitcoin look like in a world where every government has their own central bank digital currency? That will create another wave. There'll be some countries that will, programmatically not allow you to convert into Bitcoin. Other countries will use Bitcoin as a Bitcoin standard in order to drive more confidence in their central bank digital currency. We've got all that to go through for the next cycle. I think the next cycle after that is when humans are no longer good enough at central banking, and actually we have artificial intelligence running our central bank digital currencies, and the only way to control the artificial intelligence is proof of work. And so proof of work becomes a regulator of the central bank digital currency. So we've got all the drama to go through. There's no way in the future that humans are going to be good central bankers. They're all going to be fed all of this big data and all of this artificial intelligence and everything that comes through. And the only thing that gives me hope in this whole thing is to have an exit from the traditional financial system, the ability to own our own money, the ability to spend our own money, and the ability to have a fixed supply that can't be changed no matter what the algorithm says, or the central banker says, or the government says. So we've all got it to go, and there'll be all the drama in between, and there'll be all the innovation that comes from it. But the drama never stops. Those are our big next tests. And I think the 4-year cycle continues.
Okay, thanks. And so I've got a question, Douglas. I know you want to chime in on that as well, so you can answer that. But in addition to that, so it is, if the Fed is going to increase the money supply by offering credit lines to the bank in the amount of unrealized losses due to rate hikes, are we going to see inflation in the coming months? Wouldn't this whitewash the efforts JP has made so far to contain the inflation?
What I first asked, how much cash is that really, or what it doesn't, Mike, I don't know. The first thing is I don't know. Second, the first question I would ask is how much do those lines move the needle? How much does filling those losses, if they were completely filled, really move the needle in terms of having an impact on inflation? I need a macroeconomist now. Stat. Do we have one? No, but I'm sorry that doesn't quite answer the question. I did want to chime in. Simon, I loved everything you said right there, with the main theme being like, yeah, if you're going to be in certainly with Bitcoin is what you're primarily focusing on, and that's primarily what I focus on when talking about crypto. Yeah, like, it's not for the faint of heart. I mean, I love that you rattled off countless things before you even got to Mount Gox. Like, show me hands in the crowd who actually held on to some Bitcoin, when Mount Gox went under, or even know what that was. It was crazy, and it was seemingly such a long time ago, and there was a lot of things before it. And there was so much more stuff after it. You know, you and your, when I say you, the proverbial you, the masses, and your grandmother didn't know what Bitcoin fucking was until November 2017 when you went home for Thanksgiving, and you know it went up to $20,000. And I think for me that was a watershed moment where now that it was kind of known by the masses, you can look from 2017 until we are now. This is only what 5 years and change. All the battles that have been fought and continue to be fought. So Simon hits it out of the park with setting the tone and ultimately the expectations that crypto holders, and let me be more clear, Bitcoin holders should have. And if you, again, have been holding on to that particular crypto for a while, you know this very well. You should be unfazed by a 10% jump in a day, in a minute. Whatsoever. You're playing a long game. You're hoping there's room for digital store of value, and I believe there is a place for that, and that's at the very least, right? That making that statement is a disservice to the builders and innovators who are trying to do something greater than just create digital gold or digital store of value. Truth be told, that's good enough for me, guys. Selfish statement to make. That's good enough for me to have, you know, a multi-trillion-dollar asset class that's digital and it rivals that of a hard currency like a gold or a silver or something like that.
Breaking news. Thomas Massey, the congressman who was in the space with us earlier, he got off a Zoom meeting with the Fed Treasury.
We mentioned we talked about it, Kim, about the censorship. About bank runs.
Oh, you mentioned already?
About, yeah.
That is so hilarious.
Yeah, about an hour ago. It is funny, yeah.
It's an experiment. Everyone who's here should just make a tweet saying "run on the banks."
I missed it, Kim. What was it? I saw it.
It was,
You first, Kim.
Kim, do you want to read out the tweet? Just
so a Democrat senator asked whether there was a program in place to censor information on social media that could lead to a run on the banks. I think we should use this as a moment and have a bit of fun and just tweet out the hashtag run on the bank. If everyone does that, I think this Democrat senator is going to learn a quick lesson not to try and censor Twitter. You know, they learned
at the same time. I wouldn't want to be. I don't want to be. Yeah, it's a fun experiment. I wouldn't want to be responsible for any bank runs either. So I would say don't tweet that, but definitely feel free to make fun of the senator.
Let's have some fun. Let's go run on the bank, baby.
We can't all be as edgy as you, Kim.
But I want to quickly go to Vinny. Vinny, you've been with us since the beginning of this. I think this is the first space about 2 days ago. I'd love to get your thoughts. We are talking a bit more about crypto. Crypto's pumping right now. But before digging into crypto, just get your general thoughts on the response from the Fed. Could the contagion continue? Could things get worse, or we've seen the worst of it, and we could see a continuation of the reversal? Because Asian markets, if anyone looked at the markets in Asia, I meant to check them about half an hour ago, and they were in the red just slightly, but nothing too exciting there. Crypto's pumping. So I'd love to get your thoughts, Vinny, on where we're at.
I don't know what you guys spoke about earlier on. Obviously, I just joined, but thanks for having me. I think it's played out as I said it should have. If you remember from the conversation, is that the Fed had to step up. They had to backstop this, and they're going to make sure there's no doubt in the American financial system, the banking system, because the global ramifications of that, even the local ramifications, it's just too scary to even try and plot out all the scenarios, multiple runs coming this week on the banks, etc. So they did exactly what they said they wouldn't do on Friday, but they had to do today because they had no other choice. What is worth noting is exactly what I said. By the way, they had to move the differential in what the par value of the securities were versus what the mark-to-market value. They had to move that losses somewhere. So my view was that it had to move on to the Fed's balance sheet because they already got $1.5 trillion of it. What's another 600 billion? So now we're sitting at potentially 2.1 trillion, but the 600 billion, it looks like they're going to try and make it back through some sort of bank fee, insurance play, whatever it is. But this also means that the Fed cannot raise rates anymore. Every single quarter point, basically impairs the book even further. So my guess is They've taken on all this risk liability, and they're not going to raise rates much more. Maybe at 25, definitely not at 50, and I think we're going to stop at that point. And so that's just my take on where things are as it stands today. I think that I think it's over. The crisis is averted. I don't think we're going to go back to having this discussion debate. They made the decision they didn't want to make but they had to make, and so it's done. So we can move forward now. I think it's actually telling that they did go after the 3 crypto banks and shut them down effectively. As Signature today as well. So they're going to make an assault on crypto in some way, shape, or form. But who knows? The highest percentage outcome here is that crypto banking moves offshore to jurisdictions where they are crypto friendly, and it just doesn't touch the US. Companies don't get banked in the US, people don't found and start crypto companies in the US, et cetera, et cetera. It's going to happen around the world. So that's kind of the second order effect, I think, that we'll see.
So I've got a comment here. Hold on, man.
Mario.
Yeah, just 2 seconds, man. There's just a comment here, just a different take on this. And I'll tell you what he says. I won't mention who that is. Monday is going to be telling. I still believe runs are going to take place, and crypto will benefit from some VC funds and startups choosing to store some of their reserves into. Oh, he used the word hide instead of store, but store some of their reserves into BTC and ETH. The announcement we got is just a short-term risk on, but next week money will be moving around significantly from regional banks. Is trust? Did they regain trust, or could we see that continuation from the last couple of days?
So Mario, this is what I mentioned earlier on, where we saw this similar in 2008. And I'm not comparing this to 2008. I'm just saying the last time we had some sort of a crisis, there was always an initial euphoric type reaction to the Fed announcement that they were going to come out, rolling out some program, or, what we see today, they're rolling out the BTFP program, insuring all deposits. But then, as investors digest it, there typically is a correction and a continued sell-off, because the investors at some point fear that they're, what else is out there? Who's next? And it's that sort of psychology, and the market's just going to be very, very sensitive to headlines.
People are in general more sensitive after 2008. People are in general more sensitive as well. So something to mention, something I've mentioned over the last couple of days. So we'll be curious to see if anyone else agrees with that narrative.
Well, so I think the people who had their money trapped this weekend at Silicon Valley Bank, I think a large number of people went through some PTSD. I know founders and CEOs that tons of money. I can get some percentage, if Bitcoin, or Ethereum, or cryptos, they're going to go buy some Bitcoin, most likely, or some Ethereum. And people who had their funds frozen Friday, that's probably the first time they've had that happen in their life. And so you will see some percentage of that. People who are standing in line at First Republic this weekend trying to get money out, they're probably going to buy some Bitcoin as well. And so I think you're going to see this some percentage of the money move into crypto. I think it's very bullish crypto. Crypto is still a bit of a macro play right now on global economy, but I think the Fed hiking cycle is over. It's about to end. The other important thing to note is, with these mark-to-market losses, which they're not actually taking, so it's currently not impaired, they have to drop rates, because those losses only really get realized. Some of the mortgages are 10 years or something. So the expectation is they're going to drop rates, and then these marks go back up. I don't know. I'm not a bond trader. I don't understand the system as well as some other people on this forum, but I can say now that, in light of the fact that the Fed is not going to go raise more rates, and they really, really cannot at this point, I think that the market's going to go bullish and the printers go.
But if inflation does not subside, they have to increase rates, and then it's a whole different story.
Yeah, I think inflation is. The problem with inflation is the Fed's target of 2%. That's the problem with inflation. It's just not a reasonable target. If it was 3.5%. We can get there. The current maybe like that, and situation is no more room to either you raise the floor of 2 that you're trying to get to, or something's going to break. And I think that the most likely outcome now is that they come back with a revised, hey, in discussions with the Treasury and the executive administration, and blah, we've come to the decision that the new target will be 3%, 3.5%. I think that's the only option, because you can't squash inflation any further by raising rates.
Jordan, I know, Jordan, you've got a different take on this. Would love your thoughts on what Vinny said.
Yeah, thanks for having me, Mario. Vinny, I'll respectfully just slightly disagree with you here. I mean, first, I've been watching this whole thing unfold. It's been a really uneasy, I think, not just past 48 hours, but past couple days for everyone in the crypto space, us included, guys. We used to bank with Silvergate. We had to scramble to find new banking for NFT.com and everything that we're working on. We're safe now. We're able to actually set up temporary attorney trust accounts, so our funds are safe. I think it's a detriment what's happening to banking in the crypto space, but I do think this administration waited a little bit too long to step in here. So I agree with all the comments that there's now 2 tiers of a banking system, but for any entrepreneur out there that is holding working capital at a less than a tier 1 bank, at a regional bank, you've got to wonder why would you keep your funds at a regional bank at this particular point, when it seems like all the signs, unless this backstop that we're talking about here is going to backstop all uninsured deposits at all regional banks, not just Silicon Valley Bank and not just Signature Bank here, but we're talking about backstopping everything else. Why wouldn't people go move their funds from First Republic Bank to JP Morgan Chase to Bank of America to the Royal Bank of Canada if they can open accounts there? It seems nonsensical that you'd continue to keep funds at these lower tier banks. So that's
but my read is that's what they've done. In case I've missed something, that's what they've done. They've basically said that they've given the facility to all the banks, whether you can redeem your underwater securities that you're holding at par. You can loan at par.
Vinny, but have you seen something that says that it's a backstop at more than just Signature and now Silicon Valley Bank? Are they going to backstop Customers Bank and First Republic?
Yeah. That was my in the discussions I've been in today. That's everyone's understanding. I know the Treasury put out a statement. I read it briefly. And there may be some other information out there. If anyone's got information, my understanding is that is exactly the case. They've basically backstopped the entire industry.
Okay, so then final comment on this, Mario, and I'd be curious to get everyone else's thoughts here. Then I'd be short the U.S. dollar at this particular point, and I think it is the perfect setup for crypto, right? I mean, you want to be buying gold and you want to be buying Bitcoin because you can't unlimitedly backstop $22 trillion in U.S. deposits. It's
the issue. No, it's the $600 billion in losses that have been that basically the impairments happen because of the accounting rules. It hasn't been taken. The mark-to-market's not taken because the banks are going to hold those to maturity. What the Fed's basically done is, let's say, for example, you bought a mortgage at $100, right? And now it's mark-to-market at 80. The Fed's willing, if you hold it to maturity, it's worth 100. So the Fed's willing to lend you 100 against it for liquidity reasons. And so you can just hold it basically until maturity, and that's
right. So they'll take all the long duration fixed income stuff that was the
basically exactly it.
Yeah,
exactly.
So, listen, again, if they're going to do that, why? And I think you can already see it if you look at the Asia opening here. The U.S. dollar is taking a beating against some of the Asian currencies. Like, why hold dollar? Move it to Singaporean dollars. Move it to gold. Move it to. It just it's.
I mean, the one thing they did save is U.S. dollars fleeing the U.S. I mean, there are a number of people who've been having conversations about moving their dollars outside the U.S. banking system to insured countries, etc. And you can actually have dollar-denominated accounts in other countries that are insured more than the 250K. Yeah. So there's
a lot of crypto people here. Do the other crypto folks believe this is like the perfect setup for Bitcoin? Because I can't imagine a better setup for crypto right now than that course of action. Circle's going to be fine. They're going to be able to move their funds to BNY Mellon. I think this could last. This could potentially have.
I think it was kind of interesting that a lot of people were turning these banks going down into a bearish case for crypto, and I understand that some people get hurt in the short term, and there's going to be some small implications. But I mean, at the end of the day, I mean, these are the traditional financial rails failing crypto. And we saw crypto go down in the past, but I think most of us are really focused on the stuff that's been around for a long time and been through multiple cycles. And I don't personally think that's just Bitcoin. I think there's a handful of coins that fit that space. And I'm really focused on stuff that's being built as payment rails, and that's going to be adopted in the future. And me seeing two banks go down that have some deposits for these companies that are getting backstopped, like, why would that change the theory on crypto? And I just think it's important to kind of zoom out once in a while and just take a look at this from a much wider view. And yeah, I don't see what would have really changed the overall view here. And for me, it just kind of proves the theory that we're going to have to keep innovating in this space and get financial products that don't keep breaking. And for me right now, whether or not that's directly crypto or there's some other thing out there, right now it looks to me like crypto is the front runner and it continues to survive stuff like this.
I would say I wouldn't put all crypto in one basket.
but
It's important to differentiate, Bitcoin from startups that will struggle with VC funding, for example, if Silicon Valley Bank failed, or we continue seeing a contagion.
Perfectly fair. Yeah,
But you really need on ramps and off ramps. I can't tell you how hard we work to find banks that would support our industry. The exchange, the reality is that I think we said on Monday, some exchanges are a crypto to crypto bank, and they weren't before.
Is there any
but do we not think bigger players are going to step in?
You need the on ramps and off ramps. It's just been such a problem for so long, and you need the next wave of people. They all need an easy way in and out.
Again, the golden opportunity there for the third or fourth time bringing that up here. But one thing I wanted to mention was, is there any idea, and I think the answer is no, of the permanence of the permanence of these actions, in terms of what's being made available to regional banks. Jordan, I never found myself first disagreeing so hard against something someone was saying, and then all of a sudden flopping the other way and agreeing with like pretty much 100% of what you were saying there. But my question is, do we expect, what's been put forward here in terms of this backstop and sort of these loans that are being made available? Could it be easy come, easy go? It's 6 months from now. This isn't really an issue. It gets pared down or further tailored to the needs of regional banks. But my mind now flips over to what Jordan said. Why would you keep your bucks, at a regional bank? And I mentioned this earlier in the space. Keep your eye on the flow of money in these coming days and this week, of money out of those banks and into your too big to fail banks. And yes, even although I don't think it's the biggest narrative out there, and I certainly don't think Janet Yellen, over the course of this weekend was a rational mind.
So Matt, thanks for joining us. I'm not sure if you joined us after we've had the information.
He did,
Oh, you did.
I'll ask him. I'll ask Matt a specific question. Yes, Simon, because I know I was there when we were asking questions earlier. Matt, I want to get your thoughts on. We're talking about crypto now, but I want to go back to the general financial markets. If we do see a contagion continue over the next few weeks and months, especially with everyone so sensitive after 2008. I know it's not the same, we're not going through the same thing, but loss of trust in the system is probably the biggest risk. If that does continue, will the Fed have to step in again and again? And does that mean the US dollar is we're seeing weakened in the last few hours? Should we be running from the US dollar?
First of all, I hope somebody here has taken the time to alert the Guinness Book of World Record for the longest spaces in history, right? I mean, you must have done it, or you're going for the record. But
we can't. I can't beat the record. We made the record during FTX. Nothing could beat FTX.
That, Mario.
Well, that was.
Well, don't put a ceiling on your ambition. Something could happen overnight. So, but anyway, I think the word contagion implies same disease, right? Same illness, and so I just don't see. I think what the action they took actually does contain this, but It does, like I said before, it doesn't change the overall problem, but I just don't see it. I mean, it's somebody here I pretend can find a hole in it, but I think they basically shored up confidence that no matter what happens, depositors will be backstopped, and so that prevents them around the bank. You saw the First Republic statement that just went out, so I just don't see it. It doesn't, like I said earlier, it doesn't fundamentally change the problems, and the Fed's still going to be raising 25 bips.
Yes.
So Matt, yeah. So Matt, I mean, we were discussing this, but is this backstop for all banks? Whichever bank in the future falls into the same situation is going to have this this safety measure.
I mean, I think that's the thing that they're going to have to address very quickly is how to. I think one of the rule changes is going to be the concentration of insured funds, right? Unless they just created uncapped deposits, which they didn't. So then the only way to roll this back is one, mark to market, to deal with change the regulations around concentration, right, of uninsured funds. I don't think there's going to be an uncapped, limit forever. But I think short term, the contagion I think has been stemmed.
Just to make sure we're clear here, the resolution of the Silicon Bank failure is very different to what they've done for all the other banks. So the other banks, if you need liquidity, you can just borrow from the Fed very quickly against assets that are marked down. That's my understanding of what they've done. And so
that's correct.
Yeah. So they've given a big facility, and so even if you're underwater, you can still borrow against the full value. So there shouldn't be a liquidity crisis now. That doesn't stop a bank from doing crazy shit and investing in things that that blow up. But in the case of securities and treasuries that are underwater, the Fed's basically giving these guys unlimited liquidity to deal with.
So Vinny, on that, I mean, doesn't that then give banks, especially the smaller banks, almost carte blanche to basically take as much more risks, knowing that they've got some kind of backup?
Well, no, think about it, right? You still have to balance your book. You still have to comply with regulations. But in the case of mortgage-backed securities or treasuries that are trading below what you paid for them, you have a credit facility, and I think they're charging 4 to 5% or something on that. So there is an interest rate that you're still paying to borrow. But basically, what they've done is they've said, how do we prevent run of the banks? Let's guarantee banks that they can borrow as much as they have against us. And the only banks that are going to go under are ones if there's fraud. Obviously, something blows up, that can happen. But if they basically if it's a what do you call it? There's a liquidity ratio, I think it's on 10%, and if you need like 20%, you can just borrow against your securities. And I think what the problem with Silicon Valley Bank is that facility wasn't in place 2 days ago, so they couldn't, and that was the problem.
So Jordan, you mentioned gold. I mean, as an alternative, and we know we've got a lot of Bitcoin guys here on the space, but I mean, why wouldn't gold be a good alternative rather than Bitcoin, which still has a bit of risk elements to it?
Gold's fine.
I can answer that. I was actually speaking to someone earlier about it. So why don't you hold gold versus Bitcoin or any other potential digital currency? Well, we work in a digital economy at the moment, so the biggest problem with gold is, if you need to buy something, it's quite difficult to transfer. So it's not really money. It's more a store of value, whereas Bitcoin is both a store of value and money at the same time. Also with gold, you've got to still have a custodian to custody that gold. So you still got custodial risk, right? Unless you want to truck gold bars in your backyard or in safe or something, which is quite difficult to do. Whereas, Bitcoin, you can be a custodian of your own assets. You got no custody, no counterparty risk. Obviously you've got security risks and risk of losing your keys, but that's on you. So I think it's very different both in the technology as well as fundamentally what it does.
Okay, that makes sense. Matt, in terms of what's happened, do you think that the current situation where it could cause high inflation in terms of the credit line?
Say it one more time.
Yeah, of course. So basically, in terms of the move that's been made, in terms of the support the Federal Reserve is given to these banks, could that entail in the future cause high inflation in the economy?
I think the economy is doing a good job with the high inflation on its own. I mean, that's why I'm saying nothing's changed fundamentally, right? They haven't been able to get inflation under control. We haven't seen a sufficient uptick in unemployment until that happens. The consumer is not going to pull back on spending. The consumer is still spending the contrails of $3 trillion of stimulus and the pandemic savings. And they're using basically credit to go ahead and bridge the gap that's been created by inflation, right? And so nothing has changed. I don't know if this particular move creates inflation. Ironically, this particular move creates a moral hazard of a different kind with the banks, which is why I think this is a temporary stopgap measure that they now need to go back and change regulations that led to this mess. But I don't know if
Now,
this
what's your stance on crypto, Matt? I don't think we've had that discussion.
The big picture. I think crypto
Big picture, and do you own any?
Of course I own it. I'm full degenerate. I mean, fully committed to the very end. I mean, I managed to lose money in every kind of scandal too, which is pretty impressive. lost money in Anchor. I suspend my judgment all the time to be a crypto true believer. But I think crypto is the unsung hero here that no matter what happens, just comes bouncing back. Those little things you had as a kid, you'd punch it in the face, it would kind of come right back at you. That's crypto. So I think crypto's done remarkable, and it's just not going away, no matter what. It's what I keep saying to folks who want to, throw shade. It's like, look at all the smart, intelligent people who have unshakable faith despite enduring every kind of abuse at the Thanksgiving table and losing money. I lost money to a hack. I lost money to every kind of situation. So I'm long crypto. I'm not particularly a Bitcoin evangelist, but that's just by choice. You can only focus on so many things. But I'm all into Bitcoin, particularly into ENS. Hello, my ENS friends out there. Have to plug or else they'll do
Matt, I'll bring you back into Bitcoin.
I'll come back. Look, I was mining it. I was renting server space in 2013 and first met my wife, and I was like, honey, there's only going to be 21 million. It's just math, and then like an idiot, sold that in 2017. But so I was there in the beginning. I'm just not into it at the moment. Not against it, just not into it.
Come on, Matt. You
sorry.
Oh,
I mean,
Matt.
somebody get me into it. Somebody can recruit me. I'm willing to be recruited.
Umbrella, go ahead. Tell us what your strategy is, Umbrella, because you've been giving us advice in every crypto space we've done for the last 8 months now, and you're probably one of the most degenerate people I know in the space. So, what's your strategy?
Yeah, I mean, like I've been an ETH maxi for many years, and now I'm finally getting back into Bitcoin, which was kind of my home back in the day when the only way to kind of, I'm a gamer as well, like Elon, to pay for skins and kind of boxes on CS, Counter-Strike, you had to mine Bitcoin or somehow get a hold of it. So, that's me back in the day, and kind of obviously I'm a tech believer. So, kind of ETH was formed my home for a number of years, but now I'm coming back on Bitcoin, specifically with ordinals and what that brings. And I think that's going to bring the next revolution of adoption, both in crypto as well as on Bitcoin, in terms of what you can do. Let's call them pseudo NFTs, because technically they're not NFTs, but in terms of ordinals and inscriptions, I mean, historically, Bitcoin's just been a pure money play. But now with inscriptions, it brings more additional utility to directly on Bitcoin, not through kind of side chains beyond that of money. And I think that's bullish for adoption and bullish for the different type of technology we can build directly on Bitcoin, whether it's pure digital artifacts or potentially down the line. I definitely see this interacting.
Do you have the concern that Simon was expressing earlier about the on-ramp and off-ramps to the space and the potential lack of liquidity, at least in the short term?
I mean, I don't necessarily think so. I still think if you want to get into it, you can do it. Whether you're using large institutional OTC desks for big institutions, there's still, like, even if I use Kraken or Coinbase or Circle, they've got other banking partners that you can use. I mean, I don't see it as a massive problem. I think that only becomes a massive problem if they start banning it outright. I think that's when it is. And I think the biggest thing we saw this weekend was, we had 3 banks going down in the last week. those depositors at the bank weren't able to get any of their money out. Yet, if you were holding USDC, you could still trade that for other assets 24/7, right? Even though they were caught up within those bank runs. And that just shows the tech that crypto can bring. Yes, it might have depegged, but it depegged based on the risk that they were facing, but you were still able to take that haircut if you felt, I thought there was a larger bank run potentially down the line and I didn't want to be exposed to any of this at all. You could have traded out of it. Whereas if you were a depositor at that bank, you didn't have a choice, right? Obviously, we see now they've been made whole, but crypto, the technology behind crypto gives you that option, that 24/7 tradability as an example. And I think, that's something we've seen, and we've seen how resilient in nature it's held up over these last couple of days.
I am to follow up on that last point about Bitcoin. I am intrigued by ordinals, by the way. Some of those smart people have kind of convinced me that it's worth taking a look at. So if anybody wants to shill me and DM me, I am interested in putting in a little time. I mean, my approach, I don't know if folks on the call know this, but I have a fund with Gary Vaynerchuk. We have a metaverse fund. We've been at it for some time. We're investors in Immutable, IMX, and a bunch of others. And I keep trying to look for DeFi solutions that even normies would realize is elegant and is a change in how things are done for the better. So, for example, company I'm invested in is N Labs, and they're bringing factoring to the gig economy using a token. It's really smart, really intelligent. So also looking at carbon credits. So I keep trying to invest in things on DeFi that even somebody who is skeptical and cynical, couldn't resist. But anyway, I'm open to looking at ordinals.
Digital, you guys go on, Joa, because you sent me a long message. Yeah, go ahead.
Yeah, I measure tribalism, right? And if you look at it in the beginning, if you just look at it from an early adoption curve, you have the innovators, which were attracted because of the new tech, kind of like one of the guys was saying, hey, check this out, there's only 25 million tokens, it's just pure math, right? That's like the innovators. Then you have the early adopters came, and you can see it based on the percentage of adoption in America. COVID happened, no one could connect with people. NFTs offer community above most else. It was able to connect with new people, which you weren't able to do during a lockdown. Huge explosion in interest in NFTs. It filled a need. People wanted to connect. People loved the new family, let's call it. And it really created a new explosion. We're now at 12.6% adoption, or 13.6% adoption in the United States. When you get to 14, you start going into the early majority. And there you go from 13 to 40%. And I think that next phase is when you look at other countries that are already above that threshold, they've gone there because of the threat to their economic system. Vietnam, Turkey, Argentina, Brazil, like these adoption rates are higher than America because of the threat to their currency. I think this with the bank actually helps that narrative a lot. So let's have more spaces about how this is horrible, because I think it'll help adoption. Oh, and I also believe in ordinals.
Wanted to take it a step back, and we can get back to crypto. I love talking about it just as much as everything else here. I was reading some takes from some friends on this issue, particularly around how now if banks can mark at par their treasuries through the use of this facility, is the question is, isn't that just quantitative easing for the banks, so the Fed can tighten elsewhere, right? Basically on the retail side, but banks pretty much get QE. And wouldn't that, I see a lot of 100%, I like that. And it would kind of give them permission to go ahead and continue raising rates. So I know that might go against what some of my fellow speakers here have said about, sorry, Vinny, I think that was you, that they're done hiking. Well, if we think that, hey, it's QE for the banks, let's full on keep hiking. It's not a bank problem anymore. They can mark those bonds at par, do whatever the fuck they want, and at the end of the day, it's a retail problem here on the rate hiking side.
Yeah, the only problem is that I think that
you're looking at just a couple of the assets that are sensitive to rate hikes. There's a lot more that the banks don't own that sits in the economy as well. I mean, you've got REITs, you've got the housing sector. Look, whatever I say right now doesn't matter. What we say doesn't matter. All that matters in the next 2 weeks is CPI. Okay, it's very simple. If CPI prints at 6.5 and above, we're screwed. We're going to get 50.
Yeah, rates up. Yeah, we're going up 50 bits.
If it's below 6, we're going to see very little action, in my opinion.
25 bips there, super cool. Maybe I would, like I said, entertain nothing, but I don't see it. I actually believe with Matt's take wholeheartedly on a 25 basis point hike.
I agree on 25. I think they have to do the 25 to for credibility purposes, nothing else.
Yes,
because they've already signaled it. They have to do it, but then they're going to stop. And I think they may just say we're going to wait for things to play out. I don't think they can do 0. I think that unless things really deteriorate, I don't think they can do 0. I think
I mean, if things go to crap, it's QE all the way down.
I mean, I had a question specifically, just taking it back slightly, bringing it back to the issue of the banks. Now, we know why SVB fell, but in terms of Signature Bank, I mean, I've been talking to a number of people who are affiliated with that bank or even were part of the problem, and they felt it was basically the media narrative, channels like CNBC and these type of channels, whichever channel it was in the US who deal with this type of stuff, who basically caused this issue to basically become much worse than it really was. Special, you got your hand up. Have you got any thoughts on that?
Yeah, absolutely. So, I mean, you could blame the media, you could blame the VCs, but SBNY outside of PacWest, First Republic, and Comerica had the most exposure to venture capital, along with like the SEN network at Silvergate. They had their own network for crypto investors. So you had both exposure to crypto, not actual crypto that they own, but the fact that they had, they were facilitating transfers into the crypto market, along with the fact that it was exposed to venture capital, that the deposit outflows were happening in a big way for FRC, SBNY, Schwab, and PacWest, even before today. I mean, they probably had tens of billions of outflows on Friday. So we're all conjecturing. No one knows the truth. We'll know next week. But I bet that SBNY was seeing tens of billions of outflows on Friday, and that's what contributed to. In fact, the CEO was surprised. He said, this was on Bloomberg, he was surprised that the bank was shut down. But there are a lot of banks that are going to be even good banks that are going to see a lot of deposit outflows. So it's something to spend, and it's not to be taken lightly. It's a great bank, but I think First Republic is a decent bank. But just because you're a good franchise doesn't mean that.
But it happened so quickly after, wasn't it? People like Jim Cramer on CNBC who was basically causing, impacting on what was happening and then causing the fear, and then this caused the bank to occur.
Yes,
Anyway.
I think the VCs and the media are responsible for causing a lot of the fear that forced tens of billions of dollars out of several banks on Friday. We're going to find out. They're going to file 8 cases. So we're going to know very soon, just like we knew about. We were talking about whether this bailout is going to happen or not. Guess what? It happened. We're going to know very soon which banks saw deposit outflows and which banks are going to need to raise equity capital and preferred capital.
So my question is, do any of the banks actually need to do that now? I'm just reading this Wall Street Journal article now. First Republic, like 50 minutes ago, announced that they have shored up $70 billion, and that's likely using the facilities the Fed has made available. But surely, if these facilities are available, don't you think, I don't know who was just talking about special situations there, don't you think that every regional bank taps into that facility and then makes that similar announcement over the next 24 hours?
I mean, what does that actually mean, though? A lot of banks already, by the way, the SIVB already had $55 billion. They're borrowing at the discount window. The discount window is just a short-term loan. The discount window is not a bailout. Depositors were bailed out from SBNY and SIVB, but that's very different than actually bailing out a bank. The discount window is to avoid massive
bank runs, and so that these guys can raise, tens of billions of dollars of cash to offset the money leaving from deposits, and it's to ensure confidence. It doesn't solve the problem. The problem is that a lot of these banks have a large percentage of uninsured deposits, and they have held to maturity securities that are not marked to market on their income statement, and that speculators, short sellers, and depositors are going to be betting against these banks and pulling out their money. And the Fed is going to do everything that the Fed can to ensure that there's confidence behind these. But the discount window itself doesn't actually solve the problem. It's a band-aid. You could still see deposit outflows. It's just going to be offset by the 70 billion liquidity. And I actually like FRC as a business, but I will tell you that SIVB on Wednesday was telling investors that they had 180 billion of liquidity. What happened to that 180 billion? Well, when the VC said that they were running, about half of that liquidity was coming from what they call in their 10K, which is, I think it's bizarre, but off balance sheet deposit accounts. And the other half was coming from the securities portfolio. But what they didn't tell you was that 55 billion was already pledged to the discount window, which meant that they were double counting the availability they had in their securities portfolio. So you just have to be very careful when these headlines come out. That doesn't mean that everything is okay. The discount window is just a band-aid.
Yeah, so I'll renew. Just final thought. I'll renew what I said earlier, then, which is, it's just further confirms what I suspected, which is, why would you keep your money? Why would you risk keeping it in a regional bank if it really is just a band-aid on the solution to help them make the withdrawals? It doesn't solve the problem with the regional banks and their solvency. You'd go to one of the big four, put your money in Chase, Wells Fargo, Citi, B of A. Why would you use an FRC? Why would you use an M&T or a Citizens?
I think the reason why, if I could jump in, is those particular banks bend over backwards to maintain the relationships with big depositors. They do things, not unnatural things per se, but very friendly things. And so that's the reason why you go to those banks. And I guarantee that First Republic CEO, any of the banks that we're going to come up with, are on the phone, all weekend long with their big deposit holders, going one-to-one, which a JP Morgan's not going to do. So I actually do think that most of those deposits do hold after we get past the headline risk of the next 48 hours.
To be more
Matt, I've got a question for you. Sorry, 1 second, guys.
Okay, go ahead.
Matt, I've got a question for you. Obviously, we know this decision's been made. The Fed and the government came together and made the decision. And obviously, you've got experience in crisis management. You wrote a book called Burn the Boats, which is specifically about crisis management. So my question to you is, and I think a lot of people are thinking this, did they actually do the right thing in terms of the crisis situation they're in? Is this a short-term solution, or should they have been thinking more long-term? And when you do crisis management, do you think about the short-term and the long-term, or is it deal with the specific issue at hand and then we'll deal with the long-term later?
And I'll just jump in here, Matt. First, massive shout out to Burn the Boats as well. Highly recommend it for anyone listening. Burn the Boats. And Matt, as you answer this question as well, I want you to give us kind of a final wrap up of look. I don't want to keep the space going just for the sake of it. We kept it going for 3 days because it was needed for the audience. I think now the story's over. We've got to wait till tomorrow to see what happens. So if you could give us final words, you and Jay, special situations, give us your final thoughts. You've been there for a long time. With us covering the story, what can we expect over the next few days, and what could still go wrong, if anything?
Thank you for the shout out of my new book, Burn the Boats. It's if you go to my profile, you can see it, but I appreciate it. Go a lot into my days at 9/11 and crisis management. I think big picture, I do think the government handled it as good as one could expect. When we first started, we all were skeptical. We thought they would have a half measure that wouldn't be sufficient. They would have maybe announced they were doing those advanced dividends. It's amazing. I feel like we've been doing this for a week, but of 50% maybe. But the reality is they went all the way. They didn't just deal with SVP. They went and they stopped the contagion. So I do think it's a case study. If anything, I think they got wrong, to be frank. And I say this in a nonpartisan way. If I were Biden, I would have been more ahead of it. We all knew when Janet Yellen went out this morning on CNN and used that language, parsing deposit holders and separating them from equity, pox on all their houses. We knew where this was going to end. So if I would have been more ahead of it if I were Biden. But otherwise, good. I think the reality is this passes over in 48 hours, notwithstanding recrimination, which will go on. I think the story moves to those transactions, right? Those in January, the stock sales, and into the fact that bonuses were paid on Friday. There's all sorts of things for people to be looking into. That's where I think the story moves, and then we return to our regularly scheduled programming of we are in trouble, inflation's not under control, 25 bips. All the canaries in the mine I've been talking about. But specifically, as for the hangover from Silicon Valley Bank, I put an article on Twitter about from 2022, the last reference I could find to the percentage of their debt that was related to lines of credit. I think that does become the big issue. You still have thousands and thousands of companies now who just lost a significant amount of their runway, and they are going to be making more retrenchment decisions sooner than they expected, and they're going to be running around trying to replace those lines. No one's going to replace them, and so that means massive down rounds are going to come sooner. That's one of the short-term consequences. But I do think that this becomes the snowstorm of the year we can't quite remember in another 72 hours. Could be wrong.
Jay, your final thoughts on what we can expect over the next few days and weeks?
Absolutely. I agree with a lot of those points. I think that the discount window solution is a temporary solution, and that a number of these banks will eventually have to raise equity and raise preferreds, and it's going to create more scrutiny around the banking system as a whole. They're all reporting in April, so there are going to be a lot more disclosures around held to maturity securities. And what the big thing that people aren't talking about is the commercial real estate market, which Grant has covered as well. And that's a $21 trillion market that I think is most of the marks are completely incorrect. And there are some buildings that are probably worth, in this type of rate environment, with only 50 to 60 to 70% capacity utilization, they're probably worth half of where they're marked, which means that some of these CRE loans are going to be impaired. And as these CRE loans are impaired, you have to look at the banks that have a lot of commercial real estate exposure. So this is just round one. This is round one. The fact that the banks are backing all of deposits, whether they're uninsured or not insured, means that the market's likely going to rally, because this was not priced in on Thursday and Friday in the short term. You're actually even seeing bonds widen out a little bit after the huge rally on Friday, which is great because we sold half our bond position on Friday. But you will likely see that this is a short-term Band-Aid, and then a lot of these tech companies are going to be struggling to get access to credit because SIVB was a unique animal that was lending to these venture companies. So you're still going to see companies like Twilio and Datadog and Microsoft possibly see declines in their sales. You're still going to see layoffs. You're still going to see people frantically trying to find lines of credit. Some of them will, some of them won't. Oaktree is buying some. Several other hedge funds are bidding on them. Liquidity Capital is bidding on them on Lafayette Street in New York. So this is a movie that's still in progress. And the Fed.
When's round two?
Well, we're still in the first 5 minutes. I've just pinned a tweet about 20 other banks that are sitting on huge potential security losses, just like Silicon Valley Bank. So there's more to come.
Yeah, I mean, I was off for the last 2 hours. We just did a 2-hour live meeting for subscribers, and we went through over 50 banks, went through the different types of security exposures they have. They're 4,900 banks in the United States, guys, and several hundred of them are publicly traded. They have prefs, hybrids, junior bonds, unsecured liabilities that are traded, and they have equity. A lot of these banks are going to have to issue stock, and they're going to have to issue preferred, which is going to be negative for the stock prices over the next several weeks, because the discount window is not going to solve this problem. However, because the government's reaction was, I thought, very, very swift. Whether it's right or wrong, you guys can be the judge. But because of how swift this government action was in supporting 100% of deposits, you are first going to see a rally in the market, and then you're going to see the short sellers come in and start, taking positions in some of the weaker banks.
Appreciate the update. For everyone listening, I urge you to do one thing, which is what I'm going to do, what Sliman's going to do, is first, of course, follow all the speakers, but take a rest, jump off Twitter. You need it. Appreciate you all. And we've been here for months covering every breaking story, and we'll be here again if needed. But we do daily shows as well, breaking down the headlines. You'll see us again tomorrow unless some shit happens between now and then. Unlikely. Enjoy your Sunday. Thanks for all the panelists that are here now. Thanks for all the panelists that joined us over the last 40-something hours. And we'll see you again soon. Appreciate you all. Thanks, Lemon.
Thanks, everyone.
Get off Twitter, everyone. Get the hell off Twitter. Go rest. Enough.
I can't.